Good morning. It is 9 a.m. on Tuesday, February 15th. This is Yahoo Finance Live. I'm Julie Hyman along with Brian Sozzi. Let's take a look at futures here this morning. We have been seeing some bouncing around going on as of late in the mornings. Today, we're bouncing to the upside. NASDAQ futures leading the way, as they tend to do, both to the up and to the downside, again, as of late. NASDAQ futures indicating a gain of 1.5% at the open. S&P futures up 1.1%, and Dow futures up by 0.9%. We got some inflation data out this morning on the wholesale level. We'll talk more about that in just a moment. Back from the brink, Russian forces seem to be de-escalating a potential conflict with Ukraine, but the back and forth news has whipsawed markets. We will dissect that action. Bearish on tech. Fund managers pull back their weighting to the lowest since 2006. This, of course, reflected in the 12% tumble that we have seen for the NASDAQ this year so far. We'll have the details on Bank of America's latest survey. And Warren Buffett, gamer? Filings reveal the Oracle of Omaha's firm took a stake in Activision Blizzard ahead of its announced acquisition by Microsoft. We'll have those details as well. First, this morning, though, we do seem to be seeing a de-escalation between Russia and Ukraine for the moment, even as we got inflation data here in the U.S. So just bringing you three charts that reflect this morning's action, aside from the futures where we're seeing strength. And let's start with the 10-year note. For that, we're taking a look at the Wi-Fi Interactive, the Yahoo Finance Interactive. We've got the 10-year yield up to 2.04%, but we did not see much change. You see 830 on your screen there. We didn't really see much change at the 8:30 mark, did we, this morning when we got that data out? That's even though it came out better than estimated. You see here, or I should say higher than estimated. You can see that 8:30 move, which wasn't really much of a move, but PPI coming in for final demand up 9.7% year over year, 1% month over month. That is above estimates on both counts. In other words, hotter inflation than estimated. Energy is a component of that, up 2.5%. If you exclude food and energy, core PPI still rose 0.8% month over month, 8.3% year over year. You could argue we're not seeing much reaction to that this morning because we got CPI data already. So that was really the number that the market was reacting to. And then we have the latest on Russia, and it does seem like we are seeing some de-escalation. Russia's defense ministry saying that some troops deployed from military districts bordering Ukraine were actually being taken away from the border. So there are a number of different ways that we can slice and dice this morning. You can see here the benchmark index in Russia, or one of them, up this morning by 3.3%. That's one way we're measuring things. On the flip side, we've got crude oil futures that are down. But in recent days, of course, we have really seen oil bounce around quite a bit and rise to above $94 a barrel when it comes to WTI, even higher than that when it comes to Brent. Today, though, we are seeing that pullback. So how should we continue to read this Russia situation here? We want to bring in Doug Redeker. He's Brookings Institute non-resident scholar, senior fellow, foreign policy, global economy and development. Pardon me, Doug. Thanks so much for being here this morning. I want to start with, what is Putin trying to achieve? And then with that in mind, how can we try to extrapolate what he's going to do next?
What is Putin trying to achieve is the how many trillion-dollar question, because that's really what's at stake here. Nobody knows. So first of all, I would not want to be the guy who throws cold water on this morning's upside news about the withdrawal of some troops. But let's be clear, this is not the end. This is not suddenly a never mind, oh, just kidding kind of moment. There's a lot at stake here. There's a lot at work here. And what intelligence analysts will always tell you is, look at what Putin does, not what Putin says. So first of all, yes, good news that there's reports that the troops are being withdrawn, but it's some reports, some troops. There's also other reports that the Duma, that's the Russian parliament, has approved a non-binding resolution that recognizes the two breakaway republics in the Donbass, that area of enormous conflict and tension that's subject to the so-called Minsk II Accords. They want to recognize those as Russian territory. So that is a pretext for a completely different angle that the Putin government could have to play in Ukraine and in this broader saga. So the answer to the overall question, what does he want, remains very outstanding. And I break it into two buckets, basically. One is Ukraine specific, and the other is more broadly. What is NATO's role? What is the US's role as a security guarantor for Europe? What are those Central and Eastern European countries that broke away from the former Soviet Union in the early 1990s and joined NATO formally in 1997? What is their future? Because Putin put that all on the table, and that is still all very, very much in play and unresolved.
Doug, should Russia invade Ukraine, what do you think some of the responses by the United States would be?
Yeah, that's a great question. So there's a part of this that we call proportionality, which is, you remember Joe Biden's famous press conference a couple of weeks ago, where he used the phrase minor incursion and distinguished that from a major invasion. And the problem that we all have is somewhere between a minor incursion and a major invasion are a lot of nuances of what the Russians can do. And those will all likely engender a different set of responses, both from the US and from the EU, either separately or in coordinated fashion. At the most extreme case, you're talking about sanctioning Russian banks to the point where they simply aren't allowed to do business in US dollars or with any other entity that does business in US dollars, which effectively means European banks and almost everyone else. There's some people that talk about oil sanctions and gas sanctions. I think that that's far-fetched. Even during the height of the Cold War, gas flowed from the Soviet Union into Europe. That, unless it is a warfare casualty, I don't think that the US is going to go out and sanction those transfers of gas into Europe. Nord Stream 2 is a separate issue. That is not fully functional. So while it has huge geopolitical impact, it doesn't really have any immediate economic impact. But there's also another area that the US has floated, which is to use something called the Foreign Direct Product Rule under the Export Control Act. It's a lot of gobbledygook, but basically what that means is the US could say any company in the world that exports any particular product, and in this case, we're talking about high-tech semiconductors, to go to Russia would be prohibited completely. That means that Russia would be cut off from all of the bones of the future development of artificial intelligence, and let's say all of the technology that's likely to power the 21st century economy. That's the first time the US has ever floated something like that. It doesn't actually require the EU to come along, something that's completely within the US competence. And that's a big deal that Putin didn't expect. So between financial sanctions, potential energy sanctions, and these technology-based sanctions, those are three big areas where Russia could be hit.
Well, let's flip that coin around. What actions could Russia take on the U.S., Doug? Because there are a lot of U.S. companies, of course, operating in Russia. You know, top of mind, I think McDonald's. I think a lot of the fast food companies. Could he shut those companies down?
Yeah, but I think the risks are far greater than that. I think one of the big problems we have here is we're getting into the area of the unimaginable. So if you're really in a warfare scenario with Russia, the ability for Russia to pull a trigger on some cyber attacks, not just against Ukraine or even Europe, but against the US, depending on how aggravated Putin gets, they could do some real nasty damage. Because the expectation, now I don't know, you don't know, but the basic expectation is that we have the power to, for example, shut off Russia's utilities, and they have the power to do the same for us, simply because over the years, you know, each side has enormous cyber attack capability that is sort of lying in wait. So if you think about the worst case scenario, which if you're in the US government, you're paid to do, you're probably warning utilities, private companies, banks, and other actors that they better bolster their cyber defenses to a level that they really hadn't anticipated before. Because it's more than just shutting down McDonald's or even, you know, refusing to allow people to leave the country or to enter the country on a commercial basis. This could get much more widespread and much more dangerous if it reaches into the realm of cyber. And depending on what we do and what he does and what we do and what he does, it could escalate to that point. And that's got big consequences.
I mean, one would hope that this is like nuclear detente, right? Where because you know that the other side has the same capabilities that you do, nobody does anything. I guess that would be the hope, but I don't know how that would play out in reality. So given the scenario that you're painting here then, and given the potential for that, what do you make of the U.S. market's reaction that we've seen thus far, which in the past few days, we've seen more of a reaction. We've seen reactivity to various headlines.
Well, you use the key word there, and the key word there is headlines. This is a story that has so many levels of complexity that headlines can't really grasp what's going on. But we all know investors, markets, traders focus on headlines. So when you hear a headline or you read a headline that says Putin sits down with Lavrov and talks diplomacy, that makes you feel that the risk of war is less than it was before you read that headline. Similarly, this morning, you had the headlines about the potential for removing some of the troops. That's a positive headline. So the markets are really reading the headlines and reacting to those. That's better than ignoring it altogether. But I would argue this is a very nuanced, very complicated story. The intelligence community in Washington, which has both the intelligence we know about and presumably a lot of intelligence that we don't know about, they themselves don't know what's going on to the level where they have a high degree of confidence. There was a story this morning that broke right after the story about the Russians saying they're going to withdraw some troops, with a report saying that the U.S. now has intelligence that the attack is going to start at 3 a.m. tomorrow. So how do you square those two? You have to almost sort of pick the headline and run with what the theme of the market is for that day, that hour, that moment. Because in fact, if you try to get under this, which I and some others do as a day job, it's really hard to figure out what's going on. And so if you were a market actor, you'd say, wow, this is too uncertain. Maybe I just pull my chips off the table. But that's not what I would recommend. And that's not what traders and investors do. So on the basis of having what limited information they have, they run with the headline of the day.
Yeah, well, we really appreciate your helpful context here in this situation, being mostly lay people when it comes to the situation there. Doug Redeker, thank you for your expertise this morning. Brookings non-resident senior fellow of foreign policy, global economy, and development. Appreciate it. Well, as investors watch that situation unfolding in Ukraine, we are getting a new measure of sentiment from them. And that comes to us via the monthly Bank of America Global Fund Manager Survey. And in that survey, Saz, it sounds like that at least at that point, and I don't know what the survey period was, but at that point, they were not saying that this Russia-Ukraine situation was the top of mind risk, right? They said Fed, inflation, bubbles, recession, all seen as bigger tail risks than Russia-Ukraine. And as a result of all of that, most underweight technology going back to August of 2006, which we've seen play out in the market, so this is not a shock. But nonetheless, August 2000, that's a long time that we haven't seen people this underweight technology.
And as you know, Julie, I know you got a kick out of what I wrote this morning. It's now on the Yahoo Finance homepage, really reflecting fund managers also concerned about, quote, a recession scare. So that the positive thing is here, despite everything going on in the world, higher interest rates, really, really crazy levels of inflation, potential war between Russia and Ukraine, fund managers still do not see a technical recession this year. So that is good. But they do see the potential for concerns about a recession impacting stock at some point this year. Should also note, recession risk was the fourth tail risk to fund managers in this latest survey, behind a hawkish central bank. That was number one, Julie. Inflation number two, and asset bubbles number three. So again, lots of concerns clearly on the minds of fund managers, which in this survey, 171 participants that managed close to $400 billion in capital for investors.
Yeah, I mean, the Fed is far and away number one, coupled with inflation. So it's like a sort of damned if you do, damned if you don't on the part of the Fed, right? Because if the number one risk is the Fed being too hawkish, but the number two risk is inflation, which you address by raising interest rates, at least in part, then it's sort of like the risks are there no matter if the Fed raises or doesn't raise.
You're not asking me how we should play a recession scare, Julie. You have to ask me.
Okay, how should we play a recession scare for the 12% of the folks in that fund manager survey who are concerned about the recession scare?
Well, for those 12%, I can answer that question. B of A says you can play the recession scare via long bonds and short commodities. So news you can use right there, Julie. Short
commodities, though, has not necessarily been a winning trade in the very short term, in the very recent past.
Reporting what I know.
We'll see. Yes. Thank you for doing that, as you always do. We always appreciate it. Before we go to break, just want to check on one stock that we are watching this morning, and that is Yandex. Why are we checking on this stock? Well, it's sort of like the Russian Google, if you will. It has a search engine, has other things on its website, and it came out with earnings this morning, and it trades in the U.S. YNDX is the ticker. It's up almost 10%, as you can see there. Adjusted EBITDA at the company, 9.72 billion rubles. That's about $128 million or so. It's better than estimated. Revenue came in better than estimated, and the adjusted net income for the company came in better than estimated as well. So that one caught my eye. It was one of the most traded stocks in the pre-market, and of course, as I said, it is a Russian company, and there's a lot of focus on Russia this morning. Coming up after the break, we'll be talking more about all of these issues, including the tech trade, the risk of the Fed raising rates, the risk of Russia, Ukraine, all of that with Amanda Agati of PNC Asset Management. Stay right here.
Markets remain in wait-and-see mode with respect to the developing situation between Russia and Ukraine. Let's welcome in PNC Asset Management CIO Amanda Agati for more on the markets. Amanda, always nice to see you here. There's a lot coming at the markets very, very quickly. Russia, Ukraine, rising interest rates, inflation. We had a nearly 10% increase on the headline PPI. Lots going on. Do you think investors should be concerned about a potential recession scare? And what would that even look like if it should hit the markets?
Well, it's great to see you. Thanks so much for having me. There, for sure, is no shortage of material to try and cover and address and make sense of as it relates to this crazy market environment. We do not believe that the base case is for a recession to occur in 2022. We actually think that growth, while slowing, entering 2022, we're definitely seeing a slower pace of growth, both in terms of economic growth and also in terms of earnings growth. But slowing growth does not mean no growth, and it doesn't mean negative growth. And so we actually think the fundamental backdrop is pretty strong, even at this point in the cycle and in the recovery. The key challenge is going to be how far and how fast the Fed moves. That's our biggest worry. That's the thing that keeps us up at night. Are they going to be too aggressive and too hawkish that it might ultimately break the cycle? But we think there are a number of other forces at play here that won't force the Fed's hand to that degree. So we don't see it as the base case for this year.
Certainly, you're not alone in pointing at the Fed as the potential biggest risk for the markets right now. We were just talking about the Bank of America fund manager survey that showed that is the top risk in investors' minds. And the flip side of that we were talking about, and perhaps one result of that, is that people are underweight tech, or at least the lowest weight in tech that they've had in quite some time. You were mentioning the word growth a number of times. We're still seeing growth in a lot of parts of technology. Is that growth appealing in this kind of environment?
Yeah, I'm going to take the opposite side of that trade. So call me contrarian, if you will, but we actually think that growth in this environment is still fairly well positioned. There's no question that valuations are elevated across the multi-asset universe. Everything is stretched to a degree, but in a slower growth environment, we actually think investors will pay up for quality, defensible growth characteristics. So while aggressive growth has been taking it on the chin here, and I wouldn't say I'd be backing up the truck there, I do think that there are pockets of growth that still make sense here. You know, the key worry is always in a rising rate environment and a really steep yield curve that's just going to crush the growth outlook and potential for growth-oriented equities. But we actually see the yield curve as staying pretty flat. All the movement's happening at the short end. And so even with the Fed raising rates numerous times this year, we still think the backdrop is supportive for equities and supportive for growth-oriented equities, as long as that yield curve stays largely flat where it is today.
Man, I realize this might be hard to pin down, but how scared are investors when you talk to them right now? It's not something you can obviously measure in a spreadsheet per se, but after a while of doing this, you do get a sense on what investors are feeling and what they might be inclined to do next.
Yeah, I wouldn't say that our investor base is scared by any means. I don't think it's anywhere near as dramatic as that. I do think they have entered 2022 a bit more concerned about the pace of advancement and the path forward. And certainly it's been a number of months since we've had to wrestle with the downdrafts that come in a high volatility regime. But our investor base is certainly conditioned, as I think the broader market is, to this choppiness that we've really seen as a function of the entire pandemic. And so it's been a little bit jarring, certainly to start the year. I think investors have a little bit of whiplash as it relates to that, but I keep coming back to the underlying fundamentals. And even as a function of Q4 earnings season, which is, well underway at this point, we're still seeing very strong positive results coming out of earnings season. Earnings growth is way ahead of where the expectation was to start Q4 earnings season. Margins are sitting at all-time highs, like well in advance of prior peaks. Top line growth is still very strong. So there are still a lot of positives to hang our hat on here. The challenge in the short run is it enough to keep this market rally going in the face of Fed policy, stance changing and policy winds of change kicking up? We don't think that it leads to another significant downdraft. We think it really just leads to a fairly choppy, range-bound market in the short run.
And that is indeed what we have seen. Amanda, finally, I want to ask you about what we were talking about just a few moments ago, and that's the Russia-Ukraine situation, and then all of these sort of ripple effect tendrils that come from that, including what we've seen with energy prices. Is that something that you are acting on as of yet in your strategy?
No, we're not taking action on it. If you look at historically speaking, a number of geopolitical conflicts over the decades, it always leads to near-term market volatility, choppiness, much of what we're seeing right now. But ultimately, the market's able to kind of work through it, move past it, and ultimately forge a path higher. I don't want to say that that's a precise prediction. The crystal ball might be a little fuzzy relative to all the other, issues that the market is wrestling with this time around versus history. But we don't think that this is a really significant market moving event here in the short run. It's obviously something we don't want to take lightly. We care about what happens there in a very significant way, and we'll watch it very, very closely. But we don't think that's going to be the thing that's a nail in the coffin for this market rally. I do worry a little bit about what happens in energy markets, just given where energy prices are sitting today. You know, an oil price spike here is not good news, certainly for the inflationary backdrop and what the Fed might ultimately need to do. But that's probably the most top of mind thing that we're worried about right now as it relates to that conflict escalating.
Added to the long list of concerns, PNC Asset Management CIO Amanda Gotti, always good to see you. I'll talk to you on Twitter. All right, Intel is spending $5.4 billion to bolster its chip-making prowess. More on this deal next.
Welcome back to Yahoo Finance Live. We are just a couple minutes from the opening bell on this Tuesday morning, and we are seeing a boost for the futures, particularly for the NASDAQ, which is up by 1.5%. That's the strength of the opening that we're expecting this morning. In terms of some movers that we are watching here this morning, we're keeping an eye on Intel, and that's after the company agreed to buy Tower Semiconductor. It's an Israeli semiconductor foundry for about $5.4 billion. Now, Intel's not moving much. The Tower certainly is. The price on this deal, $53 a share in cash. Tower makes power management chips, image sensors, and Intel has talked about getting back into the foundry business in a more decided fashion. That is making the chips, not just designing them. Analysts, Brian Sozzi, seem kind of split on this one in terms of, because Tower's not that huge, right? So there's some questions, I guess, about whether this is enough of a building block for the company's foundry business.
Well, first you have to give Intel CEO Pat Gelsinger a little bit of a hat tip. He came in here more than a year ago, said, "Hey, I want to build chips for other companies. Here's what I'm going to do." This deal comes a few months removed of them announcing a potential $100 billion investment in Ohio to build out its own chip-making plant there. The initial investment, I believe, is $20 billion. But this is Gelsinger really going full force full force, using that strong Intel balance sheet to just build out its global capacity. Now, the real thing to watch here for investors, not necessarily this deal, that is February 17th. That is Intel's Investor Day.
There's the opening bell on this Tuesday morning. You see Chipotle ringing the bell. They just opened their 3,000th restaurant. So that's what they're marking here this morning. And the Chipotle executives there on the virtual bell ringing. I just want to pick up on what you were saying, Saz, because you were talking about that Intel Investor Day coming up. What are you going to be looking for from that Investor Day? And what investors are going to be looking for from that day?
I think the big number is capital expenditures, not to sound completely, absolutely boring, but this is a company, Intel, investing billions of dollars to support its business over the next decade of making chips for other companies, as we've seen today via a $5.4 billion deal for Tower. I want to see how much they're spending. And then also, too, I want to get their sense of how much, what the returns on some of these investments. And then lastly, what does all of this investment mean for the company's margins? I think Intel has been under a lot of pressure recently. We talked to AMD CEO yesterday, Dr. Lisa Su, a very aggressive company out there taking market share from Intel. So I want to see what their long-term margin outlook is, too.
Yeah, all of those good questions, as the market has not necessarily been terribly patient with Intel, right? They want Gelsinger to have made all these investments and be doing all this stuff yesterday. So the timeline for this, I think, is important, but it's going to take time to build all this stuff up. Let's turn to Marriott, shall we? Because that company came out with earnings this morning, fourth quarter numbers beating estimates. We know the hotel business has been recovering. Obviously, Omicron dealt a setback here, but the company's earnings per share coming in ahead of estimates, revenue coming in ahead of estimates as well. You can see the shares are up 3.5%. Revenue per available room, which is a key metric, RevPAR, as they call it for the hotel industry, was up 125% year over year. It's still down, though, 19% from the fourth quarter of 2019. So we have definitely not seen a full recovery in the hotel business, but sort of slow and steady, well, not even steady, slow progress, I guess. There have been a lot of fits and starts here.
Couple things here. Occupancy levels by Marriott's various brands still remain, by and large, under 60%. So there's a lot of potential for them to recover, but also suggests it's going to take some while for business to continue to improve, most notably that business travel. But Julie, I think the reason why the market is trading off these numbers, or what it is trading off of, I should say, they noted new bookings across customer segments have rebounded to pre-Omicron levels. And in this environment, that's a pretty good win.
Yes, well, as we know, the curve of that has come down pretty quickly. So it's perhaps not surprising to see that. We'll see how that materializes into revenue and some of those other figures we're watching in the coming quarters. Let's talk fast food, shall we? QSR is the ticker. Restaurant Brands is the company. Although I have to tell you, when I look this up, my first instinct is always to go RBI, but it's not. It's QSR. The company is trading higher by almost 3% here, by about 3%. Earnings per share coming in ahead of estimates by about a 20-cent margin here. And the company's revenue coming in a little bit ahead of estimates as well. It looks like if you look across the various chains, Tim Hortons comps up 10.3%. Burger King comparable sales up 11.3%. Popeyes, a little womp womp there, down 0.4%. And digital sales for this company have been growing big. They're about 30% of overall sales now, Saz.
Yeah, two things I think the market likes. First is that Tim Hortons number, same-store sales up 10.3% globally. That continues the turnaround at Tim Hortons, which I would say is now officially 3 quarters in the books, or 3 quarters in a row of a turnaround at Tim Hortons. That is very good to see. Next up, Burger King, U.S. sales up 1.8%. Last year, sales fell 3%. Little bit of a comeback quarter for Burger King. Probably will take a few more quarters for CEO Jose Cil to turn that business around. The real number, Julie, I think one should be excited about is Firehouse Subs. Restaurant Brands purchased this company in late November for $1.1 billion. Same-store sales in the U.S., which is now, I believe, close to 1,200 restaurants, but same-store sales in the U.S. for Firehouse Subs up 15.2%. Clearly, Americans are loving all things subs. Unclear what types of subs they're eating, whether they're putting on giant pieces of salami and Swiss cheese. Who cares? I mean, that is a large number and one of the strongest gains in the entire fast food space right now. Shout out to the Firehouse Subs team.
Now I have to ask you, what's your favorite sub, Brian Sozzi?
Well, I go lean, Julie. So if you really want to know, and I think we do have 5 seconds, so I get a sub, a whole wheat sub, I scoop it out to reduce carbs. I go turkey, I go no cheese, I go lettuce, I go tomato and mustard. It's a very low carb, friendly, but again, I get that little taste of bread, which excites me.
Little taste of bread. Nothing like a little taste of bread.
I want to talk about the recession scare. I could talk about the recession scare again, too, if you need me.
I'm quite sure that you could. Okay. We're going to take a break, though, and when we come back, we're going to ask Jared Blickery what his favorite sub is. He's back on the floor of the New York Stock Exchange, and we're going to talk to him in just a moment.
Welcome back. Let's head down to the floor of the New York Stock Exchange. For that is where we will find Yahoo Finance's Jared Blickery. Jared, I haven't said that in a while. Good to see you back down there. What are you watching?
Hey, it's nice to be back down here. So let me just make a few comments. Yeah, the first day back in a couple months, we just had the state lift some various requirements. It allows us to get together in a little bit more confined space as the numbers ebb here. And it's nice to see. We got a lot of people on the floor, lots of pictures being taken. So back to business, finally. Let's talk about the market. S&P 500 kind of rising here. We got a nice surge, nice momentum, nice broad-based sector mix. We got consumer discretionary up over 2%, financials, industrials, tech, all outperforming. So you got the value and the cyclical trade moving up together. That's nice to see. However, we're going into an ideal short zone for some of the short-term shorts, bears in the S&P 500 in the broader market. So first hour of trading on Tuesday, as I like to say, very important to watch to see if there's a trend reversal. But barring that, if we get above 4,500 again, it looks like that breakdown over the last 2 days could be a false breakout. Also taking a keen look at the Bank of America B of A Global Fund Manager Survey. And as you guys were noting earlier, especially Julie, The broadest, least allocation to tech, least overweight since 2006. I think that's very telling about what we've seen in the first 6 or 7 weeks of this year, which has been a very violent pain trade out of tech and into financials and energy. May be overdone. You got to respect Michael Hartnett's team. They do a lot of contrarian work. And if they're saying go long bonds and short commodities, that's going to at least raise a few alarm bells in my hand. So I think tech's never going to get old. We have a lot of earnings still on deck here, so we'll have to see. It's really all about the Fed, isn't it? It's about interest rates. It's about the inflation outlook. We got some heavy numbers this morning, but I have to think, and I've been saying this for a couple of weeks, we're either at or near close to peak Fed hawkishness. So any kind of dial back going to be a nice surprise for the markets, but we have to get through some economic reports, not the least of which is another CPI print before that next critical Fed meeting, guys.
So great to have you as our resident market whisperer, Jared Blickery. Good luck down there. We'll check back with you later. All right, Julie, we're also watching shares of Activision Blizzard on Warren Buffett disclosure here via 13F, of course, and Berkshire Hathaway, that he bought $1 billion worth of the company's stock ahead of the Microsoft deal. Pretty interesting stuff.
It is, and we're talking about 14.7 million shares, almost 14.7 million shares of Activision Blizzard. Now, our various caveats come with the 13F filings. So the 13F filings are the filings that various fund managers are required to do if they hold a position that's worth at least $100 million. And it's a snapshot, right? So it's as of, in this case, December 31st, what those holdings were. For someone like Warren Buffett and Berkshire Hathaway, we can usually assume that they still hold that position because that's Berkshire's playbook, right? It's a buy and hold kind of shop. It's not a very rapid trading shop. That's not necessarily the assumption with everywhere, but that's the assumption I think we can safely make here. And what's interesting to your point is the timing of this holding, taking that Activision Blizzard stake ahead of the announcement of the agreed upon deal with Microsoft. Obviously, it was a very fortuitous move for them to make. It also could have been that Buffett was just looking at what Activision Blizzard had been doing, which was not great in terms of the stock performance, and beset by a number of allegations of harassment inside the company. And so maybe he saw some value there. By the way, we don't actually, I keep saying Buffett because we tend to consider Berkshire and Buffett to be synonymous, but we don't know if he himself made this decision or it's one of his two investment managers, Todd Combs or Ted Wexler, that made these decisions. Nonetheless, it's an intriguing one.
Yeah, well, you'll also make the case, Julie, one, that he was looking for value, as you would suggest. You had Activision Blizzard shares about $104 in February of 2021. That went down to $57 by the end of November. So he could be shopping around for deep value. And then secondarily, what is interesting is you've seen Buffett, and may not be Buffett to your point, but still Berkshire Hathaway dip its toes increasingly into tech, of course. You have that Apple holding, but here's a company that I believe still holds shares of Snowflake and now Activision Blizzard, another tech company.
Yeah, and one of the other 13F filing items, there are so many to sift through. We could just talk about it for the whole show. But one other one that caught my eye, David Einhorn over at Greenlight Capital. I admit, have not watched as closely recently, but a new short bet against Tesla. And he sort of has gone back and forth on Tesla over the past couple of years, but apparently he bought puts against 100,000 Tesla shares, according to that 13F filing. He has shorted Tesla in the past, most recently in 2020. That did not work out well at that time. And by the way, we don't know if he's closed out. To my point about this being a snapshot, we don't know if he's closed out this particular short position. If he has, he might very well have made money because Tesla shares have fallen thus far in 2022, but we don't yet know that situation. In the past, at the end of 2022, even though Einhorn lost money by shorting Tesla, he said that owning Tesla stock was a fad and that the stock price was silly. It continued to go up from there before this most recent pullback, Sus.
Yeah, for me, Julie, I'll just quickly add too. I think some of these short sellers that a lot of folks fanboyed and fangirled over during the financial crisis, like a David Einhorn, I'll toss Jim Chanos into the mix too as well. They've lost their luster, in large part because of the market's continued rise over the past decade, but certainly respect the research they put behind their calls. All right, switching gears here. With inflation rampant and rates set to rise, Many traders are taking their cues right now from the bond market. We'll dive into the space next.
We continue to see rates push higher here this morning. That was even before we got the PPI data that came out hotter than estimated. We were continuing to see that 10-year yield above 2%. But at the same time, we've got the yield curve flattening. What does that do to the Fed's ability to raise rates? Let's bring in Chip Huey, Truist Wealth Managing Director of Fixed Income. Chip, thanks for being here. So, as I say, we've got the yield on the 10-year rising, but we've got the yield curve flattening. It's still at around, 40 basis points. So it's definitely not zero, but it's been heading down gradually. So talk to us about the interplay between that and the Fed raising rates.
Yeah, thank you so much. Thank you, Julie and Brian, for having me today. I think that what you're hitting on is a really important point. It's a critical component of the curve that we're watching between the 2 and 10-year. Like you said, it's floating between 40 to 45 basis points. That's at this part of the expansion. That's a pretty flat curve. So one of the reasons that we think the Fed is going to be forced to be a little bit slower on the rate hike side of the equation is because the trajectory of the yield curve is going to limit their ability to raise rates at the most hawkish forecast that we're seeing, right? It's just escalating every day, 6, 7 rate hikes in 22, 50 basis point hikes throughout. So we think it's going to force them to be a little bit more cautious.
Chip, and I don't want to make this too complicated, but the Fed is shrinking its balance sheet. What do you think the impact will be to the fixed income markets of that? And do you think the equities markets have already priced that in?
Yeah, I think it's going to be one of the things that we sort of foresee is if the Fed is slower on the rate hike side, it's because they're going to take a multifaceted approach and they're going to lean more on balance sheet machinations and reductions in order to encourage higher intermediate and long yields and therefore kind of support this idea of a healthier yield curve. You would like to see the yield curve steepen, and we were getting a little bit of steepening to start the day this morning following the PPI report, which is frankly, good. That's good to see from a yield curve perspective. As far as have markets priced that in? We do think that yields are going to rise further from where they are today. I think that what you could see is obviously some leadership on the equity side continue to change more on the value side on those shorter duration equity assets.
Chip, where do you guys sit on this whole debate over whether the Fed is going to move by 50 basis points at the March meeting?
Yeah, it's a great question. I think that we're going to get some pretty good insight tomorrow with the FOMC minutes. We're going to kind of get a feel for that sense of urgency, that the Fed, may be feeling. I think that because we are at this sort of fever pitch, Jared mentioned to you about the inflation and Fed expectations, that fever pitch that we're feeling. It probably gives the Fed, the ability to execute a smoother 25 basis point rate hike, right? One of those more traditional rate hikes, and that would be a positive. I think the markets would digest that very positively. It would send a message too from the Fed that they don't fear that they've lost, control of inflation, and that they can take this more measured approach that we ultimately think we're going to see in 2022 relative to these really hawkish expectations.
Is there a trade right now in fixed income, Chip, that you and your team really like?
There's a few. Yeah, we still like U.S. credit, particularly high yield. We like its shorter, shorter duration, and also we still are positive, on the U.S. economy. Just because we've moved past, peak growth doesn't mean we're moving into a period of weak growth, and that tends to be a really good thing for places like high yield. Leveraged loans, for instance, a little bit more credit risk in that space, but very low duration, nice incremental yield characteristics as well, and also benefit from that upward pressure that's being applied by the Fed's plans to raise rates. And for those that are looking for a higher quality trade, perhaps a bit sheltered from a continued rise in rates, high-grade municipal bonds continue, or more recently, are showing a much more value. They came into 2022 very expensive, and the volatility that was injected into markets actually has created an opportunity that has restored some of the value in the investment-grade municipal bond space.
Interesting. All right, Chip. Good to catch up with you. Chip Huey, Truist Wealth Managing Director of Fixed Income. Thanks for being here. Appreciate it. We are going to take a break. When we come back, merger talks between Monster Beverage and Constellation Brands are reportedly brewing. We're going to have more details coming up. Well, this report this morning could be great news for Brian Sozzi. Some sort of alcoholic energy drink. I mean, there are some in the market already, but maybe this is a match made in heaven. I don't know. Monster Beverage and Constellation Brands are reportedly in a talk about a combination. Brian Sozzi, what do you make of this?
Yeah, sometimes, Julie, the planets just align and you potentially get amazing products like this with 300 milligrams of caffeine, maybe some CBD in it, maybe a little alcohol, who knows? But this is a continuing story, I would say, or continuing coverage. This chatter of this potential tie-up really broke a couple of weeks ago. I believe today, Julie, was the Journal in Bloomberg reporting on this one, but I'll just take through this here. Here's the chatter. Constellation could be looking to buy Monster Beverage or form a merger of equals. The deal, any transaction won't be cheap. Keep in mind, Monster's market cap is about $45 billion. And then the strategic rationale is here, which I think you perfectly captured in your tease, Julie. Alcoholic energy drinks plus cannabis drinks all in one house. Distribute all these drinks on very large trucks sucking diesel power, and then you could really have some pretty good quarters. Now, here is why a deal may not happen. And a lot of good insight here, of course, comes to me from Guggenheim beverage analyst Laurent Grandet, been covering the space for a long time. It says Monster is already distributed by Coca-Cola. That is correct. Coca-Cola started distributing Monster beverages in 2014, also took a stake in the company. So may not make a lot of sense for Constellation and Monster to tie up. Next, Monster just bought an alcohol company, $330 million a couple of weeks ago to buy an alcohol company, which at the time signaled perhaps there was no need for Constellation to get involved in here. And last but not least, you have Monster co-founders. They could be reluctant to sell, especially Rodney Sachs. He's the company. He purchased the holding company Hansen Natural, I believe, back in 1990, and he pretty much still controls the company. And he has no apparent successor. So he could be some reluctance here to sell out to a larger company. Overall, here's my take, and it's pretty simple. Do it. It's the future. Let's get all of these drinks. Stop signing partnerships deals like we've seen with PepsiCo and Sam Adams. Get all these drinks under one house, put them all in a truck, save some oil, save some diesel gas, get them all to the stores in one thing, create lots of innovation. It's very exciting. And then while we're creating deals here, Julie, it makes a lot of sense for Coca-Cola to finally get over its own internal issues and start making snacks. Go out there and buy Utz, get snacks with Coca-Cola. It has worked well for Pepsi. Time for Coca-Cola to get off its rear end.
This is a broad-ranging take today, Brian Sozzi. You're just piling it all in there. You're piling it all in there. I mean, it also makes sense for diversification purposes, right? When beer isn't working, you have wine at Constellation. But if beer and wine aren't working, you got energy drinks. You have that, which happens, right? You get those waxing and waning of the different types of drinks. So maybe that's a benefit as well, besides your own personal interest in what kind of product innovation there's going to be.
I'm all for a Monster drink. Sign me up. Monster drink with a little alcohol in it. I'm the guy for it. I'm the target customer.
I know it. All right, before we take you to break, I just want to check on one other stock that's on the move. Maybe this one's for you too, Brian Sozzi. I don't know. You have a Monster Energy alcoholic drink. I don't know. Then you go into space.
Great, perfect.
Literally, not figuratively, literally.
Love it.
So Virgin Galactic is reportedly going to open up reservations to go to space. You can make an initial deposit of $150,000. Ticket sales open tomorrow, so make sure you're lined up there. And reservations that you put down your $150,000 deposit, and then the total cost will be $450,000. What do you get? You get a 90-minute space flight, which includes, quote, several minutes of out-of-seat weightlessness. And it looks like that they are going to sign up 1,000 customers to start commercial service later this year. So the shares are taking flight as well this morning. They're up.
Julie,
by
real quick.
Yes, sir.
I got an idea. For $10, you can go to the local amusement park and hit up the Gravitron, and you can fly off the seat there. Save your $150,000.
Okay, it's a date. We'll do that this weekend. All right, we're going to take a break. When we come back, we got you covered on all of the market action on this Wednesday morning. You see, we got stocks pretty much at the highs of this young session. We'll be right back.
Welcome back to Yahoo Finance Live on this Tuesday morning. I'm Brian Sozzi alongside Julie Hyman. Lots to cover over the next hour. We have to start with these volatile markets. We are seeing major indices bounce back from the drubbings they saw on Friday and yesterday as traders eye some minor positives on the Russia and Ukraine front. And we're seeing all three major indices in the green. Leading the charge right now is the NASDAQ, continuing a little bit of a relative outperformance from yesterday's session. Now, here are some other things we are watching for you at this moment. The bears lurk. Investors are bearish, but not extremely bearish, according to a new survey of fund managers from Bank of America. Fund managers are the most underweight tech stocks, I should say, since August 2006, in large part reflecting fears of rising interest rates. And doing deals. Intel said today it will spend $5.4 billion to buy Israeli-based chipmaker Tower Semiconductor. The deal is expected to boost Intel's efforts to make chips for other companies, a key focus by Intel CEO Pat Gelsinger. And going in on crypto, media outfit Forbes has secured a $200 million investment from crypto platform Binance. We'll dive into the deal with Forbes CEO Mike Federle. And speaking of crypto, BlockFi has agreed in a settlement with the SEC to pay a $100 million penalty for hawking its crypto lending product without registering it as a security. Yahoo Finance crypto reporter Jennifer Schonberger has been covering this for us. Jen, take it away.
Good morning, Brian. That's right. The Securities and Exchange Commission Monday settled with BlockFi Lending over its crypto lending product, underscoring how the SEC is looking to regulate crypto firms through enforcement action. The SEC accused BlockFi of selling unregistered securities, operating as an unregistered investment company, and making, quote, material false and misleading statements on its website, while levying a $100 million fine in conjunction with 32 other states. Now, this marked the first kind of action against crypto lending, setting an example for the industry to proactively file lest they get slapped with similar enforcement action. SEC Chair Gary Gensler has repeatedly warned cryptocurrency firms to register with the commission to avoid enforcement action, and SEC officials encouraged others to view this case as a roadmap for future cases, noting that it lays out a pathway for how other crypto platforms should register proactively and self-report violations. Now, while Gensler has repeatedly referred to crypto as a wild, wild west, there are no formal rules on the SEC's docket for regulating cryptocurrencies this year. And SEC Commissioner Hester Peirce told me in an interview she thinks that the SEC will regulate crypto this year through enforcement action rather than new rules. Take a listen.
I think that that's the discouraging piece of it, that we're leading a lot of these charges through enforcement instead of taking the approach of using our rule book, our existing rule book, and our existing statutory authority, which tells us that we can make adjustments to the rules to accommodate new things and different things. So we should be working on creating that kind of a framework that works. But I just don't see it on the horizon based on what's in the regulatory agenda. And that leads me to fear that a lot of this work is going to be done through enforcement, which is not the right way to go about writing rules.
Now, the SEC is reviewing a proposal that would seek to expand the definition of an exchange that some, including Commissioner Peirce, see as a backdoor way to regulating crypto exchanges, though that proposal is still in a comment period now. So it appears that the onus is very much still on the industry to self-report. Guys?
All right, Jen, hang with us. I want to welcome in Sheila Warren, who's the new CEO of the Crypto Council for Innovation. Sheila, good to see you here, and congrats on the new position. You just heard Jen talking about this settlement here. How do you think this will help shape future crypto regulation?
Well, I want to spotlight, I think, what Commissioner Peirce was saying to Jen, which is that we are seeing a lot of lead by enforcement going on here. In this case, there was a very specific response that was taken with BlockFi. And I got to be honest, I don't really see those particulars being something that extends across the entire industry. So that really is where BlockFi wound up. But BlockFi was already in a particular place with particular kinds of centralization model that it was using that doesn't really apply to a lot of decentralized exchanges. So I think it's a little bit of a one-off in a way, and I don't necessarily see it as something that portends what's coming for the rest of all the exchanges in this space.
Hey there, Jennifer here. I'm curious to see what your reaction is from the industry standpoint, because SEC officials and Chair Gensler have been very fervent that crypto exchanges need to come in. They need to register proactively with the SEC. And it seems that officials were really trying to use this as an example to get firms to come in and register. Do you see that happening? How do you see the industry responding overall to this action?
So again, I think the industry is open to doing what clearly needs to be done. And I think, again, as Commissioner Peirce noted, it's not clear what needs to be done. I don't really see the BlockFi settlement as changing that reality. There are just aspects of the way that BlockFi operates that differ. It's not a pro or con. There's just different ways that these things run and operate, and not everything about the BlockFi parameters applies across the entire industry. So I think you've got an industry that is ready, if not eager, to understand the rules of the road, but is also very eager and standing very firm on the fact that rules that operate and made sense in a previous environment, or you could argue the current environment, don't really make sense in this new world of decentralized exchanges. They're just things that are important and interesting to preserve in the way that open permissionless protocols run, in the way that DeFi operates, that would be lost if we treated it like something that has come before. So I see this as, again, a very targeted response to a particular situation. I think it does indicate, and I do take it as the SEC saying, look, we're going to come almost, if we have to go case by case, maybe we will. If that means we're going enforcement action by enforcement action, maybe that's what's coming for us. My hope, echoing again Commissioner Peirce, is that that will not be the approach that's taken, that ultimately there will be something that is a more productive collaboration with industry around what the response ought to look like and how we can ensure that this activity is safe for consumers, because that's, of course, what everybody wants at the end of the day.
Sheila, it's Julie here. So what is your top priority at the council in terms of policy? What do you think is most urgent to get done now from a policy and regulatory perspective?
You know, it's such a great question, Julie, but it's really fundamentally education. And I don't mean to be punting, but there's so much misunderstanding. And the concern, I think, is that we are going to see either this piecemeal, backdoor regulation that we're seeing in the examples we've been talking about through these enforcements, or we're going to see something that is regulating the wrong thing. It's imagining that crypto is something that it really isn't, or it's imagining that crypto doesn't have the potential to be what those of us in the industry understand it can be. And so I would say it's really still just education to make sure that we are engaging in evidence-based advocacy to policymakers and regulators all around the world, so that when they do create these different rules of the road, they're doing so coming from a very informed position.
Sheila, you mentioned backdoor methods to regulating crypto, and certainly a number of folks have seen the current SEC proposal on the table with ATS that basically expands the definition of what an exchange could constitute as a backdoor way to regulate crypto. Your thoughts on that and where you see that proposal going?
Well, I think it's interesting, that proposal, because it's getting all kinds of fire from well beyond the crypto industry, right? It's really drawing flack from a lot of different places because it has implications beyond crypto. But from the crypto industry perspective, I think that, yes, I think we do see it that way. We do see it as Commissioner Peirce, I think, warned all of us that it is something that is opening a door. I don't know that it goes directly at this, but it's opening a door to kind of bring in through this, I would argue, this kind of backdoor way, a lot of different kinds of entities that maybe really ought not to be regulated in such a fashion and should be regulated more directly in a way that, again, acknowledges the innovation and benefits that they're bringing to the table. I think there's a reason that DeFi has emerged and blown up and gotten the traction it's gotten. And we need to kind of honor that and recognize that something was missing that now exists. So how do we make sure that we're looking at that thing and we're not killing that, what's exciting about it, killing the innovation in an attempt to bring it under the fold of something that, again, that's better understood. So I think that the ATS, this is going to get a lot of response from a lot of places, including from us. And we will stand together as an industry to just say, look, this is not the way to do this, right? That there's a better way of going about crafting the policy that is going to be protective of consumers, et cetera, and all these goals that I think are laudable and admirable goals. But let's do this in concert. Let's do it, again, recognizing where the innovation is providing benefits.
Sheila, there's an interesting conundrum that has sort of been, or paradox has been called out in the crypto industry to some extent. And that is the idea that this is DeFi, right? It's a very decentralized industry. And yet here you're at a lobbying body that's effectively backed by a couple of powerful firms. And that is something that's been called out, I feel, in the crypto world. So how do you sort of think about that this is something where everyone is supposed to have a stake, and yet it's still running through some pretty powerful players who are controlling a majority of it?
Well, I'd push back pretty hard on that last point, but let me start by saying I hope that there's widespread recognition across the industry, and I think this is the case, that we really need all the talent and firepower we can bring to the table. We're in a very particular moment right now where the policies that are made around the world, not just here in the US and not just with the SEC, right, are going to shape the enabling environment and really determine the trajectory of this technology. Is it something that's going to thrive in a decentralized fashion, or is it something that's going to be captured and controlled and really forced to resemble legacy systems that really have not been serving a lot of people? Are we going to remain in kind of an exclusionary environment where only folks that have certain kinds of identification or have certain kinds of economic privilege can actually access financial services that will help them grow their wealth and better their lives? And I certainly think that's something we all would agree is not what we want to see. We want to see more people have more access to more services that can serve them and their families and communities. In terms of who's behind what, I think that there's a lot of value in having different players coming from different sides of the table that are all speaking the same message, which is, crypto's here to stay. It's really important. It's a tool of empowerment. And then to kind of your last point that you made, I don't agree with that. I do think there's a difference between who might be deriving economic benefit and who's in control. Those are not the same thing, and it's important to recognize that. So here, I think that there's been a lot of support of decentralization as a concept in terms of who's got governance, who's actually making the decisions that are furthering different projects. And that remains very decentralized in our ecosystem, which is something that we want to see preserved here at CCI. And I would also speak on behalf of my members in stating that as well.
And you talking about stakeholders and sort of spreading around the economic benefit brings up another question, which is, you're not only a woman, you're a woman of color who's in a leadership position now in the industry. And pick an industry where it's rare, unfortunately, and crypto is one of them, right? So how do you, we've been talking increasingly to women in the industry, but less so women of color. And so how do you think that needs to be worked on? I mean, again, pick an industry, but within crypto specifically.
Well, I would again pick an industry, right? It's kind of a sad reality today. I would say that the premise of crypto is one of inclusion. It's why I'm in this space, and I think part of being a woman of color, part of being a mother, part of being a lot of things that are a little unusual, I think, in leadership positions in any industry, to be very visible with those kinds of qualities and personal circumstances. It brings a lot, I think, to the table, and I think that we need to be amplifying voices around the world of people who are engaging with crypto in different ways, who are not really focusing on speculation as a use case, who are really looking at how this is bettering their communities and their lives. I think for me, I spent a lot of time abroad in my life, a lot of time in India, a lot of time working with communities of color, whether that's organizing or advocacy on a variety of different topics. And so I've seen firsthand really how empowering a technology like this can be, and how empowering these opportunities can be, not just at an individual level, but at a family level and at a community level. And it's something that I take very seriously as a responsibility to keep talking about that, and to make sure we're surfacing these concepts that we're not just building something here to help a small percentage of people make a lot of money. We're building a tool here. We're building a system that is really going to provide, again, as I noted, this more inclusive environment, help empower women, help empower people of color, help empower historically underserved communities that have not been given access to legacy systems in ways that are meaningful, or have had to go through massive hurdles and barriers to really do the basic things like get a loan, get a mortgage, whatever it might be. So I think we need more and more of those voices everywhere, but certainly in crypto, because here, unlike many industries, we are literally building something that is, I believe, going to be a very critical tool for how we empower these communities, how we level the playing field, and create more inclusion. And so to me, surfacing those voices is only going to help make that case and help people understand that there's a lot more here than what maybe you're hearing traditionally in the media, or maybe what you're reading, somewhere on Twitter or something like that. It's a much different pool of people that are working really hard.
Real good discussion here. Sheila Warren, the new CEO of the Crypto Council for Innovation. Good to see you, and thanks so much to Yahoo Finance's Jed Schomburger. All right, here's your Yahoo Finance stat of the day, $25.3 billion. That is how much market value Moderna has shed so far this year as analysts fret about the vaccine maker's product pipeline, or looked at another way, Moderna's stock has crashed about 45% year to date. Really striking sell-off here in Moderna. All right, straight ahead, Levi's is taking a lot of heat for reportedly a top exec for speaking out against COVID-19 school closures. More on this coming up.
U.S. authorities have launched a probe into block trading on Wall Street. Major banks like Morgan Stanley and Goldman Sachs are reportedly being investigated by the Securities and Exchange Commission and the Department of Justice about whether they tipped off favored clients ahead of large share sales. Regulators have been looking into irregularities around block trade since 2018. Last year, there were nearly $70 billion worth of this type of trade on Wall Street. Tesla CEO Elon Musk donated about $5.7 billion worth of Tesla shares to an undisclosed charity last year. That's according to an SEC filing. This took place over the course of a week in November during that 2-month span when Musk sold more than $16 billion worth of Tesla shares. The donation could help reduce Musk's personal tax bill, which he has said would be $11 billion for 2021. Meanwhile, Tesla itself had a tax bill of $0 for last year. Texas Attorney General Ken Paxton filed a privacy lawsuit against Facebook parent Meta Platforms over its data collection. Paxton said the company collected facial recognition data without clear permission of users. That violates a Texas consumer protection law. He said the company also shared the data with third parties and did not destroy the gathered information in a reasonable time. And another story we are watching as we continue to watch the interconnection of free speech and COVID and the workplace of the future. There is an executive at Levi who has left the company over what she said was her outspokenness regarding whether schools should be open or not in this environment. Brian, you've got the details on all of this.
Yeah, a new blog post by the now former head of the Levi's brand, Jennifer saying that she left the company and left $1 million severance on the table here. That, just according to the post that she had on Substack, that she was forced out of the company because of her views on COVID-19 related school closures out in California here. Very much a developing situation here. I should note that Levi's comms chief Ansel Martinez did not return my email for request or comment on this one. But again, a very worrying situation for a company, Julie, that has done pretty well throughout the pandemic. Just looking at it from a pure business standpoint, Levi's brand has done very, very well the past few years, and in large part, it has been because of Jennifer Say's leadership at the company. So just from that standpoint here, is not necessarily a good look here if you are a Levi's shareholder here, that you're losing the head of this Levi's business. But also, what was further revealed in this Substack post, Julie, was that CEO Chip Bergh, the CEO of Levi's, Chip Bergh, potentially signaled that she was the successor to him as CEO. So, of course, you don't want to see an executive of that caliber leave the company.
I would just, I don't know if I would quibble, but I would say we don't really have enough information here as of yet. I really would love to get that statement from the company and hear what their perspective is on all of this, because for now, what she's saying in her blog post remains as it stands. And as you say, perhaps there are some worrying implications there, but we don't know, what the company's perspective on it is. So hopefully they'll get back to us.
Yeah, no, and I'll just add too, in this post, it's noted that Bergh met with Say in the fall of last year to suggest that she was in the lead spot to take over Levi's as CEO. And again, just looking at it from a pure business standpoint, Chip Bergh, he's taking on a lot of heat and related to this situation here, but still his leadership of Levi's the past 5, 6, 7 years has been one of the strongest stories here in retail. He came in there, he really turned the company around. And so even to get a signal that he is eyeing perhaps another chapter in his own life, is he only CEO for the next year, is something to be on the lookout for as well.
Right. And there had been no other indications of that in other conference calls, investor days, et cetera, correct?
Correct.
Okay, so that's something to watch as well. All right, we're going to take a quick break. When we come back, Binance is investing $200 million in Forbes as that company makes the transition to public life. Forbes CEO Mike Federle is going to join us with the details next.
Forbes has secured a $200 million investment from crypto platform Binance. The investment comes as Forbes eyes public markets in the first quarter via a SPAC transaction. Joining us now is Forbes CEO Mike Federle. Mike, good to see you again here. Big transaction for Forbes. Why are you making this deal?
Yeah, well, good to see you too, Brian. It's part of our belief. You know, Forbes from the beginning has always been about giving people the knowledge, the resource, the inspiration, the connections they need to achieve success. And what's going on with digital assets, I call it beyond crypto, you know, with crypto, NFTs, blockchain technologies, the metaverse coming on. We want very much to be the guide to or the bridge to understanding as this comes on and starts to make even bigger impacts on society and business.
Hey, Mike, it's Julie here. I think it's undeniable, right? The interest that we are seeing in crypto broadly in society. We've certainly talked about it a lot. I have to ask, though, about the defamation lawsuit from Binance against Forbes a couple of years ago after you guys published some stories that were critical of the company. So how do you go from that to then this business relationship? And have you guys sort of addressed that directly?
Yeah, so they withdrew that lawsuit rather quickly, I think, recognizing the error of it. But, you know, going forward, it was a great demonstration of the importance of editorial independence. And that is a cornerstone of Forbes' brand. And any investor coming into, making an investment in Forbes knows that impinging upon that editorial, the journalism or the crossing that line is going to be a negative effect on their investment. So in some ways, it's actually strengthened an understanding of media from Binance and from the industry. But more than that, I think, again, we're going to continue to write stories that are pro and con from different points of view based on what we believe. So in the end, I think that was actually a sign of strength going forward.
And certainly there are a lot of various journalistic institutions that are owned by stakeholders who would have an interest in pushing coverage one way or the other. So to your point about journalistic independence, talk to me about the firewalls or what is sort of written into this deal to ensure that you guys are going to retain that independence.
Well, you know, I've gone through a lot of large investors, mergers, acquisitions over my career. And there have been various ways to deal with kind of creating defenses on the wall. I actually don't think any of those are necessary myself, in that it's a black and white situation and very clear as to editorial independence is the cornerstone of the value of the brand. And anyone coming into that, anyone, again, making that investment or anyone looking at acquisitions has to recognize that, you know, doing anything to damage that or to try to influence that negatively is going to be a negative effect on their investment. So for me, it's a simple problem that, or a simple thing that doesn't really exist. We know it's not going to happen on my watch. It's not going to happen on Randall Lane or managing editor's watch, and it hasn't happened for 104 years. So we feel confident that there's no problem there.
Mike, how do you plan to use this money?
Well, the money is part of the overall de-SPAC, so and the SPAC process. So what we did, we've already used it, I should say, in the sense of we've traded out, when we first went out to raise the pipe on this SPAC, we had a target of about 175 million, and it was so oversubscribed, we capped it out at 400 million. What this investment does is allow us to actually take out some of the institutional investors in the original 400 million, strengthening it with the 200 million from a very strategic investor. And that's how we look at Binance, as a very much strategic investor in achieving that kind of bridge I was talking about in terms of understanding and demystifying crypto and digital assets.
Lastly, Mike, too, there was it's my understanding that a competing firm, GSV, has stepped up here with an offer of pretty close to the valuation of the company, with $620 million. Have you heard from them recently, and do you still see yourself being a public company in the first quarter?
Yeah, we're very much on track as a public company. I know the GSV guys very well. They're all friends, and it's all part of Forbes. Has had many, many different people, companies from around the world and interests from around the world about investing in Forbes, buying Forbes outright. We've chosen to go public via SPAC, in that it leaves us with the most cash to do the things that we want to do to really grow the enterprise, as we say, from, to grow our business, which is relatively small compared to the giant outsized brand that is Forbes. So it leaves us with cash to do that, as well as no debt in the deal. So we chose this route, and we're on track to close the deal by the end of the first quarter.
Mike, as you know, the SPAC environment has gotten tougher, and the other well-known media company that's recently come public through a SPAC is BuzzFeed. We see the stock chart there. It has not been a pretty story there in terms of how it's reacted. Now, in terms of the SPAC that you guys are merging with, which is Magnum Opus, it's trading a little under $10. I'm just curious, given that environment, how you're thinking about when you guys are going public, whether you need to brace yourself a little bit for that public market life.
Well, there's no doubt I have to brace myself for public market life. And SPACs, yes. I mean, it's no mystery that SPACs been going, people have been questioning SPACs. But I will tell you, we have some really strong indicators that, we're very different than BuzzFeed, and you just need to look at both the underlying financials, which can all be found in the proxy statement, as well as our restatement of forecasts that we did in the third quarter. We are a very solid business right now. Significant revenue growth in the top line and big, EBITDA growth on the bottom line. So we're already delivering a very good business, and the possibilities of growth in there, a lot of investors have seen. And now adding Binance as well, I think, is a big boost, and a good indicator of that is, in our analyst day next week, we've got over 30 analysts signed up, which is a really terrific number for a micro cap coming out in the market for the first time. So there's a lot of momentum, a lot of buzz around it, and the markets will be the markets in the end, and we'll work with those as we see where the stock goes.
Well, good luck at that analyst day. We await your first day of public company life. Forbes CEO Mike Fairley, good to see you as always. All right, we'll be right back with Yahoo Finance senior columnist Rick Newman, who has a hot take: stock trading by government officials. Stay tuned.
idea of somehow regulating or even banning stock trading on the part of members of Congress is gaining traction among members of Congress after they got some pressure from constituents. Our Rick Newman has been following all this. And Rick, the question now is, how do you do it, right? What does this regulation look like? Do you ban it entirely? Do you just put curbs on it? And you've got some ideas.
Right. There are a couple different ways of thinking about it. The most popular way, if you can say popular, is to put all these investments into blind trusts that would be managed by an outside person. So the member of Congress, and this would probably apply to staffers as well, would never know what trades are happening. And I think there are some legitimate problems with that. Nancy Pelosi, to my mind, does have a point when she says it's a free market economy and members of Congress ought to be able to participate in that free market economy. So another way you could approach this is to ban the trading of individual company stocks, but allow members of Congress to trade ETFs and mutual funds. So they'd be able to basically take part in market action, make bets on what's going to go up and what's going to go down, but it would not be company by company. So I don't think that's a perfect solution, but I don't think there is any perfect solution. And if you sort of take away the ability to make bets on individual companies, that would eliminate a lot of the concern here. And the concern is that members of Congress know things about regulatory matters or policy changes that might affect individual companies and let them turn a profit on that insider information. And we have seen some examples of that. So if you limit it to funds, at least you're taking away the ability to play on what you know about any given company.
Rick, as I said, this is sort of gaining some traction, right? Pelosi has expressed some support for doing something like this. Chuck Schumer has as well. But what's the timeline? Is this actually happening in the short term?
Well, the timeline is we have an election coming up in November, and Americans, as usual, are disgusted with Congress. That's what's driving this, without a doubt. So both parties are now trying to cash in on voter disgust with elected officials and try to get something done by the November election so that they can be the party that says, look, we're cleaning up government. Please reward us when you vote in November. I think if nothing happens by the time of the midterms, I think this is going to go away until perhaps the next election cycle coming in 2024 when we could see it again. So as much as anybody might want to think that these members of Congress really have the public interest at heart, this is just about politics and trying to burnish your image before voters go to the polls to decide on your fate.
All right. Well, so we'll catch up with you again, see if we can get it done before this midterms. Rick Newman, Thanks so much for keeping us up to speed on all of this. Coming up next, we will catch up with one of the largest African-American managed banks in the United States. That is Carver Federal Savings Bank. Stay with us.
Investors are so fixated on the impact of banks from rising interest rates, they perhaps are overlooking key trends the banks are seeing on the ground in their own local communities. Some of those trends include higher wages, rising food inflation, and of course, expensive housing. Let's talk more about all this with Carver Federal Savings Bank President and CEO Michael Pugh. Michael, always nice to get some time with you. To that end, what are you hearing within the communities your banks serve with regards to all these economic issues?
Yeah, so good morning. It's good to see you again, Brian. I think, within our communities, one of the key things that many of our small businesses are thinking about is access to capital, tools, and resources that will help them reshape their businesses. For the communities that we serve, largely have been populated by minorities. And so if you think about Black and Brown communities, what we know is that a significant number of our small businesses within the African-American communities were at the brink of closing their doors, specifically small businesses, and closing their doors because of being hit by the pandemic. So we have been spending a significant amount of time trying to help those businesses reimagine and to get the access to capital, the tools that they need in order to remain strong and survive.
Michael, it's Julie here. I want to ask you to expand on that a little bit. You guys are also designated as a community development financial institution, and you and your peers have really served an essential role in communities during this pandemic period. What has the situation been like in terms of getting PPP and other types of government funds to businesses that need it? And do you think that there has been sort of more friction or more trouble getting those funds into minority communities?
Yeah, I think it was certainly in the beginning stages of the CARES Act and the Paycheck Protection Program. The beginning stages presented some real challenges for getting the funds out there to the true small businesses. We know that the Small Business Administration defines small businesses as ones that have 500 or less employees. But what we often see is that many of the small businesses within our communities, again, here in Greater New York City, have less than 50 employees. And so those businesses, in many cases, don't have the technical resources, the tools needed. They don't have an accountant on staff or an attorney on staff to help them navigate through, a significant amount of paperwork. And so in the first tranches of the Paycheck Protection Program, many of those businesses did not get their applications submitted in a timely basis and able to participate. We were fortunate to be financial first responders and work very closely with small businesses, hand-holding them through the process. And just for our bank, which again has been here very hyper-local focused in Greater New York City, we were very proud to be able to provide more than $50 million in access to capital to small businesses. But one of the other metrics that we frankly looked at and we felt very proud of is that more than 5,000 jobs were preserved by providing that access to capital. I think the key thing that small businesses have learned is that it is important to have relationships with community banks because there's certainly a lot more accessibility to decision makers. And I think the key thing that the community at large has continued to focus on is thinking broadly about tools, resources that will ultimately help these small businesses thrive.
And of course, the pandemic, now in this phase, inflation is a big, big issue for small businesses and large businesses for that matter. And so those resources and tools that you talk about, what is necessary right now, both from the bank itself to serve the community and also from the federal government, whether you think there is more aid that is needed to flow through to these small businesses?
Yeah. Well, capital continues to be one of the most important things for small businesses. Getting access to capital through various programs that will allow them to further build the tools, the resources that they need, whether it's new equipment or frankly, hiring talent that will further support their businesses. But we know that capital remains king or queen when we think about small businesses and supporting them. I think also workforce development will remain a very important part, helping to provide tools, resources that will allow small businesses to efficiently train and develop staff that will remain critical. And then, one really important thing is helping small businesses develop stronger business plans and strategies that will ultimately lead to their growth and sustainability. We implemented a program that has been very effective in terms of supporting small businesses on the financial education side. We've been proud to say that we've educated more than 16,000 people through financial education workshops and programs. But specifically for small businesses, the programs that we've really tried to hone in on is helping them walk through business plans, marketing plans, and thinking broadly about how they reach their customers in a digital age. And so I think more work is certainly needed, and we'll continue the journey there.
Good to always get some time with you. Carver Federal Savings Bank President and CEO Michael Pugh, good to see you. We'll talk to you soon. And we will be right back.
Well, we earlier in the show covered the story that an executive at Levi's has stepped down over what she said was her outspokenness on opening schools in San Francisco amidst the pandemic. That is Jennifer Sey. She published a blog post about it. And Brian Sozzi, you've now gotten a little bit of information from the company.
Yeah, Levi's sending a couple statements to Yahoo Finance first. Levi's saying that they replaced Jen Sey, who resigned from the company. So taking Jen Sey's place on an interim basis is Seth Ellison, the executive vice president and chief commercial officer. Levi's adding that they have begun a search for a new full-time president of the Levi's brand. So that's the first thing. Again, Levi's saying that Chen Sei resigned from the company. And then at last, we asked Levi's if there is a vaccine mandate inside the company. They said to us, quote, "We strongly encourage employees to receive COVID-19 vaccinations." So to me, Julia, it doesn't sound like they have that mandate, but still Levi's responding to Yahoo Finance.
Yeah, so we'll keep on this this discussion, see if we can get any more information about what exactly went on here. You know, and why is there such focus on this? Obviously, there is a big sort of free speech debate, and obviously the coronavirus and everything associated with it has become a flashpoint. So going to continue to focus and report on this and find out what we can. In the meantime, we got to talk about these markets here today, because we are seeing a rally, and it sort of feels like a quiet rally, if you will. Not a lot of fireworks here, not a lot of news necessarily pushing it higher. We have been getting sort of regular updates on the situation between Russia and Ukraine that indicate that Russia is pulling back its forces or de-escalating. But as we talked about at the top of the show with Doug Redeker, you know, that's not necessarily what the outcome is going to be, and we should not be so reactive to each and every headline. We should try and dig a little more deeply into what's going on in this situation. But today, market participants appear to be feeling more bullish, Saz.
Little relief rally. The one thing that we do know, Julie, interest rates are going higher this year, and Burger King brand owner, Restaurant Brands, mega quote out of Firehouse Subs. Big.
Yeah, that's part of the reason we're seeing consumer discretionary perhaps head higher today. Tech also leading the gains. Going to leave it to Akiko Fujita and Brian Cheung coming up after this break. Keep it right here on Yahoo Finance.
Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Brian Chung. We are 90 minutes into the trading day and we are seeing all three major indices surging ahead as geopolitical tensions in Eastern Europe show some signs of easing for now. We've got the Dow up 450 points here, the Nasdaq up 260, and the S&P 500 up 64. New inflation data kind of being shrugged off here as the producer price index jumps 9.7% from last year. Well, a potential diplomatic opening. Russia's defense ministry says it's withdrawing some troops from the Ukrainian border, even as the U.S. continues its drawdown at the embassy in Kiev. We're diving into the conflict over the next 2 hours and tracking the impact on broader markets. Oil seeing some significant moves to the downside in this session as well. You see WTI crude right now trading at 98 a barrel. And Intel looking to expand its portfolio, acquiring Tower Semiconductor. We're going to be discussing the $5.4 billion deal, what that means for the chip space, as we see shares of Intel pop on the news. We are beginning, though, with the market action yet again today. We saw things reverse as soon as some of that news came down out of Russia. The defense ministry, again, saying that they are withdrawing some troops from Ukraine, although they haven't specified the scale of that drawdown. I want to turn to Yahoo Finance's Jared Blickery, who's tracking the market action for us this morning. And most notably, Jared, today, some big moves in oil.
Yes, and we'll get to that in a second. Just want to draw everybody's attention to the nice rally we have, not only in the NASDAQ, but also the Russell 2000. Let's get a two-day view of the NASDAQ composite, and here's that jump up on the open. Now, in a larger context, let's take a look at a one-month chart here, still in the middle of its trading range. So got some work to do if we're going to mount any kind of rally here. But as you said, Akiko, the moves have been in oil. First of all, let's get to some of these tickers. This is the Russia index, MOEX Russia index. And we can see that is up 3.4% today, still in the bottom end of its range here that it's been trading in since about November of last year. Also seeing the U.S. dollar taking a little bit of pressure off. Let me get a 3-day or 2-day view of the U.S. dollar. That has been trending lower, so that means the ruble is appreciating, indicating some lower tensions with respect to that particular ticker. And then WTI crude futures off 4.5%. Haven't seen a move to the downside in quite some time this large. It is oil, and we know it can be volatile, but we're coming off of the highest price since 2014. So really a lot of pressure to the upside on crude oil, but $100 per barrel is a huge number, and it's probably going to take a lot more than geopolitical tensions as they are to get crude oil above that price. So a little bit of pressure coming off of not only crude oil, but also gas prices, and not natural gas. I was talking about RBOB gasoline, but natural gas up just a smidge today. Well, taking a look at the sector action, we actually have a pretty broad-based rally going on right now. Consumer discretionary and tech, those are the two leaders, each up about 2%. Also houses Amazon, that's consumer discretionary. Industrials and financials and materials close behind. So it's not only the value trade, it's not only the mega caps, also the cyclicals, also the growth trade. And so that's looking pretty good here. Not surprisingly, energy, the sole sector to the downside, off more than 1%. And taking a look at our leaders board, this is nice to see because this indicates a lot of interest in some of those fringe areas that you tend to see money sucked out of when there's any kind of trouble. So we have TAN, that's a solar ETF. We have chip stocks, talking about that acquisition potential by Intel. Also looking at cannabis, ARC components, Chinese internet, IPO, gambling. So all of those are indicating a little bit of risk on sentiment. But as I said, market's not out of the woods just yet. Do have a little bit more work to do. Want to take a look at our semiconductors because there's a lot of things going on in that space. It's not just that Intel potential acquisition of Tower. By the way, Tower Semi, that's up 42% today. It's also NVIDIA. NVIDIA reporting earnings after the bell. Analysts expecting a big beat and a raised quarter with expectations high for gaming and also data center. So any kind of disappointment, which usually NVIDIA doesn't produce. It's usually pretty good earnings reports and nice beats to the upside given conservative guidance. So we'll be looking out for that as well. And also AMD just closed its merger with Xilinx only yesterday, and we can see AMD up 2%. So nice to see some of these chip stocks getting some love here. And let's see if I can get to our travel sector because we're seeing a lot of movement there as well. Carnival Cruise Line's up 6%. So is American Airlines. Only thing really in the red right now Avis Budget Group, and that's after some disappointing earnings. That stock is down 13%, still up 278% over the trailing years, guys.
Okay, a lot of big movers there in the session. Jared Blickery, thanks so much for that. Well, the news out of Russia has led to some swings in the currency market as well. Take a look at where the euro is rebounding against the dollar right now at about 1.13. We saw the dollar index, meanwhile, pulling back against those gains we saw yesterday on the back of news yesterday again that violence could potentially be escalating in the region. To break down the latest moves in the FX market, let's bring in Emily Weiss, State Street macro strategist. Emily, good to talk to you today. What are the moves we're seeing today suggest to you in terms of how much of the worst case scenario has actually been priced in already?
Yeah, it's really been an interesting few weeks here where we've been stuck in this sort of push and pull of geopolitical headlines. And geopolitics is one of the hardest things to trade as a trader perspective, just because there's so much uncertainty involved. So as you noted, today we have out new headlines that are suggesting maybe an easing of tensions comes on the back of Friday when there was a repricing in terms of potential military escalation, et cetera. Now what really comes down to is just sort of teasing through the headlines. And unfortunately, there's a lot of headline risk in this scenario. As we see in the moves today, things are reacting very quickly. We do have the ruble still weaker on the year, but only about 1.7% weaker versus the dollar, which is well off the highs of where it was at the end of January. So as much as the market is still pricing some risk premium there, it certainly isn't pricing the worst case scenario. And that is something to sort of keep an eye on as we head forward into following additional headlines.
Hey, Emily, it's Brian Chung here. Great to have you on the program. I mean, how much of this is also tied to the picture on oil? Because obviously, when we talk about the market implications, that seems to be where people gravitate to very closely. And we know that the ruble does have a relationship with oil very closely, given the importance of energy to the country. In fact, you point out that the last time the ruble was this underweight was when oil prices, it feels so long ago, but we're at $40 a barrel.
Mm-hmm. Yeah, no, it does tend to really closely follow the oil price movements. And if anything, this year so far, we've actually seen a pretty bullish cycle for commodity markets. The geopolitical tensions added on top of factors that were already in place over supply and demand imbalances from the pandemic. So we still were already seeing heightened commodity prices, and then that obviously has further gotten investors sort of sucked into this ruble trade. Additionally, these kinds of sanctions and political risk are always sort of hovering in the background. For people who closely follow Russia, this is certainly nothing new. What is different this time is just the potential for a much further escalation that could have economic consequences by way of sanctions, which there are a range of options. So I think right now there's just a lot of things on the table. Commodity prices are one, but actually that's been a net positive for EMFX so far this year and for the ruble. So that's been interesting to watch, particularly if there is an easing in tensions. We would expect to see the ruble snap back pretty significantly.
Emily, I wonder, to what extent we're going to continue to see the choppiness around the headlines, as you mentioned. I mean, today it seems like a significant pullback, even though we don't have a lot of details about what exactly this withdrawal means. In the meantime, you got the Russian parliament today voting to declare the Donbas region independent. I mean, it feels like there's a lot of things that are layered on here in what's playing out in Russia. And I wonder to what extent the market is fully pricing in this risk. If it's not military action, it doesn't necessarily mean that Russia is not going to move in on Ukraine further.
Yeah, as I mentioned at the start of the program, geopolitics is one of the hardest things to trade, just because you're subject to an evolving situation that honestly no one really has incredible insight into. We can do our best to try and predict the next moves, but it's really hard to figure out the most probable outcomes. So in our situation, that means evaluating where the potential pain points could be in terms of where investors have already built up positions and where we're seeing the price action show that maybe there isn't as much price in as there should be. And then on the second hand, evaluating all the different outcomes that we could see fall out of this. So not just is there a military conflict or not, which for us, it focuses primarily on the financial implications, but then following it one step further to think what could the U.S. Treasury response be in terms of foreign ownership of OFCs or Russian bonds, or what could the implications be for access to the SWIFT payment system? All those sorts of questions are important to think about, and they're really hard to price. So right now we are sort of subject to this push and pull until we have additional outcomes. The one sign of encouraging news for me is just that there hasn't been too much of a contagion effect from this Russia story and Russia-Ukraine story at the moment into both either other areas of EMFX or even into the broader market sentiment. So while we still have seen some fluctuations, it isn't yet something that seems to have a major market systemic risk factor.
That's a really interesting point that you bring up about kind of how you haven't seen the spread to other EM, especially given the time in the cycle when everyone's been talking about EM and how undervalued they've been through the recovery. But I guess, how do you pair that with the tightening cycle that we're seeing around the world in other emerging market countries? Like if you think about the BRICS countries, Brazil, for example, one of the earliest to start hiking rates. How does that kind of also factor into the risks either on the upside or on the downside of getting into EM now?
Yeah, Brian, I'm glad you brought up monetary policy because it's been the key component we've been watching, not just from the point of view of the Fed, which we're now pricing significantly more Fed rate hikes coming up this next year, but also from the view of emerging markets, which have broadly led this cycle in the terms of removing policy. So actually places like Brazil are coming up towards the end of their easing cycle, just as the Federal Reserve and the ECB are starting to talk about getting started. So it's actually been a bit different this time around. We haven't seen the same sort of exodus from EMs that we might have expected alongside a tapering scenario. Certainly was not a repeat of the taper tantrum. If anything, it was almost the opposite in terms of we had EM FX outperformance in this environment. So those unsynced monetary policy cycles are actually benefiting at the moment some of these emerging market countries where rates are in Brazil above 10%. And that's pretty significant at a time when inflation is just starting to peak in that country.
Emily, it's good to have you on this morning. Emily Wise, State Street macro strategist. Well, despite concerns stemming from a potential Russian invasion of Ukraine, a hawkish Fed remains the key economic risk for fund managers. At least that's according to a new survey out from Bank of America. And Brian, we're talking about 5 key economic risks that were highlighted in this report. A hawkish Fed at the very top, followed by inflation, asset bubbles, global recession, and then Ukraine at the bottom here. So to Emily's point, it does really, we might see the wild swings we're seeing. We have seen over the last few days on those headlines out of Eastern Europe. But at the end of the day, it feels like we're still talking about the Fed policy and how quickly the central bank could hike.
Absolutely. And it is important to note that the survey period may have preceded some of the big headlines coming out of Russia and Ukraine. But I think it doesn't change the thesis that most investors are really pricing in the biggest concern being the Federal Reserve. And even those other concerns that are listed after the Fed are Fed related when you talk about inflation or a recession, which could be induced by the Federal Reserve. And when you take a look at just like the monetary risk, there was a measurement in the Bank of America survey about monetary risk that's perceived to be above normal. It's the highest level that they've ever recorded on the survey. And I think that this kind of complicates the picture for where to put your money, as underscored by the other finding in the survey that the investors really think long tech remains the most crowded trade. Maybe that's just because of how bad the FANG stocks got shellacked during the earnings season. But Akiko, a lot of movement and a lot of uncertainty over where to put your money in a time that's as uncertain as not knowing whether or not you're going to get 4, 7, or 8 rate hikes from the Fed this year.
Yeah, and it's really interesting in this report, looking at where the funds are likely to flow with those risks in mind. You talk about the move away from tech. Specifically, BofA highlights this big rotation to cash. UK and EM also in there, but when they look at, when they ask the fund managers specifically, most bullish on cash, most bearish on bonds. I mean, to me, that's interesting in part because we've had a lot of guests on who've said, look, cash, some would say cash is trash, but that there's not a lot to be gained in cash, holding cash, especially with inflation. And yet this report seems to suggest that there's an increasing move in that direction because of the choppiness and just the uncertainty that's in the markets right now.
Yeah, and I do think that the framing of all this is very interesting because, again, when you read the survey results, pay attention to the phrasing of the question. So when we talk about long tech, the phrasing of the survey question, as I have here, is what do you think is currently the most crowded trade? And 28%, the highest amount, said they were, that the most crowded most crowded trade is long tech stocks. But you can read that from two different lenses. Either that's because the survey participant is themselves long in tech stocks and they feel, well, I'm just with everyone else, I'm just going with the flow. Or it's people who are taking the other side of that bet, perhaps short tech stocks that are saying, hey, look at the majority of people that are stupid and aren't doing what I'm doing, which is shorting the US tech stocks. So it's really uncertain to kind of say, all right, you know what? This is exactly where people need to put their money. And I think that's because of the macro picture being so uncertain about Fed policy and the possibility of the Fed hiking too fast and then inducing a recession. I think that fits very nicely into the second narrative, which is the second most cited crowded trade, which is short US Treasuries. But again, who's on that side of the positioning and then who's going long US Treasuries? I think that remains a very open question, but we'll see how that pans out and who on that side of the trade ends up winning. Let's shift now to our trending ticker on this Tuesday. I want to move on to shares of Virgin Galactic. And the big question here is, if you have $450,000, can you put a third of that down right now? Well, if so, you can fly to space. Virgin Galactic said it will open up ticket sales to the general public beginning tomorrow, with reservations including custom accommodations and world-class amenities during your astronaut training. Shares of SpaceX up 20% on that news. Akiko, you're going to go? You have $450,000?
I don't have the money, but I'll go if it was offered. Hands down. Just need the money. A few $1,000,
like
you know?
Like a buy one, get one, maybe? If it's a buy one, get one, maybe you and I can take out a big loan and then go together. What do you think?
I like that idea. I don't think it's going to happen in the next few months. I'm just going to go out on a limb and say that. But that sounds exciting. I am not one who is concerned too much about safety. I'd say just get on board if there's a seat available.
I want to know what these custom accommodations are, because keep in mind, you have to go to New Mexico to go out there. So maybe it's like, what is it, like a Holiday Inn Express in the middle of New Mexico is the custom accommodations. Need to get a little bit more details on that. But let's move on. Coming up on the other side of this break here on Yahoo Finance Live, Intel dishes out $5.4 billion for Israeli company Tower Semiconductor, breaking down what that means for the chip industry as semiconductor sales worldwide surpass $500 billion for the first time ever. That's next. big news in the chip space as Intel is set to purchase Israeli chipmaker Tower Semiconductor for a reported $5.4 billion, all cash. The deal will beef up Intel's manufacturing capacity and global presence. So for more on this, let's bring in Daniel Newman, Futurum Research Principal Analyst who watches the chip space very closely. Daniel, great to have you on the program today. A big transaction for Intel. How do you think this plugs any sort of holes that Intel has in their global markets?
So we've seen the Intel IDM2 strategy. One of its big tenets was all about the Intel Foundry Service and expanding that. And we've seen what Intel is doing, its Ohio investments, other fabs across the US, its plans across Europe. But one of the big opportunities that the company still needed to address is what you'd call kind of that other 30% of the market opportunity, which is some of these analog technologies. And that's what Tower really focuses on. So the company focuses on, what you could kind of call lagging edge nodes, 45 to 250 nanometer. So we hear Intel talk about 5, 7, 10, and other leading edge technologies. A lot of the shortages we faced in this past year were in these lagging edge nodes, and Intel, looking to deliver a more complete foundry service, has found a really synergistic, straightforward acquisition that's going to help them accomplish that.
Daniel, I was going to ask you about the price tag here, $5.4 billion, which is a 60% premium on the closing price of Tower yesterday. But I'm looking at the stock now, up more than 40% right now. How much of this move you think is justified?
Well, this is a really significant growth opportunity. You look at the TAM for the foundry space, and you're talking about $100 billion today. And you're talking about a significant opportunity for growth. Like I said, I reiterate, so much of the shortage that we've experienced were some of these different analog technologies, power management, RF, automotive. We saw how many of the power management and sensors and different PCI connectors that actually caused PCs and autos not to be available. Well, Intel has promised to be part of the solution to expand capacity. The mega investments, like I said, the $100 billion up to in Ohio, this company is spending big. And by putting together this full-on foundry service, you start to see it being much more likely to be able to compete holistically with TSM. And by the way, TSM trades at something like a 30 times multiple, whereas Intel is about 10 right now. So this foundry service business could become a really big opportunity for Intel in both the short and long term. And I'm watching that closely.
Daniel, how much does this help with the Asian market specifically? Because the statistic coming from the Semiconductor Industry Association, sales reaching a record $556 billion last year, about a third of that was China being the biggest market. I mean, that's not a surprise. We know this, but TSM is dominating in that market. So does this acquisition do anything to move the needle for Intel there?
I think it moves the needle. The company has a presence there, largely in Japan. In the announcements today, it talked about serving the China market and continuing to push to serve that market. Right now, we still have a lot of demand constraints. So, the demand is so high, you could say we have supply constraint. And right now, if Intel could deliver more volume and more chips, they would be able to sell more, and that market would certainly be a beneficiary. TSM is a great competitor. They've had a tremendous run. There is no question that this move was going to be important to make Intel a full spectrum foundry service. And so I think it can help. I mean, we're going to have to track the numbers. We're going to have to see if this growth is material. But the investment and the numbers I can get behind because of what this does for Intel being able to execute on its promise to expand capacity here domestically in the US and then, of course, abroad.
Yeah, I mean, what does that ultimately mean for Intel? We know the stock has come under some pressure on the back of cost concerns. Obviously, the company has made it very clear this is not a 1 year, 2 year story. This is long term. But as they continue to add to their portfolio with the domestic production in focus, what does that ultimately mean in terms of how Intel is positioned in this space at a time when so many of its competitors have gone in the other direction in terms of going fabless?
Yeah, and Intel is working on several fronts to build and reestablish the trust in the market. The foundry service is certainly one of those big opportunities. We've seen over the last few years, all the fabless chip makers have done really well in the market, but solving this problem of the shortage has left only a few companies, including TSM and Samsung, and now Intel has an opportunity to fill that gap. So I like it from a diversification play. Also, if you see what Intel did announce just a few months back with their Mobileye strategy, you also see an opportunity that Intel could potentially see IFS become almost a standalone opportunity? Could it be spun off in the long term if it becomes big enough? Again, you look at those multiples for TSM versus Intel, and those multiples for, in the automotive space for what Mobileye will very likely IPO at. It creates some excitement that they're diversifying their business. They've certainly had challenges in meeting the expectations with some of their leading edge technologies. It seems with their new, 7, 4, and other, new process nodes that they're bringing into market, that they're gaining confidence, they're gaining steam. Pat Gelsinger seems to have his handle on it, but the market needs to give it a longer time horizon to accomplish the goals. Building fabs takes years. So fully seeing out this business and this acquisition actually provides some revenue and a boost to that 30% of that lagging edge semiconductor market immediately, which is something I think shareholders should be able to get behind.
Yeah, patience key, especially when we're talking about the build out. Daniel Newman, always good to have you on the show, Futurum Research Principal Analyst. Coming up, China's digital yuan taking center stage at the Beijing Olympics, ending Visa's reign as the game's exclusive payment service provider. We're going to break down the hurdles for the digital currency after the break. Welcome back to Yahoo Finance Live. The price of Bitcoin on the rise this morning, above $44,000. And in today's Crypto Corner, though, we're taking a deeper dive into China's digital yuan. With more than 80 countries now exploring digital central bank currencies, there's increased focus on the security and privacy concerns of that digital yuan. The number of users in China now over 260 million and rapidly growing. Here to help us break it down is Emily Parker, CoinDesk Global Macro Editor and CoinDesk TV anchor. Emily, before we get into the security concerns, I wonder to what extent we know how much the Olympics have really accelerated the usage of digital yuan. I mean, that was the expectation in the beginning. We're in the halfway mark. Not a lot of international travelers to bring into the fold, but do we have any idea on the usage at the Olympics so far?
So China has not released any official numbers for ECNY or digital transactions, but so basically inside the Olympics bubble, we have three forms of payment. There's Visa, cash, and ECNY. And we don't know exactly how much ECNY is being used, but I would say that symbolically, this is a very important step because it really means that the era of central bank digital currencies has officially begun. I mean, you can use it. You can use this in China. You can use it to make purchases. That's actually been true at the pilot level for a while. So symbolically, it's more of a symbolic marketing thing than it is an actual pragmatic thing, because I don't think that a wide swath of the population is using this right now.
Emily, I want to ask about the security of all of this. Obviously, a lot of concerns about the way that the People's Bank of China or the government at large is kind of monitoring the data or the usage of these digital currencies. Has there been any clarification from the issuers of the digital yuan over exactly how they're policing, kind of scrutinizing and monitoring the use of this new technology?
So it's still so early, so we don't really have a lot of details on this. I mean, basically what China has indicated is that for smaller payments, there's a certain degree of anonymity. Other people have said, well, everything is basically traceable. But, at the most basic level, a central bank digital currency like China's is pretty much trackable by design. If they're able to track every single tiny payment that every person makes, that's another question. But yes, this has raised concerns all over the world, not simply because of China, but because of the ripple effect throughout the world. So, as Akiko just said, there's over 80 countries now exploring central bank digital currencies, and we don't really know what the model for privacy will be. So I think that's really the concern, is that are we entering an era now where governments are just basically going to be able to track financial transactions of ordinary citizens at a much greater level than they were before?
Well, obviously the concern being that China is kind of leading the way when Western countries are still debating whether, in fact, they want to issue their own digital currency. Let's talk about the moves in Bitcoin specifically. We talked about it being well above that 44,000 level, slowly creeping its way back. What do you attribute some of the moves that we've seen over the last few days to?
So, always anyone's guess, but it seems that Bitcoin's moves are somewhat related to what's happening with Russia and Ukraine, which is kind of an interesting thing because, Bitcoin, in theory at least, is supposed to be a safe haven asset, which means that when there's a lot of political and economic turmoil in the world, people in theory should turn to Bitcoin to escape from that. That's not actually what's happening, at least right now over the short term. It does look as if Bitcoin's price is tracking what's happening in Russia and Ukraine. So, we recently saw there seems to be a little bit of a drawdown, a little bit of relief, and Bitcoin may be rising because of that. We obviously don't know for sure, but it does seem to be following political developments and acting more like a risk asset than a safe haven asset.
Okay, Emily Parker, as always, good to have you on, CoinDesk Global Macro Editor and Anchor. Coming up, a bid to avert war, the latest developments on the Ukraine crisis as German Chancellor Olaf Scholz meets Vladimir Putin in Moscow on the other side of that long table. We'll be right back. In our worldview today, Russian President Vladimir Putin says he does not want war in Europe, amid reports of some Russian troops pulling back from the Ukrainian border. Putin's comments followed his first face-to-face meeting with German Chancellor Olaf Scholz. The bilateral discussions come as Germany faces increasing pressure from NATO allies to take a stronger stance against the Kremlin, despite Germany's heavy reliance on natural gas imports from Russia. Meanwhile, Russia's defense ministry says it is withdrawing some of its troops from the Ukrainian border, suggesting all diplomatic channels have not been exhausted yet. Russia has not specified the scale of the drawdown. Over in Russia's parliament, the lower house voted to ask Putin to recognize 2 Russian-backed regions in Ukraine as independent. The move to recognize Donetsk and Luhansk as separate from Ukraine threatens to inflame tensions between the 2 countries, and it could kill the Minsk peace process. The Donbas region has been embroiled in a war between government forces and separatists backed by Russia. It's already killed 15,000 people. The appeal has been sent to the Kremlin, but there's no timeline yet on how quickly Putin is expected to address the issue. Over in Canada, police are stepping up arrests 1 day after Prime Minister Justin Trudeau invoked the government's Emergencies Act to end a near 2-week blockade brought on by COVID-19 protests. Trudeau became the first Canadian leader to invoke the act on Monday, giving his government sweeping powers to crack down on individual demonstrators, including freezing their bank accounts. The so-called Freedom Convoy grew out of opposition to vaccine mandates for truckers crossing the U.S.-Canadian border. Demonstrations brought a major artery for U.S.-Canadian trade to a near halt last week, forcing many car makers to temporarily halt production. The United Nations is calling for an immediate ban on toxic chemicals following a new report revealed the toll pollution is taking on communities globally. The UN report said pollution from pesticides, plastics, and electronic waste contributed to more deaths than COVID-19. It's led to at least 9 million premature deaths every year. Now, the report calls for a ban on harmful chemicals, including those used for non-stick cookware. The UN is scheduled to present their full plan at the Human Rights Council next month. And some breaking news here. Prince Andrew settling the sexual abuse lawsuit against him. The allegations were made by Virginia Giuffre, who said she was under the control of Jeffrey Epstein and Ghislaine Maxwell at the time, she says, the assault took place. The price of the financial settlement was not disclosed, but the filing says Prince Andrew will also make a donation to Giuffre's charity, which supports victims' rights. Andrew previously tried to get the suit thrown out, but his attempts failed. In the process of the suit, Andrew was stripped of his military titles and other honorifics tied to being a member of the British royal family. Well, coming up, Marriott rebounds to Omicron levels as demand for business and leisure travel gets a boost. We've got more details on the latest earnings results for their hotel chain as Airbnb gets ready to report after the bell today. We'll be right back.
travel stocks in focus as Marriott reported, and they said that demand for business and leisure travel appears to be back. Yahoo Finance's Emily McCormick is watching the tape very closely and has the roundup of all the big travel stocks making moves. Emily, what are we hearing?
Well, Brian, Marriott shares specifically are climbing this morning after the company posted quarterly results that topped estimates across virtually every major metric. Now, the travel stock has also been outperforming the S&P 500 so far for the year to date as the recovery and reopening process continues despite a brief bump from the Omicron variant and the surge in cases that we saw in January. But diving into these results here from Marriott, adjusted earnings per share were $1.30, coming in 31 cents ahead of consensus expectations, and revenue of $4.5 billion, more than doubled compared to last year, and also topped estimates. Now, we should note it was still down by about 17% compared to the same quarter in 2019 before the pandemic, but again, still ahead of expectations and still showing encouraging signs of moving in the right direction on the top line. But more importantly, revenue per available room, which is a closely watched metric in the accommodation space, grew by about 144% in the fourth quarter for Marriott in North America specifically. Worldwide, RevPAR was up by 125%. And Marriott also said in its earnings statement, quote, "We experienced significant progress in global RevPAR recovery in 2021, despite the emergence of new variants and ongoing headwinds from the global pandemic. Each of our regions saw meaningful continued RevPAR recovery in the fourth quarter compared to the third quarter, with the exception of Greater China, where recovery stalled due to their zero COVID policy." Now, for this year, Marriott also expects to increase its property footprint and see net rooms growth come in between 3.5% and 4%. And we should also note that Marriott executives struck an upbeat tone about bookings trends in the first quarter, the current quarter, despite that brief impact from soaring Omicron cases in early January. Now, specifically, the CEO of Marriott, Anthony Capuano, said during the earnings call this morning that group and corporate cancellations had ticked up for January and February arrival dates due to Omicron, but these cancellations have now started to slow and new bookings are also gaining momentum. And then finally, in terms of what Wall Street is saying about this print, Bloomberg cited analysts at Citigroup who wrote in a note, quote, "Marriott's fourth quarter results were well ahead of consensus expectations, and results reflect continued rate-driven recovery, which bodes well for accelerated earnings growth as occupancy trends improve." Now, this report from Marriott is also potentially a positive sign for some of the other accommodations and lodging companies we'll be hearing from with their latest quarterly earnings results coming out in the next couple of days. Airbnb and Wynn Resorts are each slated to report after market close today, and Hilton and Hyatt report tomorrow. Now, all of these stocks have outperformed the S&P 500 so far for the year to date. And again, just zeroing in on Marriott specifically, definitely seeing a boost in those shares today after these results, guys.
Yeah, big earnings expected from Airbnb at 4 p.m. And of course, you'll be able to catch that live with Emily McCormick, who's going to be hosting the 3 to 5 later on. We'll catch you later, Emily. Thanks so much. Keeping on the theme of Airbnb, though, some interesting reporting from the Wall Street Journal of schemes where investment firms are getting into the rental game. Basically, the scheme works like this. An investment firm will team up with a rental operator. The investment firm will buy up a property. They will then securitize the mortgage on that property, sell the bonds to investors, and then the rental operator brings the cash in by renting out that property. And Akiko, I've noticed this personally going to Airbnbs. It's not a person that's actually listed as the host. In many cases, it's now becoming a company or an LLC of some sort, but very interesting within the context of just broad institutional home buying, which of course has been leading to bidding wars across the country.
Yeah, you're certainly right about the offerings on Airbnb. I've also noticed increasingly that you walk into a house there and you clearly know it's not lived in. But in terms of what we're seeing right now, I mean, it is an interesting move for, a lot of these investment firms to get in. But I think it also speaks to what's happening in the broader context of investment. If you can't find the yield in equities, in traditional market space, then increasingly people are moving to home buying because the expectation is that the return is more significant on that front. I will tell you, Brian, just firsthand, I have seen it at open houses where you've got investors just sort of rolling up, offering cash on the spot. And this isn't necessarily vacation homes. Obviously, that's what this article focuses on. But I think that has led to some significant increases in property prices in some of the more hot markets. Now, you pointed out an interesting thing here in the break about what we saw play out with Zillow and their offers, which was their home buying, home flipping operation, ultimately shut down here, left with about 7,000 homes.
Yeah, no, and it's not a great picture, but I think this underscores how, even though it might be attractive for people to want to get into home flipping, whether or not that's actually doing work on a home and flipping it for more and kind of making it a project versus actually just buying a home that's already nice and just hoping that it appreciates. I mean, there is an uncertain kind of thesis on whether or not that's a viable investment strategy, even though, yes, it might be a better option than some of the yield that's available out there. And I think one last point here is that it's so important for people who are investors to recognize that there's a very different level of investment when it comes to home buying than in other types of financial investing. And that's because of the maintenance costs that are required when you buy a house. And I think that maybe that's something that Zillow just didn't appreciate. I mean, there's so many types of characteristics that you look for when you're buying a house that don't come into play when you're trying to figure out what share of a stock to buy. It's just about what company you're buying into. Beyond that, there's no difference between a Facebook share and another Facebook share that you buy on TD Ameritrade versus on Robinhood, right? Whereas maintenance for home buying, way more intensive, way more difficult. You have to become a plumber, you have to become an electrician, all these types of things, which is a reason why I think it's a lot more difficult than people maybe discount it for.
Well, it is worth mentioning that there's a lot of interest in this direction, not just because of the yield that's available or that they expect to get back, but also because the expectation is that things really, as COVID becomes endemic, more and more people are going to want to travel. Airbnb's talked about people staying longer in the Airbnb rentals because they can now work remotely. So there's a lot of trends on that side that are providing a tailwind to this move. To your point, Brian, the question is, how can they manage the properties beyond just seeing the property prices go up? What does that ultimately mean for just how affordable homes are, even if we're just talking about vacation homes today, but a story we're going to be watching really closely. And again, Airbnb reporting after the bell today. So we'll be looking at those numbers. Well, coming up, pain at the pump as the average for gas prices hit $3.50 nationwide. Some lawmakers are looking to suspend the federal gas tax, but a suspension may cost consumers more than they think. We'll explain after the break. had to fill up gas recently, you are feeling, like everybody, the pain at the pump. Some Democratic lawmakers are looking to suspend the federal gas tax as the average price hits $3.50 a gallon nationwide. That is $1 more than a year ago, at least according to AAA. But the Committee for Responsible Federal Budget warns a freeze could end up aggravating inflation more and reduce gas tax revenues by roughly $20 billion. Brian, I'm curious to get your thoughts. We're talking, what, 18 cents a gallon for the year in terms of how much would be reduced?
Yeah, so the tax holiday would not reduce gas prices that you're paying at the pump by $1. Let's just kind of get that out of the way. The estimate is that the federal gas tax is about 18 cents. And in fact, in many cases, states have a larger gas tax than the federal government does. And this is just covering the federal government, this proposed holiday, which again remains to be seen if this will actually get done. But again, this is all about inflation, right? Making sure that the 18 cents, which could be impactful for a lot of low-income Americans, will hopefully alleviate their, costs on a monthly basis and be able to allow them to spend on the things that they need to spend on that are getting more expensive. But there's kind of a bit of a self-fulfilling cycle here where if gas prices are lower, maybe people increase their demand for stuff, and demand push is a big reason why inflation is as high as it is. So the jury's still out from an economic standpoint about whether or not a federal gas tax holiday, which would be temporary, would actually do the job of quelling inflation. So I think that this is more just kind of posturing from the White House to say, hey, we're paying attention to this. But again, important to note that it's really not so clear that if this actually gets done, it will have the ultimate impact that the White House might want it to.
Well, underpinning all of this is just the political headwinds that Democrats are facing right now going into the midterms, especially as consumers, they're not looking at the inflation number per se. They're just looking at what they're having to pay in gas and food. And that has really translated to pressure on the White House as we've seen the president's numbers, approval ratings fall as we see the inflation numbers tick higher. So in many ways, lawmakers who are in these more vulnerable districts, certainly want to be seen as doing something, saying, we hear you, we understand the pain, we're making some moves. But to your point, I guess the question is, how much of an impact is that really going to have? And that seemed to be what we saw last year when the White House tapped into strategic petroleum reserves. And, the time it was, okay, this is great, but 2 months from now, 3 months from now, how big of an impact is that going to have? We're still seeing those prices go up.
Yeah, and I think thematically, this also fits with, the White House has messaged that a lot of these price increases are due to anti-competitive behavior and strong pricing power. But I mean, we know that anti-competition is something that's not going to get done overnight. And in the immediate problem of high inflation now, I don't think we should expect any sort of pro-competition agenda to immediately be done to address these price pressures. And I think this is why in conversations that I've had with administration officials, they're saying really a lot of this falls on the Federal Reserve. And it's difficult for them to outright say that because they want to respect the Fed's independence. But the only agency that has the blunt tool to be able to, on the aggregate, address price increases is higher interest rates, higher borrowing costs. Very important ahead of later this afternoon. The Senate Bank Committee is supposed to hear the 5 nominees for the Federal Reserve from the Biden administration that will have a key hand in addressing those things. Reports now about whether or not the Republicans might want to kind of hold up one of those nominations, Sarah Bloom Raskin for the vice chair of supervision role. But these will be very key people in the argument over how the Federal Reserve, how aggressive they should be in raising interest rates. And I think that's really going to be a part of the focus for not just the later parts of this year, but really right now, the next 3 months, the spring of this year is going to be extremely critical in getting those CPI PCE numbers down.
Well, and Brian, bringing it back to the price of gas and, how significantly that affects consumers and also lawmakers, because the finger pointing goes in that direction. You mentioned we're talking about the federal gas tax now. Obviously, states have their own tax. California, one of the highest, if not the highest. The governor there, Governor Newsom, has also proposed a holiday. So this is clearly something that so many lawmakers, not just on the federal level, but at the local level, are facing a lot of pressure on. So it'll be interesting to see how quickly these things move as people continue to say, look, why is it that I'm paying this much more than I did a year ago every time I fill up?
Yeah, we were joking about people flying into LAX and seeing those gas stations that are immediately around that area. It's like $6, $7 a gallon sometimes, though, of course, that could just be the proximity to the airport in addition to all of those other factors. But don't gas up. at those gas stations by the airport. Just drive a little bit inland. Coming up on the other side of this break, the Dow snaps a 3-day losing streak as the major averages all remain in the green. This is as news reports come out that Russia is showing signs of a potential de-escalation with Ukraine. We'll have the details after the break. Welcome to Yahoo Finance Live. It is officially the noon hour here on the East Coast in New York City. It is Tuesday, February 15th. I'm Brian Chung. That is Kiko Fujita. We'll be hanging out with you for the next hour. But of course, as we get started, let's take a look at where the numbers are so far. And pretty nice green across the board. You can see the Dow up about 1%, S&P 500 up about 1.5%, and the NASDAQ, some of those tech stocks getting a nice rip higher, up 2%. All of this coming as we get possible news of a de-escalation with Ukraine. A lot of news that we have to follow, but of course, some optimism as Russia announces that some of its troops would return to base. What does this mean for markets? We'll have the breakdown with a number of markets guests later on in the show. And also, elevator up. Otis Worldwide stops by on their investor day to chat about the business of moving people up and down and side to side in some cases. You won't want to miss that conversation with Otis CEO Judy Marks coming up in the hour. But of course, a rip higher in markets, reversing a lot of the concerns that we had seen in the past few days over Ukraine and Russia. So let's bring in our markets guest for the hour, Emily Bowersock-Hill over at Bowersock Capital Partners, founding partner, and also Ryan Payne, Payne Capital Management President and Payne Points of Wealth podcast host. Great to have both of you on the program. Just want to start off with you, Emily. Obviously, we are watching markets in the green so far. People kind of optimistic that maybe the concerns over a spat between Russia and Ukraine might not happen with some of the positive developments. What do you see on that front? How sensitive do you feel U.S. equity markets are still to news coming out of Eastern Europe?
I think equity markets were on edge anyway, and so they are reacting more than they typically would to geopolitical events. Obviously, the Russia-Ukraine tension is more than just a standard geopolitical event.
But I frankly think the Biden administration has actually handled this quite cleverly, almost narrating it like it's a sporting event. And I think that they may succeed in neutralizing some of this tension, which obviously would be good for markets. I'm not surprised to see this surge today.
Ryan, I'm thinking that your energy holdings have looked pretty good over the last few weeks or so, but we're seeing declines today. And I wonder to what extent we're likely to see a more meaningful pullback here, if in fact it does appear as though both sides are able to pull back from the brink of a war.
Well, I mean, it looks like we're getting repriced on that today, right? Obviously, we had the fear of war yesterday, markets were down big. No fear of war today, markets are up big. But I think the bottom line is what's interesting about this whole pullback that we've had here, it's really been concentrated in growth. I mean, if you look at value stocks, they're barely down for the year. Emerging markets are actually up for the year. We know commodity prices through the roof, which was one of my great calls on your show. And I do talk about it on my podcast, Pain Points of Wealth, maybe one of the fastest growing podcasts in America. Whereas growth, on the other hand, has gotten trounced here. If you look at anything, it's like a disruptive technology, like that Cathie Woods ARK fund's down 50% from its peak. And the NASDAQ is still down like 12, 13% for the year. So I think what's really going on here, if you look at the big picture, is this narrative of interest rates are going higher. And you're getting a big repricing of those growth assets that I've warned about, on your show time after time again, and it's all kind of coming to fruition right now.
Ryan, as a follow-up here, I mean, you're noted 3 R's, right? Raising the policy rate, repricing of stocks, and the Russia conflict. But what R I didn't notice was the reopening of the economy. And it's interesting because today we're getting a lot of travel stocks, Airbnb after the bell. We got Marriott before the bell today. How important is that thesis? Or because of all the concerns in the macro picture, you want to stay away from those types of equities?
Brian, I totally regret I didn't add that R to my thesis. Been 4 R's. Because, yeah, you're right. The reopening is huge here because that's the thing is you think about all the lockdown restrictions globally right now, we're still coming off of those. And that's why I think this summer, you're going to see the economy boom, right? Because there's still so much pent-up demand. The middle class is still sitting on $1 trillion that they didn't have before the pandemic because of stimulus. We know wages are going up. And, contrary to popular belief, inflation is extremely high right now. We have the Producers Price Index coming out today, but inflation is going to slowly come down this year, but wages are going to remain high. So you've got consumers with money in their pocket, their wages are going up. They're just like amping to do things. And this summer, you're going to see, and you've already seen the polls on this. People say, it's becoming endemic. We just accept the virus. We're going to live our life, which is going to be a huge spending boom, which is phenomenal for earnings, which is going to drive this market higher if you caught all that.
Emily, we've had a lot of guests on who talked about the fact that they're turning bearish on U.S. equities. They see more opportunities outside of the U.S. It sounds like you're looking to emerging markets too. Can you talk a bit more about what opportunities you see there and how much of your exposure to the U.S. is getting moved in the other direction?
International stocks generally are trading at about a 30% discount to U.S. stocks. So we did not see the surge in values that we saw in U.S. growth stocks last year. So there are still really good opportunities, especially on the value side. And you've got good cash flow, good dividend paying stocks. With regard to emerging markets, I think you need to proceed with a little bit more caution. But as Ryan points out, emerging market stocks are actually up for the year. I think that is partly because they had such a terrible 2021 and the Chinese stock market really struggled. So you have much better prices in emerging markets. And also, you've got a country like China that is actually starting into an easing cycle while the developed world and the US and soon Europe is going into a tightening cycle. So that should be a tailwind for stocks in China and potentially for emerging markets generally. Now, again, I would tread a little bit cautiously in re-entering emerging market stocks, but international stocks generally are absolutely at a better price than U.S. and particularly U.S. growth stocks.
And I'll turn this over to Ryan to respond to that. I mean, she kind of referenced your thesis there with regards to emerging markets. I mean, you feel the same way?
And it just warmed my heart to hear that because, most strategists out there aren't talking about international, and it's just so undervalued here. You look at growth rates in the emerging markets, they're going to be faster than the US. They've got cheaper multiples. And I think that's really significant. What Emily just said is, as we're tightening, they're actually loosening their policy because they already tightened. And if you look at China specifically, loan growth is up big over the last 12 months, which bodes well for all of the world. And if you look at the UK stock market right now, it's actually up this year as well. It's outperformed the US market over the last 3 months. And you got a lot of old school industries, right? You've got energy, financials, you got materials. Whereas if you look at the major US indexes, like the S&P 500 is like 35-40% tech, again, which is experiencing this repricing. So I think you've got to have money overseas. The dollar is actually starting to weaken as well, which is very beneficial for those overseas assets. So you want to have a value-oriented international portfolio. That's the place to be this year. Well said, Emily.
All right. Good note to end on there. Emily Bowersock-Hill, Bowersock Capital founding partner, and Ryan Payne, Payne Capital Management president, and also host of that podcast, Payne Points of Wealth. Thanks so much for hopping on. All right, well, let's shift gears and just get a bigger picture of exactly what's going on with the Russia-Ukraine situation. Obviously, a lot of developments just over the past few days over whether or not there would be an impending invasion sometime tomorrow. But of course, Olaf Scholz from Germany going over to Kiev, going over to Moscow. There's a lot to unpack. So let's bring in an expert who can speak to the politics of all of this. Michael O'Hanlon over at the Brookings Institution is the Philip H. Knight Chair in Defense and Strategy. Michael, it's really great to have you on the show. We've been talking about the market implications of all of this, but I feel like it's really helpful for our viewers just to back up and get to the root of the issue here, which really concerns Ukraine and whether or not they will or want membership in NATO. Give us just kind of the 32,000 feet in the air review of exactly what's at stake here, what the problem is, and whether or not the de-escalation that we're hearing about today is ultimately optimistic to you as well.
Well, thank you for having me on. And to start with the last point, don't take anything that's happening today as to the bank. I think the idea that markets are assuming war yesterday and peace today is verging on silly. Putin is good at trying to make us think whatever he thinks is useful for him. And so if he thinks that today a little bit of diffusing tension maybe makes us more inclined to try diplomacy, because yesterday we thought war was inevitable, so why bother? That's the kind of thing he would do. So I don't presume in any way, shape, or form that this thing is becoming less tense. Having said that, I think Putin's smart enough to know that war is a huge gamble and cost for him in military as well as economic terms. And I still would bet against him doing it if he can get some concessions. He's gone so far that I think he needs something. So to get to your more fundamental question, as you know, NATO was set up in 1949 to deal with the Soviet threat, but once the Soviet threat was gone, we doubled its size anyway over the next quarter century, and we included ultimately the 3 Baltic states, which had been part of the Soviet Union. We also included countries like Poland and Romania that had been part of the Warsaw Pact. And what really got Putin's goat is he watched all this and didn't like it, but put up with it. What he really didn't like was when Ukraine and Georgia were promised NATO membership back in 2008. This sort of came about as part of President Bush's so-called freedom agenda. He and Secretary Rice were really pushing democracy promotion, partly to give a better veneer to the Iraq War, but also more generally to try to reform the Middle East. And, it's a noble goal, nothing wrong with promoting democracy if you do it right. The problem here is that by promising membership to Ukraine and Georgia someday, but with no interim security guarantee, we essentially painted bullseyes on their backs because Russia knew we would not bring them in as long as they were unstable and as long as they had border conflicts with their neighbors, even if it was Russia that was causing the conflict. So ever since, we've seen various efforts by Russia to make sure these two countries stay unstable. And in the last 1 to 1.5 years, President Putin appears to have developed a real antipathy against President Zelensky of Ukraine. Zelensky started talking about wanting to expedite membership for Ukraine into NATO. He wasn't being offered that, but he raised the conversation, raised the topic publicly. And I think that, plus whatever else Putin perceives in terms of wanting to create a legacy, maybe wanting to do this when Biden's president rather than Trump, those kinds of issues could factor in here as well. But I think that the immediate, impetus to this was Putin's growing contempt for President Zelensky and his concern that Ukraine was going to try to finally make real and make immediate what had only been promised in the abstract previously, the idea of Ukraine joining NATO.
Michael, you just highlighted some of the risks there in the case of, the worst case scenario here where Russia invades Ukraine. What would still motivate Vladimir Putin to move forward with that kind of plan, even in the face of that risk? Is it about regime change over in Ukraine?
It could well be. Yeah, that's a great question. I think it could well be. It could also be just taking part of Ukraine. As you know, he already took part of Crimea. The Russian Duma this week is considering whether to take that small province, the Donbass, over in the east and make that part of Russia. And so it could just be that Putin, who has said that the dissolution of the Soviet Union was the greatest catastrophe of the 20th century, that he's trying to put some of Humpty Dumpty back together, or at least the pro-Russian parts of Ukraine, basically from Kiev eastward. I'm not so sure they're pro-Russian anymore, but they historically have been closer to Russia than the Western parts. So that's possible. But I think your guess on regime change may be the closest to the mark if I had to try to figure it out. Because if Putin, what Putin wants is a permanent agreement that Ukraine will not join NATO and that therefore it will be closer to Russia in general than it is to the West. I think that's his long game. And whatever he needs, if he could get a binding commitment from us never to offer Ukraine membership, that would be the best outcome for him. He actually wants to roll back some previous, membership additions as well, which is not on the table. But if he could make the idea of Ukrainian membership go away permanently, that would be ideal. Next best is to get a government in Ukraine that has no interest in pursuing that, as well as the historical lesson to any future government of Ukraine that if you try to go down this path, you may suffer the same fate as President Zelensky. So yeah, I think that's a very plausible picture. I still think he prefers to see what he can get in this out of diplomacy and threats rather than the actual invasion. I think if he gets some kind of a diplomatic process that reduces the odds of Ukraine joining NATO, he's not going to be punished for this whole crisis in any meaningful way. He's essentially going to get out of jail free card despite all the anxiety he's created. If he attacks and he kills people and he seizes land, then I think all bets are off as to where our economic punishment of Russia would extend. And I think he knows that.
Well, Michael, as a follow-up here, it sounds like based off of the United States messaging, though, that they will not try to immediately balk to the demands for allowing Ukraine to get away from NATO here. What do you read from the State Department strategy, namely last week, with regards to putting it out there that they felt that an impending invasion was going to happen? Because one interpretation of that I had seen was that this was the United States double dog daring Russia to not necessarily do the actual invasion, but to basically let them know that the United States had no intention of stepping aside here.
Yeah, you could be right. I don't totally have the motivation for the Biden team figured out. I'm not sure I agree with the sense of imminence that we've created in our prognostications. But I do think that you're certainly correct as well, that they've held firm to the so-called open door policy, which, by the way, is not really in the NATO treaty. There's nothing in the NATO treaty that says you must admit new members if they ask to join. You only do it, according to Article 10 of the NATO treaty, if you think it would improve European security. And I don't think bringing Ukraine into NATO is going to improve European security. So, but the Biden team disagrees with me, and so do most American foreign policy specialists of both parties. And so I think you're right. It's a delicate act. Even I would concede with my views, nonetheless, that you don't want to do this at the barrel of a gun. You don't want to somehow take NATO membership off the table at this moment. We would have been better off trying to negotiate a different arrangement before the threat, rather than giving into the threat. So the best you can do now is start a process that is open-ended about where it might wind up. But Putin would know that if 30 NATO countries are involved in this process, and all 30 would have to bless a future invitation to Ukraine for it to be able to join NATO, that's a lot of countries that could prevent Ukraine from joining NATO if they believe that Russia's made a good faith effort to create an alternative successful security structure. So this is, it gets hypothetical and it's provisional, but I think it's the best Putin can hope for. There may be ways that certain member states in NATO today, President Macron or whomever, might sort of wink and nod that this could be possible, but only if we get to a certain place in the negotiation.
Michael, what does Russia's standoff with the West right now ultimately mean for its relationship with China? These two countries are not allies, but we have seen them get closer. We saw Vladimir Putin attend the opening ceremony over at the Beijing Olympics. They had a bilateral meeting before that. What does this all mean in terms of those two countries getting closer?
Yeah, and which, by the way, is the reason why, one more reason I was always skeptical that Putin was going to attack this week. I mean, people say that the Chinese don't care as much about these Olympics as the 2008 Olympics, but they still care. They still put tens of billions of dollars into the preparation. And if there's a war this week, it's going to slightly displace the Olympics from the headlines. But I think you're right that certainly China can provide a lot of the markets for Russian gas and oil exports that Western European countries now provide. And so if you imagine that we were going to reduce our, we in the West are going to reduce our imports of Russian energy in the years to come, either as we go green or out of punishment for a Russian aggression against Ukraine, China could become an alternative market much more than it is right now. That's one piece. For China, however, it can't really get too far down this path of replacing, a billion wealthy Western consumers with 135 million not so wealthy Russians. So there's only so far this relationship can go at satisfying both countries economically. But I think that strategically and diplomatically, even if they don't form an alliance and promise to fight for each other, they can do a lot of coordination. They can create crises at the same time to distract us and overload our circuits. They can protect each other's flanks at the UN Security Council. They can sally up to countries that we don't like and do it together, countries like Iran, where they can create a big headache for us and weaken us in that sense. So I think it's a pretty important partnership for both of them, and I would expect it to continue as such.
Michael O'Hanlon, it's great to have you on today to help us make sense of everything that's playing out in the region. He's with Brookings Institution, Philip H. Knight Chair in Defense and Strategy. Well, let's turn our attention back to the markets, and one stock on the move, that is Tesla. CEO Elon Musk making some news here, donating $5.7 billion worth of the electric car maker's stock to charity in 2021, according to securities filings. Although the organizations aren't listed, the donations occurred while Musk sold off a massive amount of his Tesla stock, totaling more than $16 billion. In the case of the ultra wealthy, charitable donations like this can help counter huge tax bills set off by trading activity at that amount. And we should mention Elon Musk last year tweeting, complaining about having to pay more than $11 billion in taxes in 2021. So potentially the donations may be motivated by that as well. Well, coming up, we are going up. The CEO of Otis Worldwide, one of the world's largest elevator manufacturers, joins us next to discuss the company's full-year outlook in a Yahoo Finance exclusive interview. That's on the other side.
Big Investor Day is wrapping up for elevator giant Otis, where it outlined its long-term growth plans. Joining us now in a Yahoo Finance exclusive is Otis CEO Judy Marks. Judy, nice to see you. Busy day for you. Thanks for taking the time here. How wrong is it for one to assume that Otis is just a return to office play?
Yeah, Brian, thanks. It's great to see you. And it was an exciting morning for us where we got to share with the investors the progress we've made in 2 years since our last Investor Day and since we've spun. I think what people don't understand is with urbanization, buildings of all types need elevators. And, almost 60% of our 2.1 million unit leading service portfolio is residential. So multifamily, apartments, condos. And while office is very important globally, it's certainly not one of our largest markets.
The pandemic, of course, Judy, is still raging on, something you and I talked about when you reported earnings a couple weeks ago. How is that impacting your pipeline of development here in the United States?
Actually, in North America, the pipeline is strong. We're seeing kind of the Omicron impact more in Eastern Europe and now heading towards Asia, actually the reverse of what we saw in early 2020 in terms of COVID spread. So job sites are open. We're seeing all the economic indicators and more importantly, the building indicators, the Dodge Momentum Index, the Architects Billing Index, and frankly, the bids themselves growing here. You can barely go to any city, small, medium, or large, and not see a crane these days. So we're excited about America's growth, had a really strong fourth quarter in orders, both in new equipment and modernization, where people are going to really modernize the elevators and whether it's aesthetics or machines, bring them up after about 20 years of service.
Well, let's stay on the elevators. I do want to get a feel for what's happening overseas, but I took an elevator in my building this morning. It's not too fancy. Had some buttons. It got me down the floor. That was great. It worked fine. What does the elevator of the future look like to you?
Yeah, this is we're really at an inflection point in this industry that we had the innovation and the privilege of starting almost 170 years ago. As the industry leader, innovation is what we're all about. And the future of elevators is all about being connected from electronics, connected from data, connecting the passenger to information, and letting us be more predictable and more quick in terms of repairing elevators, but more importantly, being able to make them even safer and more predictable for building owners and residents alike. So being connected is all about having information at your fingertips, actually being able to call the elevator with your iPhone or your Samsung phone. So when you leave your apartment or condo in the morning, it's really the first and last stop everyone makes in their day, most of their days, if you don't live in a single family home, whether you're in a hospital, a school, or an office building. So being connected is going to give us more information. It's going to reduce entrapments. And we introduced two new elevators last year, our Gen 3 and our Gen 360, that have automatic data sensors in them that communicate with us regularly, with customers regularly, and we'll add in the future, actually this year, multimedia to it. So it's a full range of offerings that, most importantly, Brian, besides the passenger experience, give us critical data to service. And as you know, service is the name of our business. Last year, 55% of our revenue, 80% of our profits. And it's that resilient and recurring service model that make this such an attractive industry and make Otis such an attractive investment.
You mentioned there was a slide in the Investor Day deck today, Judy, noting that 33% of your units are in fact connected. Over time, where do you see that number going, and how does that impact your service business?
So over the medium term, we see that 33 going to about 60% of our 2.1 million units. Although those units are growing, there was another slide that said we'll be at 2.5 million units by 2026, which is great growth. Our service portfolio growth has been fantastic. 19, we grew 1%, 20, we grew 2%, last year 3%. So, being connected is going to make a difference because it gives us that stickiness with customers. They're getting added value. They have the ability to see the heartbeat of the elevator, to know the elevator's operational. And most importantly, we know that there's an issue with the elevator before the customer even knows or calls our Otis Line help desk. So we get better retention, which again just compounds our service portfolio, which is the name of our business.
How big a profit hit, Judy, this year is inflation to Otis?
So we witness inflation, Brian, two ways. One, in the new equipment business, we experience it mainly through commodities, where only 30% of our new equipment business is labor. We're going to see still some commodity headwinds through the first half of the year. We've targeted that at about $90 million. In our service business, it's just the opposite. We're 70% labor because we have 34,000 field service mechanics throughout the globe in 200 countries and territories. But for us, we also have the benefit of a significant amount of collective bargaining, not just here in the US, but in Europe with the works councils and in the mature countries in Asia. So we have predictable wages. We're getting ready. We're actually have some early agreements with the National Elevator Bargaining Association that we're part of, has reached a tentative agreement with the International Union of Elevator Contractors here in North America. We'll wait for that to get ratified. Won't share more data, but that'll give us 5 years of predictability. And that's what we look for in wages across the globe for our 70,000 colleagues, being fair and having predictability so we can manage everything else through productivity, through pricing, and obviously return to our shareholders.
There's been a real slowdown in economic activity in China. Hearing that from a lot of companies, do you anticipate, is there another shoe to drop here, and how is that impacting your business?
So China's the largest elevator market in the globe, and of the about 1 million units in the market segment last year, over 650,000 in 21 were in China. We are basically predicting this year, or planning, I should say, that the China book and bill business for us, that segment will be down about 5 to 10%, which gets you back to 2020 levels. So it's still a tremendous market. We're growing our service business in China. We grew it, our portfolio grew high teens last year. This is really, there's going to be 7 million installed units in China out of 20 million in the globe. China's an important market, but it's going to be just as important as a service market, and we're experiencing high growth there and good returns. It's accretive to our margin.
I'll have to give you my address, Judy. I need one of those elevators with a big screen in it. I'm just saying. But always good to get some time with you. Otis CEO Judy Marks. We'll talk to you soon. All right, coming up, producer prices jumped again in January as CPI hit a 40-year high last month. Our next guest argues that retailers are returning billions to shareholders at the expense of workers. Her thesis after the break.
Well, inflation continues to be in focus from Wall Street to Main Street to Washington. The producer price index soaring nearly 20% or 10% in January from a year ago. And our next guest recently testified on Capitol Hill on pricing and the root cause of the price spikes. Let's bring in Rakeen Mahbood. She's a chief economist at Groundwork, and we should mention Groundwork is an economic policy think tank based in DC. Rakeen, it's good to talk to you today. You say that the price pressures that we're seeing right now is all about pandemic profiteering. What do you mean by that? What are you seeing?
Yeah, thanks for having me. So, my organization, the Groundwork Collaborative, has combed through hundreds and hundreds of earnings calls. And this is where CEOs are obviously telling their investors what they're seeing in terms of, their financial situations. And what we see is across sectors, across companies, CEOs are just crowing about how they can raise prices on consumers, all while bringing in record profits. And that's really the root of a lot of the price increases that we've been seeing over recent periods.
Rakeen, it's Brian here. It's great to chat with you about this because it's such an interesting and important topic, because some of these price increases could be just part of the organic higher labor costs. For example, if they're paying their employees more, maybe it's not as nefarious if they have to raise the cost of what they're selling to make sure that they can meet their margins. But on the other hand, there is anecdotal evidence in some cases of a price gouging, in which case a heavily concentrated industry with one or two major players can charge whatever they want to charge. So how do you kind of parse out what's happening behind a company's decision to raise prices and whether it's for a more nefarious reason than another?
Yeah, let me take the wage point first, because I think that one is pretty important. There's a good amount of research that shows that wages and prices are not linked right now. So the sectors where we're seeing the highest price increases are not the sectors where wages are actually going up. So wages don't seem to be a driver at all with the current price increases. And in terms of how we can see nefarious intent, don't take my word for it. We have hundreds of earnings calls that show exactly that. So let's take what might be a typical day, right? You wake up, you want a cup of coffee. I know I did this morning. You head to Starbucks. Starbucks has raised prices across the board. They've also seen their profits go up about 30%. Maybe for lunch, you want to get Chipotle. Chipotle's CEO has really been talking on their earnings calls about how they're so lucky that their consumers are not reacting to the price increases. And they see that their ability to raise prices is a real strength for the business. Maybe in the afternoon, you stop by a drugstore because you realize we're still in a pandemic and you need some high quality masks. Well, Kimberly-Clark, which is one of the major producers of N95s in the country, between October and January, a 50-pack box of N95 masks, the price of that more than doubled, right? And that is exactly in the period when the CDC changed its guidance to suggest that we all switch to higher quality masks. As you're heading home, you're going to pick up some stuff from the grocery store. You stop by Kroger's. Kroger's CEO has said that, quote, a little bit of inflation is always good for our business. Maybe you head to the meat section, pick up some chicken or some beef. Tyson, which is one of the 4 big meat packers, identified by the Biden administration as an industry where there is actually a lot of price gouging. Tyson's poultry prices, they've risen them about 20%. Their beef prices, they've risen about 30%, and they've seen profits nearly double. And then maybe, it's been a long and frankly quite expensive day. Maybe you stop by the section in the grocery store and pick up a couple of beers. Constellation Brands, which is a big umbrella company for brands like Modelo and Corona, has also been raising prices and has been really clear that what they want to do is, quote, take as much as we can vis-a-vis pricing from what they've identified as their primarily Hispanic consumer base. And so essentially what we see, the earnings calls are really the receipts of what's happening right now. Prices are going up across the board, and a large part of that is being driven by corporations who are really, we see it in their profit margins. It's not just that profits are going up, it's that profit margins are going up.
Rakeen, I wonder if I can play devil's advocate here, because we have also been listening to all the earnings calls, and we have noticed that, we hear from CEOs who have to explain to investors, to shareholders, about how exactly the money is being used. And in the case of a company like Chipotle, and they're not just the only one, when we see the price increase, the share price has moved also up. So what do you say to those who say this is just the obligation that companies have to shareholders? If that's the case, what needs to change about the structure?
Yeah, I mean, the Kimberly-Clark example, I think, is a really interesting one. On their earnings call, they actually reported a pretty bad quarter. Yet they told their investors, don't worry, we're still going to get your money and we're going to make up that bad quarter by raising prices on consumers. And frankly, what we're seeing is not a new problem. We're seeing these companies use the cloak of inflation to raise prices, but that cloak has been built over the course of decades. We have seen, my organization, Groundwork Collaborative, partner with the American Prospect to dig deep into the supply chain. And what we found is 50 years of deregulation, financialization, and rampant corporate concentration that basically created a bunch of mega companies and turned our supply chains over to those same mega companies. What they did with that power, they built this incredibly brittle supply chain. So that means that, if one link in that supply chain breaks, the whole system breaks down and prices go up, or we see supply bottlenecks, which we've been hearing about. But a really brittle supply chain, that just-in-time supply chain, also allows them to boost short-term profits. So they've built a system that works for them, but not for anyone else. And at the end of the day, these companies are using those bottlenecks, those supply shortages, those very real price increases, but adding just a little bit on top to pad those profit margins. And addressing the situation we're seeing now is really going to take a lot of tools across the toolbox.
Yeah, and everyone feeling the pinch of those higher prices across the board. But thanks so much for breaking all that down for us. Rakeem Mahbood, Groundwork Collaborative Chief Economist and Managing Director of Policy and Research. Thanks for stopping by this afternoon. Coming up on the other side of this break, masks off. As the Omicron wave slows down in the United States, some cities are starting to lift mask mandates and not requiring proof of vaccinations. We'll have the details after the break. Welcome back to Yahoo Finance. The latest jurisdiction to make some moves on mask mandates and vaccine mandates is Washington, D.C. The announcement February 15th, the vaccine mandate will expire, and then February 28th, the indoor mask mandate will expire. Let's get a little bit more on what this means, as well as other jurisdictions that are in focus with their mandates. Yahoo Finance's Anjali Khemlani here with all the details. Anj.
That's right, Brian. As you mentioned, DC, the latest to join in dropping some mandates. We know that this has been happening across the country, especially for masking indoors. And this happened at a time where really DC was about to actually mandate 2 doses be required rather than the one that had been a requirement for DC diners until recently. So that is now in place, joining several other countries. We know that on the coasts in particular, here in the Northeast, as well as along the West Coast, we've seen these states roll back some of these protections as we've seen cases drop. We know right now that cases continue to drop, hospitalizations continue to drop. Deaths are still on the downward climb, though still at concerning levels at about 2,400 per day on average. So that's where things stand now when it comes to specifically the virus and the restrictions there.
Anjali, what about the vaccine mandates specifically? Masks are coming off, vaccine mandates are still in place, and it sounds like a lot of offices are now revisiting that timeline for return to the office.
That's right. With Omicron out of the way, we're definitely seeing that. As it stands right now, we know that New York City, of course, had to let go of over 1,400 individuals who did not comply with the vaccine mandate deadline, largely seeing educators or those that work for the Department of Education laid off as a result of this. Meanwhile, we see Microsoft looking for a back to work, specifically in Washington and California, by the end of the month. So that really is going to start to trigger a lot more conversations about the return to office. Not quite clear on, how many others will be on board. We know we heard from Expedia as well. So it really is going to be interesting to see how that plays out. We know that the 2022 outlook is not over yet. The virus could still make a comeback. We could still see surges. So really interesting to see how that plays out. And especially as we know here in the US, vaccines and vaccination rates have really plateaued when it comes to adults, especially for booster doses. That has been slowing down. We also know that kids, especially those who are eligible, as much as there is a focus on the under 5 age group, the over 5 age group has really stagnated at roughly 20% right now. So it really is a mixed picture, and we have to see how that plays out for the rest of the year.
Okay, Anjali Khemlani bringing us the latest there. Thanks so much for that. Coming up, more trouble for Didi. The latest woes for the ride-hailing giant as the Uber rival reportedly plans to reduce 20% of its workforce before going public in Hong Kong. We'll be right back. Welcome back to Yahoo Finance Live. We are seeing shares of chip makers up broadly in the session today. NVIDIA among the leaders, with that stock up more than 6% ahead of earnings after the bell today. Let's bring in Ines Frey for a preview. Ines.
Yeah, that's right, Akiko. NVIDIA right now up more than 60%, as you were just mentioning. NVIDIA and AMD are leading the semis higher. Let's take a look at our Wi-Fi interactive board. You can see a lot of green on the screen with the semiconductors. NVIDIA will be reporting on February 16th. That's tomorrow. Piper Sandler is expecting a significant beat and raise on its gaming and data center business. Intel is up about 1% after announcing that it will be buying Tower Semiconductor for about $5.4 billion. So we are seeing quite a bit. We're also watching Qualcomm up more than 3% as well. Let's take a look also at another chart that is seeing gains right now, and that's the travel space. Take a look. A lot of green here on the screen, except for this one right here. Avis down 11% after the company reported its quarterly results, beating on profit and revenue. Revenue per day in the Americas coming in short of what Wall Street had been estimating. That's why you're seeing some pressure on the stock, even though some Wall Street analysts called it a solid quarter. As far as ratings on the stock's concerned, the stock has 2 buys, 4 hold, and 2 sells. And keep in mind that last year, Avis gained about 455% in 2021 alone. Year to date, the stock is down about 17%. Akiko, Brian?
And as a follow-up, want to call attention to Didi, the Chinese ride-hailing service. Apparently, they're going to be cutting about 20% of their headcount. This is another bad development for a company that's had a rough go at it as of late.
It has had a very rough go. The company went public on the New York Stock Exchange last year, and shortly after that, you'll recall that Chinese regulators opened up an investigation on its user privacy. So basically, that app had been yanked from in China from the App Store, so it hasn't been able to register new users. So its market share has shrunk since all of this chaos, and also as far as the cuts are concerned that the company is having, according to reports. It's cutting about 20% of its staff. Some of it has to do, a lot of it has to do with its grocery delivery business. As far as its international and autonomous driving, that will be intact. But if you take a look at the stock, let me find it here on our China board right here. We're seeing Didi down about 1%. Year to date, it's down 15%. And since it went public last year, those ADRs at $14 a share down about 70% from its IPO last year. Of course, we know that it will be delisting from the New York Stock Exchange, and it will be listing on the Hong Kong Exchange. Brian, Akiko?
Yahoo Finance's Ines Frey. Thanks so much. We'll have more market coverage right here on Yahoo Finance right after this break. Welcome back to Yahoo Finance. You know, the Super Bowl had its moments on Sunday. Those who tuned in to see the Bengals lose were treated to at least a close game. But ultimately, it's all about the numbers and the ratings and how successful it was for NBC, which carried the telecast. Yahoo Finance's Josh Schaefer is here with the preliminary count on how many people tuned in for the big game. Josh, what are the numbers?
Yeah, Brian, this was the most watched Super Bowl in 5 years, according to NBC. So the total audience delivery came in at an average of 112.3 million viewers. And so to kind of break that down and compare it to years past, a few numbers to get into here. It's a big increase from last year. Last year's Super Bowl was the least watched Super Bowl in about 15 years. It attracted 96.4 million viewers. So we kind of saw Super Bowl audience bottom out last year and kick back up this year. Now, this year's number includes a big amount of streamers. NBC says that this was the most streamed Super Bowl ever, with 11.2 million streamers. So the number you're seeing on your screen right now didn't include the streaming. When you put in that streaming number, it goes up pretty high, and it was a big day for Peacock. Another important number to hit on too was Telemundo televised the Super Bowl on Sunday. So it was the biggest Spanish language broadcast we've ever seen, averaging 1.9 million viewers. Biggest Spanish language football broadcast, that is. And really the big takeaway here for NBC and Peacock is that these numbers came at a time when NBC really needed them. We've been talking about the Olympics numbers for the past week and how those weren't really where people had hoped, down about 40%, depending on the day, going back to 2018. Well, NBC hit a home run on the Olympics Sunday night. They had 24 million viewers, and that's the largest NBC primetime audience for the Olympics going back to the opening Sunday of 2018. So NBC finally got that tailwind they hoped for from the Super Bowl with the Olympics coverage that followed right after the Super Bowl on Sunday night. A final number for you guys here that I know Akiko might not like, but Brian, maybe you and I can smile about it. The local markets number. Cincinnati led with a 46.1 rating. And I was looking through the top 10 and I had to search for it to look for Los Angeles, but I couldn't find it. It isn't in the top 10. LA delivered a 36.7 rating. Akiko, the Rams fans might not have been in the stadium, and it doesn't even seem like they turned on the TV for the game.
Wow.
There's a lot of things to do in LA, right? I mean, that's always the excuse. I will not make that excuse. LA needed to show up. Thank God the Rams won. But I am curious to what extent this win, will sort of propel the team into a bigger presence in LA. I mean, we've talked about this before, Brian, that it's not a football town right now. As bad as the Lakers are, people are still watching. And, hopefully when the lockout ends, the Dodgers are going to be playing too. So there is talk, by the way, of a championship for all three teams, which is what I would counter with. The Lakers in 2020, the Dodgers, and the Rams.
Yeah, I was going to say no love for the Chargers or the Clippers, but we'll just leave that conversation right there. Yahoo Finance's Josh Schaefer, thanks so much. And just one last look at the markets before we go. Everything in the green, S&P 500 and Dow up 1%, and the NASDAQ up 1.5%. But that does it for Akiko and I in the 11 to 1 hours. More market coverage with Alexis Christoforous and Karina Mitchell for the next 2 hours. We'll see you tomorrow.
Welcome to A Time for Change. I'm Marquise Francis, joined by Alexis Christophorus. Today, we begin by turning a lens back on our industry, the media. Nielsen, the company that tracks audience behavior, just announced a new initiative, this time to measure the reach and impact of minority-owned media companies. It's called the Diversity Media Equity Program, and it's designed to quantify the value of diverse media companies to advertisers.
And here to talk about the changing media landscape is veteran journalist and philanthropist Soledad O'Brien. Soledad, it's great to meet you and welcome to Yahoo Finance.
It's so great to meet you guys as well. Thanks for having me. I appreciate it.
Yeah, it's amazing. You and I have been doing this for a hot minute and we've never really met before. So it's a personal pleasure to welcome you to the show, Soledad.
I was thinking the exact same thing, Alexa. I was like, we literally have been doing this for a long time separately. And it's so nice to get to meet you finally, sort of kind of in person-ish, I guess. Exactly.
Yeah, I know. Well, we'll do it again when we're all back in the studio when it'll be fun. But this will do for now. I'll definitely take the virtual. So Soledad, this Nielsen report, we dug into it a little bit. And as Marquis said, it highlights the power of diverse-owned media. And one of the big takeaways for me was that in markets with Black-owned media, almost half of all Black viewers typically watch the evening news. Now, if that's the case, are traditional media companies, you think, missing out on a big opportunity here? And are we at the point where these smaller media companies are giving those established networks like NBC, like CNN, a real run for their money?
Yeah, I think part of the problem has been how I have seen it always historically work, which is news directors kind of have a gut about their community and their audience. And often that gut is wrong. So a gut in cable news might tell you two congressmen screaming at each other is amazing television. I might argue it is not, right? So you end up sort of creating this programming that oftentimes is based around what the leadership thinks is their audience. And I think when you don't really know your audience, or you don't think that, for example, if you think your evening audience, are you thinking African Americans? Are you thinking like, wow, actually there's a whole bunch of people that we could capture, that our audience doesn't necessarily have to be what just the news director thinks. And when you create a lot of diverse programming, I think you have this tremendous opportunity to bring more people in. We found this when we did a zillion years ago now, Black in America. And I remember for CNN, and I remember, there was like the unspoken, kind of spoken, don't make it too Black. Like, we have a white viewership. We want to not push them away, but we'd like to, grow our Black viewership. And what we actually found was that kind of program. I mean, it was pretty Black. It was called Black in America, but it grew the white audience as well as the Black audience. And when we did Latino in America, interestingly, Latino in America grew our Black audience, right? So I think there are all these sorts of senses and takes on what an audience wants and likes. And often it's just not accurate.
Mm-hmm. Yeah, and to that point, Soledad, speaking of diverse content, one of your latest projects is the HBO documentary called Black and Missing. And you really highlight how hard it is to get the attention of both media and even the police to search after these Black missing people in America. So I'm just curious, how hard was it, number one, to sell that show? And I'm curious, what was your biggest learning?
Yeah, that show is streaming right now on HBO Max. And it wasn't so hard because I think HBO is always sort of willing to do an edgy topic. But really, it was very critical, both of law enforcement and media, when it comes to, well, why is there what our colleague who passed away now many years ago, Gwen Ifill, used to call missing white woman syndrome, which was people would just go crazy. Media coverage, law enforcement, and regular people. You guys are too young for that, but Alexis and I remember that during the Natalee Holloway, not that we have just been around a minute, during the Natalee Holloway, when she was missing, literally there were people getting on planes to go to Aruba to search for that young woman. And I interviewed her mom a zillion times, and deservedly so. She deserved a lot of airtime. It was a horrific story. But what you find is that young women in a similar situation who are women of color, Black women, don't get that same kind of coverage. And this is the question we wanted to ask, was why the foundation, Black and Missing Foundation, really was established to help the loved ones of people who've gone missing, one, get the attention of the media, get the attention of law enforcement, get the attention of the community as well. But that's a really good example of a gap. And often, you'll say, well, but why is this woman's story not as interesting to you? Right? I mean, a weird circumstance, a dramatic story, an attractive young woman. And you realize that at the end of the day, it comes down to to an individual personally, they just didn't think that girl was important. Her story was interesting. Her story would be relevant to the audience, whoever that audience is. And also often they just didn't think she was cute enough, that she just wasn't what they perceived to be the attractive damsel in distress. I wish I were making that up, but I am not.
Yeah, that's a sad reality. And we see it, infiltrate all sorts of media to this day, which brings me to Black in America, which you talked about just a minute ago, all the way back in 2008, your series on CNN. Since then, what kinds of changes have you seen in the kinds of stories that are being told, Soledad, but also in the people who were telling those stories?
You definitely see changes. I think you see more diversity on camera, but as all of us know, the real power, right, is the person in the meeting that talks about what the direction of the network is going to be. So that's not always the anchor. The anchor, I think, has a fair amount of power, but often the person who's the executive producer or even the news president, right, is really deciding what the agenda of the network is going to be. Also, that's a position that can hire people. So hiring positions always mean that you have much more power to decide kind of what the tenor of the network is going to be in terms of demographics in the layout of the staff. So yeah, I think I've seen certainly more diversity in front of the camera, which is a big plus. But I would like to see more diversity in the higher ranking positions in newsrooms across the board. And I think that has been very slow to change. And if you look at the number of Latinos in newsrooms, that is crazy. Those numbers are so incredibly low. We don't even have to talk about Native Americans because they basically don't exist, as horrifying as that is to say. And Asian Americans is very, very low. I mean, there was a local reporter in New York who was interviewed the other day talking about how, the person who was interviewing, who was a person he knew well, a friend, said, I don't find Asian American men attractive. They scare me. How are you supposed to move ahead if people are very clear, like they don't find you attractive or your race attractive, and they don't find you, they find you scary. I mean, I don't know how you can hope to be successful in that kind of an environment.
Yeah, really nauseating stories there. And recently, Soledad, you spoke at Carnegie Mellon University, and you said, we've taken that step back for years when talking about race and equality. And I bet a lot of people right after the George Floyd murder would have thought, okay, America, now we're in a new place. We've taken so many steps forward. But I actually understand your sentiment in taking a few steps back. And I'd love for you to expound on that. What does that look like? And I know on social media, particularly, I love the fact that you call out media companies. So I'd love for you to send a message to folks who may be watching this or maybe going to see this after the fact. What can media do a better job at when covering these kind of stories?
Yeah, I'll answer the second part first, which is I have found, and it's so not incredibly wow as a response, just track it. What we have done, I anchor a syndicated show that we co-produce with Hearst TV, which is called Matter of Fact with Soledad O'Brien. And what we started to do, because our tagline is stories as diverse as America, was to track it. Are we actually telling stories as diverse as America? Who do we put on TV? And we have a spreadsheet that tracks who is on our air. That's it. We just make sure we do it. And you see your own bias when you start to track those things. You really begin to determine how are we telling these stories? For example, if we did missing person stories, would we find wow, it seems like all the missing people stories we're doing are young white women. That's interesting. I wonder why. So I think one way to really make a change is to start tracking and holding yourself accountable, because I do think sometimes those errors or the lack of insight is not intentional. It's just bias, and you just don't necessarily see those big gaping holes, again, because you feel comfortable, but you have a sense oh, I am my audience. And often I am not my audience. My audience is very diverse. And so I need to make sure I'm covering a lot of ground, number one. Yeah, I do think we take a step back because I think TV news loves to be very self-congratulatory versus, you know, coming up with a plan. If we were not talking about diversity, but we were talking about refrigerators, right? We would map it out. We would have goals. We would come back every month and assess those goals. How did we do? Where are we falling short? How do we fix it? Why are we falling short? You know, if it were just a product, like a regular product, we would have no problem saying like, here's what we're trying to get to. And I think we have a real challenge often in holding ourselves accountable and really thinking about like, what do we want to get to and how do we get there? So yeah, in the wake of George Floyd, everyone was like, kumbaya, this is amazing. Well, it's only amazing if you see actual tangible change over time. You know, doing one special, doing one event, hiring one person is not actual change. What really makes change is where are you hiring people from? You don't be baffled that you can't find any Black employees when you actually, you know, go and recruit at Harvard and Yale and not at organizations that serve overwhelming numbers of Black people. You know, recruit in both places. And so I think it's just really all about holding oneself accountable, which at the end of the day isn't so complicated.
Soledad O'Brien, we can go on and on here, but such a pleasure to have you on. We'll do it again when we can do this in person. Thanks so much for being with us.
Nice to see you both. Thank you so much.
All right, still ahead here on A Time for Change, what global computer giant HP is doing to diversify tech. Welcome back to A Time for Change. We are midway through Black History Month when companies go out of their way to show support, whether genuine or not. HP's chief information officer is one of a handful of Black execs at Fortune 500 companies, and he shared his thoughts on whether or not the month still holds any true value. Here's Anjali Kamlani.
That's right, Alexis. I spoke to its chief officer, Ron Guerrier, about a number of things, and really HP right now holding a really good record when it comes to looking at the numbers. 54% of board members are minorities, 27% of its US employees are diverse, though only 3.8% are Black. So that's really important to keep in mind. Ron told me that he, the son of Haitian immigrants, is often the only Black person in the room. And I spoke to him about that and what he's doing to open the door for others.
My concerns are the same concerns I've had over the last 25 years in IT.
is how do we diversify and get more people excited of color, Latinos, Blacks, into technology, not just in the technology that we use, the hardware and the great products that we offer here at HP, but getting into the world of technology, artificial intelligence, machine learning, all that. It's very important for us to expand our aperture and bring in more people of color into this industry.
I know that you've talked about it just now, really just that constant focus, and it's 25 years is quite a long time. I think we can all agree that there are still some concerns about the progress being made on this. And so I've seen strategies over the years being implemented, especially for hiring processes, right? Things like blinding candidates' names and genders. I'm sure you know this. What strategies have you really used and seen that help to actually move the needle? And how much work do you still think there needs to be done in order to sort of achieve really true diversity?
Great question, Anjali. And so one of the main reasons that drew me to HP was the just history of diversity since Bill and Dave founded this organization, essentially that founded Silicon Valley. And so there's many things you could do. You can be very intentional and say, we are going to do X, and you put strategies in place. And those strategies, in my opinion, they work on a broader scale, but we need more people to get more involved in younger parts of kids' lives, getting into the Black and brown communities, explain to them what they could do with their careers, making the investments in those areas are just going to change the game. And so at HP, we have the Diversity Equality Task Force, for example. There's many different things we're doing where we're partnering with HBCUs to make sure that we are actually going to where the talent is and really talking about the curriculum they need to build so we can hire that great talent. So HP is doing a lot of it. But again, my biggest concern, and this is where I love joining and working here, is that it has to be part of the fabric of the organization. It can't just be a flavor of the month, lack of a better term. It's got to be something that we strive through year in and year out and hold ourselves accountable to those numbers and those efforts.
How do you do that? Can you explain maybe behind the scenes, like, are there metrics that are used? How do you ensure sort of growing in that direction?
Correct. And so one of the things, many things we do is we want to make sure we have a diverse palette of resources, diverse palette of candidates. And so what we do is we actively go out, we partner with Black-owned businesses, Latino-owned businesses, women-focused organizations, and help try to recruit from those organizations, get out into the network and talk to them about what HP has to offer. There's a lot of great things happening here at HP. So how do you get them excited about not just the problems that we have to fix, but the problems that we solve for our customers? And that's something our CEO, Enrique Lores, talks about a great deal. Another thing that we're doing that I think is pretty exciting is that we have a lot of suppliers that help us with our products and a lot of our services. And so what we're doing is we're diversifying our supplier base. We want to ensure that certain metrics, that we're hiring a certain number of Black-owned companies, Hispanic-owned companies, to make sure that we're working with them. And we see that as a multiplier effect. So if we hire those companies, they in turn will hire other companies and bring in more diverse talent to our ecosystem. I think that's extremely important.
I'm glad you brought up supplier diversity. That's something that has been seen as a really effective strategy over the years. But part of the problem still remains with that, the red tape that goes with it. You need to prove scalability. Yeah. Some of the smaller businesses tend to get left out sometimes. So I wonder, is there a solution for that? Or because it's sort of a catch-22. They need the experience to work with you, but you're the experience they need to work with you.
You're right. It's kind of a catch-22. And the thing that I really enjoy, I've worked in private sector for most of my career. For 2 years, I worked in the public sector. And so I was able to see on the other side what it's like to get other companies excited and jazzed and invest into these companies. And so you're absolutely correct. The capital is sometimes not the greatest, but they need that experience to find that next opportunity. So what we're doing is we're actually bringing in diverse-owned companies, Black-owned, Hispanic-owned, women-owned companies, and we're actually having interview panels. And our IT leadership team can interview different opportunities, and we bring them in for projects. And the most important thing, Anjali, I think is pretty exciting. We're not bringing them in as staff augmentation to bring them in just to supplement and complement our team. That's clearly one way you could do it. But what we're doing, I think, is a little bit different. Hopefully, it's going to be kind of more sustainable. We're bringing them in for strategic projects. These are big projects that we're working on, and they can put this on their resume. And they say they helped this great organization move this forward. And of course, it builds up their kind of plan of record. And other companies will say, hey, they did this exceptional work with HP, they could do it for us. So we're really bringing them on to be more strategic partners as opposed to staff augmentation providers. And I think that is a huge change. Again, learned that from the public sector, and now I'm hopefully applying that back into the private sector.
Any issues with supplier diversity considering the chip shortage? Do you feel like that helps or hurts the situation? Can you still afford to really do this at such a time?
Absolutely. I believe we absolutely should. And now's the time to do even more. And the reason I kind of flip it is because now's the time that diversity is needed more than ever. Because usually when there's a chip shortage or shortage of any kind, you fall back on those big companies, those big opportunities. Now's the time to give those small organizations an opportunity and a leg up, right? And so now's the time to actually do more of that. And we're actually doing that. So we have some really hard objectives that we're working towards so we can make sure that part of our spend goes to a lot of these diverse owned companies.
Tell me about your experience, Ron, because I feel like that's always, that always really helps you. It's a skill you have, having been the only Black person in a room sometimes. And I know we've heard many of these stories of some of the executives, a few that there are in these positions, who have faced some of the same problems as your everyday person, despite the levels of success you've reached. How have you maneuvered around these? And what advice can you possibly give to someone younger who's looking up to you?
That's a great question. It's one that I'm learning along the way. 25 years seems like a long time, quarter of a century in IT. What happened? But with that being said, I've learned a lot. And so before the term microaggression became a term, I would go to conferences. I would actually be the keynote speaker, but people would not know that. And they would look around the room, and several times, full stop, they would assume that I am the valet or I am the coffee attendant. And they would ask me, where's the coffee? And a few times, Anjali, I did not even get it. It was over my head. And I realized they're asking me to get them coffee. They're asking me to get them their car. And I'm looking at them, I'm a little confused, and then it dawns on me. They assume that I am the only person of color in the room. Therefore, whatever, they assume that I'm the one to help serve them here. And so what I've done in those times is there's moments where you have a moment. And in the moment, something my mom always told me, what is the learning from this? How could you improve the people around you? So I would have a conversation with them, say, I think you were mistaken. I'm actually the keynote. I work for this organization. I am a peer of yours. Let's talk about this. Sometimes it's a great conversation, and some of those individuals are still friends today. Sometimes it goes in deaf ears and they walk away, and there was that moment. But for me, those are the things I really kind of just take and I process, right? But what I do when I talk to young talent is I always tell them, bet on yourself. It's very important that if you don't bet on yourself, no one else will bet on you. Also, when you see a job opportunity, a lot of times minorities, women, they say, well, I don't do all 10 things, therefore I'm not going to apply for it. Go for it. If there's 7 of the 10 things that you're really good at, go for those. Go for that opportunity. You never know what they're really looking for. So you really have to make a bet on yourself. And the last thing I'll say broadly, and I'll say this to everyone, doesn't matter what race, creed, color, is speak your voice. You have to speak your voice. I've been in boardrooms, as you may know, I'm on a board also and several boards, and there's a lot of pre-meetings you have. And in those pre-meetings, everyone has a great idea. But when it comes down to the board meeting, there's wallflowers, right? And usually it's a minority or it's a female in the room. And I usually try to call out on them, not embarrass them, say, hey, Jan, John, Jerome, you had a great question during the pre-meeting. What are your thoughts? And you kind of bring it into the room. So as leaders, I think we have to make sure inclusion is an action, not just a statement. So I think it's very important that we do that. But that's a great question. And again, I started as a repo agent for an automotive company. And, I became a CIO. So if you don't bet on yourself, who else is going to do it?
Welcome back to A Time for Change. Black History Month is in full swing. Some people think it's time we move on from a single month to honor Black Americans. I talked to HP's Chief Information Officer, Ron Guerrier, to ask his thoughts on whether or not the month still holds any true value for companies and the culture at large.
I do believe it's important to highlight the value and contributions of Black Americans, African Americans in the United States, right? No different than Latino month, Women's Month. So I do believe there's value in that. But the other thing is just it gives kids, young kids of color, just an opportunity to really learn and focus on their history. Now we have 12 months to do that, of course, but that 1 month of focus is really exciting, right? You learn new things, and I learn new things all the time. My background is Haitian American, right? And I still learn a lot from my African American friends and colleagues. And so there's so much to learn. And I think this 1 month of focus is great. And the last thing on that statement is for corporations to focus on it and really talk about it, it's good to have the conversation. The absence of conversation, it just falls in the background as white noise. And it shouldn't be white noise, it should be brought to the forefront. So I definitely support it. I think it makes sense. But again, it should be for all 12 months that we talk about all these issues, not just for 28 days or 29 if you're talking about that every 4 years.
So as you can hear, really a lot to think about. There's still some value and still some learning, as we know. Haitian Americans not necessarily well versed as African Americans on the culture and history. So definitely something to keep in mind. That's our show for now. I'm Anjali Khemlani. For myself, Marquise Francis, and Alexis Christoforous, thank you for watching. But stay with us. There is still lots more ahead on Yahoo Finance Live.
Mixed messages. Russia says it will pull back some troops from around Ukraine, a potential sign of de-escalation, but other military drills are continuing. Investors try to make sense of it all. More proof that inflation is everywhere. Prices paid to U.S. producers jumped more than expected in January, thanks to ongoing supply chain and labor constraints. Does it give the Fed ammunition to front load those interest rate hikes? And what's your price for flight? Richard Branson's Virgin Galactic gets set to reopen ticket sales to the public. We have everything you need to know about buying a ride to the edge of space and back. Hello, everyone. Welcome to Yahoo Finance Live. I'm Alexis Christoforous, along with Karina Mitchell, and stocks are staging, we'll call it a relief rally for now, as investors' concerns over Ukraine begin to ease. And Karina, it looks like the S&P 500 on track to snap a three-day losing streak.
Indeed, indeed. A relief rally is definitely underway. Geopolitics and inflation, a big part of the market story today, that as there are signs from President Putin that a partial troop pullback by Russia is on the cards, and that is lifting the benchmarks. If we look at them right now, the Dow is up by 417 points. That is at a session high right now. So snapping a three-day losing streak. The S&P is better by 63 points, heading towards its best day in 2 weeks. The NASDAQ, of course, outperforming right now, as you can see, up by more than 2% there. Sector-wise, let's take a look. The materials are leading the winners there. Consumer discretionary, tech, industrials, all leading the gains. The only loser right now is energy, as oil slips on those possible easing of geopolitical tensions. So oil slipping from a 7-year high. Over to the bond market. Let's take a quick look, if we can, at the 10-year, which is up well above 2. The last time I looked, up 2.04%. The 30-year up at 2.35%, and helping drive that gain, of course, the hot PPI data that we got showing a climb of 1% year over year to 9.7%. And of course, as tensions cool, Russia saying it has begun retreating or removing some of those troops and sending them back to the home base. With more on all of this and what's moving markets, let's bring in our Yahoo Finance's Jared Blickery. A lot going on today.
Yes, there is. And a bit of a relief rally, as we've been talking about, but we're not out of the woods yet. We have the Dow up 400 points. And by the way, the leadership is pretty broad-based today. The NASDAQ up 2%. We're seeing financials and energy and tech participate, along with consumer discretionary. So not just the value, but the growth stocks as well. This is a 2-month view of the S&P 500. And as you said, over the last 3 days, we've seen a bit of a slide here. Now, I want to point out that we are coming back to this area where we broke down out of this trading range 2 days ago, 2 sessions ago. And so it's going to be critical to see what happens around anywhere from 44.50 up to 4,500. That's where shorts would reignite their short positions and potentially drive the market lower, but it remains to be seen. It's possible that we end up breaking to the upside here, in which case we're probably going to make a run at these record highs that we reached towards the beginning of the year. And as you said, 10-year T-note yield, that is up again to, it looks like we didn't take this out, but we are right near multi-year highs in some of these yields. And we're also taking a look at the sector action. And as I was talking about before, pretty broad-based here. Tech and consumer discretionary, each of those are up more than 2%. Now we have materials, industrials, and financials, each of those outperforming as well. And you can really see some of the love in the market in the NASDAQ 100. That's where a lot of these gains are being made. Tesla up nearly 5%, Nvidia up 8% ahead of its earnings after the bell tomorrow. Microsoft and Apple each up more than 1%. And chip stocks really flying high today. I mentioned the Nvidia earnings, but also AMD just taking over Xilinx. That merger closed yesterday. Intel on its way to buying Tower Semi. So lots going on in the semiconductor market. And we have to look at the ARC components as well, because these are an important sentiment indicator. And we can see that some of these companies like Beam Therapeutics, Intelia, each of those up 8 and 6% respectively. So in terms of sentiment, and I'm going to go to my leaders board, really seeing a lot of these sectors flying high. So we got solar energy, we have chip stocks, we have ARC, we have cannabis, we have Chinese stocks, we have IPOs and retail. All of those are strongly outperforming today. We've seen this risk on, risk off behavior several times this year. And I would just point out that with the VIX north of 20, we have to be at least alert for the possibility that this is just going to be sold into.
Yeah, excellent point. You got to be ready for the volatility. All right, let's stick with the markets now. Bring in Louis Navellier. He is founder and chief investment officer at Navellier and Associates. Louis, it's good to have you here. Clearly, this is a market that is driven by the headlines right now. We know those headlines seem to be changing hour to hour. What is an investor to do?
Well, investors have to realize that their best inflation hedge is stocks. We saw it with any company that can raise prices. That was Procter & Gamble, Levi's, and Tyson Foods. And the semis are on a tear right now. Obviously, have a big order backlog. NVIDIA is acting very good ahead of its earnings announcement. But earnings are working, and but companies not only have to beat, they have to provide good guidance.
So in terms of what's happening between Russia and Ukraine and how that's affecting the markets, do you think that will play into the Federal Reserve's decision as to when they're going to raise interest rates? Let's say, for instance, there is an escalation of the conflict between Russia and Ukraine. Does that mean the Fed begs off and doesn't raise interest rates right now?
I think the Fed wants to stay the course, to be honest with you. The truth of the matter is the Fed doesn't like to vary from its plot that it has. I'm in the camp that they'll do 3 to 4 rate increases this year. I think what Jim Bullard's doing is just undermining the Fed's credibility. Jerome Powell's a consensus builder, and in the end, they're going to do what the consensus wants. If they do 50 basis points at the end of March, it's not going to be a surprise. But let's face it, even if you raise rates 4 times, a full 1%, that's not going to put a dent in this inflation. This inflation is structural, and it's just not going to be resolved by the Fed.
So what will resolve it? Just time? The fact that we need to pass through this pandemic and supply chain issues need to loosen up?
Well, what would resolve it is a recession. And we're not going to have that right now. Obviously, we're coming off very strong economic growth, but the world has to slow down and demand has to drop. The problem with oil, there's more demand for oil in the spring than there is in the fall. There's more people in the northern hemisphere than southern hemisphere. So even if Russia doesn't invade, which I have Russian friends, they say this is all a big distraction so they can take over the economy of Belarus. The truth of the matter is, I think oil is going to remain very, very firm just because of strong worldwide demand. But yeah, the Fed has lost control of the inflation, and they're not going to be able to get a hold of it until we have a recession, and that's not in the cards.
We were just showing a graphic of oil. We know crude oil was getting closer to that $100 a barrel. I mean, it's down today quite a bit, off now about 4%. And energy is the only S&P 500 sector in the red today. What are you doing with regards to oil and investments in the energy space right now, Louis?
Well, we have a lot of big integrated oil companies that showed up, like a British Petroleum and things like that. Obviously, it's got a great dividend yield. We do like the EOGs of the world, the ConocoPhillips. Obviously, they're very busy in the Permian Basin. But the truth of the matter is the output of the U.S. has dropped. It was initially with the drilling ban, which a judge overturned, but the basin's having a bit of an issue with age. I realize we can tap North Dakota, but now we have to put all that on trains and trucks, and that's not very efficient. And so we're not going to be energy independent immediately. And then, of course, they did have a big auction offshore, but that got blocked in the courts. So we have to get used to energy prices where they are.
So St. Louis Fed President Bullard, you mentioned him a little while ago. You say he's maybe undermining Fed Chief Powell by saying what he's been saying. He's been talking about front-loading those interest rate hikes. And then yesterday he said, and if we were to have 5 interest rate hikes this year, they wouldn't negatively impact the economy or the stock market. Would you agree with that? Is that pretty much a baked-in scenario for investors at this time?
It's anticipated. We've had major strategists from big banks say 5 to 7 rate increases. Here's the problem. We have a $30 trillion deficit, okay, or debt. It's a cumulative federal debt. If they tax all of us at 100%, we're still going to have a $10 trillion deficit. So this is not going to be resolved by tax increases. It's not going to be resolved by raising rates too much. If they raise rates too much, it's going to kill us. Now, Jerome Powell at the end of the FOMC meeting said that he can't raise rates too much because of what's going on in Europe and elsewhere. You know, Japan's zero, Europe's was negative, now they're positive. So they're putting a cap on our rates. So, and we are doing this thing called modern monetary theory, which is unlimited money printing. This was pioneered by Mario Draghi in Europe when he was head of the ECB. He's now the Italian prime minister. And it's unfortunate, but we've gone beyond the point of no return. So we're going to have to learn to live with inflation, and we're going to have to look for inflation hedges, which is basically your home and the stock market.
All right, we're going to have to leave it there. Louis Navellier, founder and chief investment officer of Navellier and Associates. Thanks for joining us today. Karina?
Okay, great conversation there. And coming up, geopolitical risks front and center as we wade through the ebb and flow of talk and tensions between Russia and the Ukraine. More on that story coming up. Welcome back. Well, Russia's Vladimir Putin says he hopes for a diplomatic solution with the West as he announced a partial pullback of troops from Ukraine. Comments came during discussions with Germany's Olaf Scholz, but can we count on a troop drawdown? With more, let's bring in our next guest, Ed Mills, Raymond James Washington policy analyst. Ed, thanks so much for being here. So the headlines on the surface slightly better than 24 hours ago, but still so much uncertainty. And NATO saying they will believe it when they see it. And if an invasion comes, it could come very quickly, similar to how it did, when Crimea was invaded. What is your assessment, and what chances do you think that there is for escalation?
Karina, my general assessment is that we're going to be on at least a very high simmer for a foreseeable future. Putin has a lot of incentive to continue the pressure, but also to drag this out. You look at energy prices that are dollar denominated as he pursues this, as long as he still has customers, that's a benefit to the Russian economy, especially with a lower ruble. He sees political divisions here in the United States. He sees a European Union that has new leadership, and as you mentioned, within Germany, with the new kind of leader Scholz, you see a prime minister in Britain who's been weakened by scandal. So the longer he plays this out, the higher that simmer is, probably helps out President Putin. And I think that is the base case that the market has to expect at this time.
Let's talk about some of the sanctions. The U.S. says that it will act promptly and swiftly and harshly against Russia. So what are the sanctions that they could impose? And then what does that mean for our economy, as well as what it does for Russia, as far as our energy and our economy and that of Europe as well?
So we have a lot of adjectives to describe these sanctions. What we don't have are specifics. One of the issues with these sanctions is that for them to be effective, we have to work with our European allies to make sure that they get applied appropriately. But there is a disproportionate impact on the European economies versus the United States economy. One area where we could have an impact on the United States economy, Karina, is on oil prices. That is one of the key components of inflation metrics, and that's a key component on consumer confidence. So anything that continues this upward push on commodities, especially oil, natural gas, that could put political pressure on President Biden and harm kind of the political sentiment for congressional Democrats as we head into the midterm.
And then I want to talk about what market implications it has here. The Fed has been talking about moving more aggressively to tighten at this point. Do you think that this throws a wrench into that plan at all?
From a market perspective, we published a note earlier today here at Raymond James that we highlighted what we saw in terms of a reaction on Friday, which is certainly a risk-off environment. There can be a flight to safety, a flight away from technology, certainly a bid in energy, as we discussed previously. From a Federal Reserve perspective, it could flatten the yield curve, which could put some pressure on them to not be as aggressive as they'd want to be on some of the Fed funds hikes. But I do think that probably the underappreciated aspect of this is you go back to Powell's reconfirmation hearing before the Senate Banking Committee, and he talked a lot about the use of the balance sheet and kind of runoff, ability to have some level of curve control and other tools at his disposal beyond just raising rates. So I think that the Fed is going to be steady as it goes, but use other tools to achieve their desire to lower inflation, but keep the economy moving ahead.
And then, Ed, Putin said today to Scholz that energy cooperation is paramount to him. It's something that's very important. And I'm wondering, if sanctions are imposed, how likely is Russia to cut off Europe from energy supplies? Because Europe is so dependent on their energy. And, will Europe stay away from imports?
Yeah, so there is a interdependency here. As much as Germany and the rest of Europe are reliant on Russia's natural gas and oil, the Russian economy is very much reliant upon those payments. So I think right now the market expectation is that it's in Putin's best interest trying to keep as many of those sales going to boost the domestic economy within Russia. I don't see a scenario where Putin tries to hold off some of those sales because it is just too important to him economically, unless he's made the decision to invade. And that's where we look to some of the conversations that have occurred between Russia and China, seeing what agreements have been made there. Those are the wild card factors in this discussion.
And really quickly, how do you hedge against inflation and geopolitical risks at the same time? Because one involves cutting back on treasuries, one involves buying more treasuries.
So I think you have to kind of separate the noise, kind of identify high quality investments, things that probably have a decent yield, and stay the course. Don't let some of these headlines out of DC fundamentally alter your decision-making on a day-to-day basis. Let it inform some of the longer-term investment goals that you have.
Okay, thank you so much. Ed Mills, Raymond James, Washington policy analyst. Thanks for your perspective. Alexis?
All right, well, it's not exactly to the moon, but you can fly to the edge of space if you've got deep pockets. We've got the details coming up. Welcome back. Richard Branson's Virgin Galactic reopens ticket sales this week to the public. Yahoo Finance's Inez Ferre here now with all the details on how you can reserve your seat on a plane, Inez, that will take you to the edge of space and back. What can you tell us?
That's right. You just have to shell out $450,000, Alexis. These tickets will be going on sales. These reservations will be going on sale this week, with Virgin Galactic announcing reservations for the first 1,000 people to get these reservations. Of course, Virgin Galactic already has about 700 people waiting to go on these flights, but those tickets had been sold at around $200,000 to $250,000. Virgin Galactic last year said that the tickets would be going up in price to $450,000 a pop, and now people can buy these by single or also get double seats. Also, they can even get the entire flight if they'd like. Now, what this will get you is a 90-minute flight, and this will be to the edge of space, and the aircraft will be able to, you'll be able to look through 17 windows outside the aircraft, just breathtaking views. You'll be able to also have some minutes of weightlessness as the spaceship gracefully flips. As far as when you can expect to be going on these flights, if you do end up getting one of these reservations, well, it will be likely near the end of this year, closer towards the end of the year, because you'll recall that Virgin Galactic has had some delays with getting its commercial flights going because of upgrades that it was doing to its spacecraft. However, again, $450,000, you put $150,000 deposit, $25,000 of it is non-refundable. So make sure that you do want to get on that flight, that you do, if you do pay, you're going to go.
You better start saving now, Inez. Okay, switching gears, another space company exec in the news today as well. Elon Musk donated apparently $6 billion worth of Tesla stock to charity last year, and I'm guessing it wasn't purely for philanthropic reasons.
No, it wasn't. Of course, you get deductions when you do give away these stocks to charities. As far as when this happened last November. The filings do not show which charity or organizations that this was given to, but some 5 million shares of Tesla were given, were donated. And Elon Musk does not get compensated with cash. He gets compensated with stock awards. So he does get deductions when he does donate. As far as the top givers are concerned for 2021, these shares that he donated make him the second largest donor for 2021, the first being Bill and Melinda Gates.
All right, Inez Ferre, thanks for all the space-related news. They're live from the NASDAQ. Appreciate it. Karina?
All right, we will switch gears after the break. We're going to give you more market news and a closer look at the trucker protests at our northern border. Stay with us. Welcome back to Yahoo Finance. I'm Karina Mitchell, along with my co-anchor Alexis Christoforous on this risk-on session for a Tuesday. Market seeing a little bit of a rebound rally. If we check the numbers right now, we'll see all three major benchmarks are at their session highs at the moment. The Dow is up 411 points. That is snapping a three-day losing streak. The S&P on course for a two-week highest level in 2 weeks, up about 64 points right now, and the NASDAQ outperforming, up by 2.09%. With much more on what's moving markets, let's bring in our Yahoo Finance's Jared Blickery, and it is a big day for tech stocks. NVIDIA and AMD leading the chipmaker rally. And Intel says it's poised to buy Tower Semi.
That's right. Rather a small company given the size of some of these others. In the lower right-hand corner, Tower Semi is up 41%. This is over the last 2 days. And you can see that year to date, it had been underwater. Now it's up 18%. This is a $5.4 billion deal. Intel would be paying $53 per share. You might notice it's still $6 off of the price there. Part of that could be that the companies have to go through antitrust negotiations with some of the countries, namely China. So we'll have to see if that comes to fruition. Here's Intel. That stock up 1% today, still underwater for the year. And if you take a look at the prior year, you can see we're off 22%. But in fact, if you go to a 3-year view, you can see just chopping around for a long time in this trading range. And I do have some commentary on this. This is from Bloomberg Intelligence, saying that with the deal, Intel may widen its manufacturing scale and variety, we believe, while offering U.S.-based capacity to its customers and counterbalance dependence on East Asian specialty foundries. And then Morgan Stanley, which rates the stock an equal weight with a price target of $55, about $7 above the current price, saying acquiring this foundry competency, even at relatively small scale, would change the narrative of Intel's foundry strategy for the better. A contrary opinion here, though. Bernstein, which rates the stock an underperform with a price target of $48 under. Spending this much to obtain further foundry and specialty expertise and some geographically favorable incremental capacity seems unlikely to hurt much. However, we're not sure why going after a subscale, margin-dilutive analog fabber is all that attractive. So interesting to read these conflicting reports there, different opinions. History will have to decide. And also want to check out some of the leaders here. AMD up 5%, as you mentioned, just acquired Xilinx, closed that transaction only yesterday. And then NVIDIA up 8% ahead of its earnings, which we're going to be bringing to you tomorrow after the bell.
All right, want to switch gears and talk Avis. I know that stock is getting hit pretty hard today, Jared. They had pretty good earnings, right? I mean, there was a beat, at least on the top line, but I guess investors are upset about these revenue per day numbers and also their rental fleet metrics. That's right. And let me just take a look. Let's take a look at this board. You can see this is a travel and reopening board, and lots of green on the screen. The one exception is Avis Budget Group. And this is over the last 3 years. Let me dial this down to a 3-month chart. This is coming off that incredible peak that we saw last year, down 38% over these last 3 months. This has been a very volatile stock, so not surprising to see it down 12% today on a little bit of disappointment. Here's what the street is saying. JP Morgan is saying, which rates the stock in neutral, said that Avis's commercial travel in the fourth quarter was higher versus the fourth quarter in 2019, as corporate travelers are taking longer trips than before. Analysts saying that is leading to less rich leisure corporate mix and therefore pressuring revenue per day. That's what you were talking about, Alexis. Avis is more likely taking share in this segment, exacerbating the impact. Also, a couple words from Deutsche Bank. They're saying that it was a, quote, solid quarter. CAR delivered another top and bottom line beat versus consensus, though some bulls will likely view it as an imperfect quarter in light of an expanded U.S. fleet. So let's take a longer term view, because over the last 3 years, we can see still sitting on gains of nearly 500%. A quasi meme stock, you could say. It got caught up in a huge short squeeze over here back in late 2021. So we'll have to see what comes of this particular company amid all this green that we see, thankfully, on our travel heat map.
Okay, and then Jared, Yahoo Finance's Plus investment idea of the day is a bullish call on Twilio after reporting a favorable outlook in its most recent earnings announcement.
That's right. And as you can see, Twilio has been under pressure, down 55% over the last year. However, Argus Research, writing today, they do like the call. And in fact, they see a longer-term target of $320. They're saying big revenue beat against expectations, reiterating buy. Twilio edged up following a big upside revenue surprise for the fourth quarter and guiding for stronger organic revenue growth going forward. They posted a 60% plus revenue growth in 2021, but they're less concerned with pleasing Wall Street with short-term profits. Dollar-based net expansion rate, a measure of increased spending by existing customers, was 131% for the full year of 2021, indicating a strong customer retention and engagement. Twilio shares have come off sharply off peak prices. That's what we were just looking at, due to willingness to cooperate or to operate at a non-GAAP loss while pursuing longer-term growth. We see an opportunity for investors to initiate or dollar average into positions in a digital enabler with solid growth prospects in coming years. So as it comes down to, it's a value play, guys.
Okay, absolutely right. Jared Lickery, thank you so much. We're going to keep it on markets and bring in our next guest. Matthew Mishkin is co-chief investment strategist at John Hancock Investment. Matthew, thanks so much for joining us today. So markets trading on hopes of de-escalation of tensions between Russia and Ukraine and a lot of rumor. What sort of conviction is there in the market right now?
Yeah, every moment the market is twisting and turning based on headlines, and we wouldn't overplay it either way. There's still a lot of uncertainty around this geopolitical risk, but we're looking at the earnings picture, still pretty good. Economic data is okay. But right now we're kind of stuck in this stagflation type environment where the economic data is kind of stagnating, and yet inflationary pressures are still building. PPI today came in hotter than expected. Empire Manufacturing came in about flat. And so we're kind of in this air pocket here where we're still stagflation type backdrop. We think growth does come back here in the next couple months. Earnings stay solid and equities up for a bit of an opportunity.
And then what do you think about inflation peaking anytime soon? Are we at the peak? Does it get worse before it gets better? And what are some of the prime causes of that inflation? How much of that can correct itself?
Yeah, we do think a lot of it is supply chain disruptions. I mean, you think about what is one of the largest inflationary pressures, it's been used cars. And it's hard to say used cars, prices going up 40% is based on the Fed or based on a lot of stimulus, but it's really, to us, that is a supply chain disruption issue. We do think that fades over the course of the year. That was the one bright spot in the CPI report, was that used car prices are starting to moderate. So that's a good thing. But yeah, otherwise, we think that, by the end of the year, we're looking at 3 to 4% inflation off the 7% we're at right now. We think year over year, the comps are going to get higher into April. That's going to be a big step up in terms of the base effects. But at the end of the day, it's just been even month over month in January. You really want to see it decelerate a bit. It didn't, but these disruptions should ease as the pandemic comes down, which we think will happen here over the next couple months.
So Matthew, tomorrow we get more Fed speak, right? We hear about the minutes, and we already know Bullard is aggressive. He wants to tighten and much more comprehensively. So what do we learn that we don't already know? Because we know the Fed is behind the curve. They still are behind the curve because we know nothing about QT. We don't know how to unwind this $9 trillion that they have on the sheet. It's not been done before. And, we still know so little.
Yeah, I don't think it's going to be a huge change. And we do have a lot of speakers. So you're hearing real time their inputs, and things are changing fast. A Fed meeting, a month ago or even weeks ago seems like a lifetime ago, given how much the data has been changing. Inflation data has been changing. So, I think Bullard is coming out and adding more and more volatility to the market. And that's not really helping the situation. The market is pricing in a lot of rate hikes this year. And I think what the market's really going to be keyed in on this week is, do we get 50 basis points at the March meeting? And that would be a pretty abrupt start to a Fed tightening cycle. We think that they do one, and it helps actually steepen the curve a bit and gives them more time to raise rates all in. But if they come in with 50 basis points, and if they stay very hawkish, the curve could invert, meaning 2-year yields could catch up to 10-year yields and really hit the same yield level. And that's not a good sign. And that could be happening here in the next couple months.
want to ask you your assessment of tech stocks. They're much higher, while yields are also much higher. Usually they go in different directions. What do you make of that?
Yeah, I mean, today is seeing a bit of a reprieve in the technology space after some pretty tough performance. I think some of that's the M&A activity in the semiconductor space that you guys were just talking about, but the fundamentals still look strong. At the end of the day, the earnings are going to be the key driver of returns, and earnings estimates are good in tech. The street's looking for about 11% earnings growth this year, higher than the overall market. And one of the things we think is misunderstood about technology is they can raise prices too. They can, cause inflation, whether it's subscription rates, whether it's new products raising prices. They can pass on higher prices because they've got good moats. They've got good stances in their industries, competitive advantages, and that can cause higher prices and pricing power in technology as well.
So then how do you reposition the portfolio? What do you tell people to do at this point to hedge against inflation and geopolitical risk? Or is it time to sort of park your money and sit it out for a little bit, wait and see?
We see a lot of things on sale right now. And in the bond market, for example, you're starting with higher yields. Yields have really elevated, but you're looking at 3-4% yield on some corporate bonds. That's a pretty attractive starting yield for longer term investors. And in the equity market, you've seen valuations become more attractive. So the PE ratio on the S&P 500 now about 19 times. Earnings estimates are going up while prices are coming down. So that's valuation. That's a better valuation entry point. So we're seeing actually better entry point in parts of the equity market, better entry point in parts of the bond market, and cash is still earning zero. So that's the worst place for a 7% inflation. We think a balanced portfolio offers a lot of opportunities starting today.
It is so interesting how bonds suddenly became much more attractive all of a sudden. Okay, we'll have to leave it there. Matthew Mishkin, Co-Chief Investment Strategist at John Hancock Investment Management. Thanks for your tips today. Alexis.
Thanks, Karina. Coming up next, how the trucking industry may be profiting from the supply chain mess. It's estimated that the U.S. is short some 80,000 truck drivers. That's a record high. But those behind the big rig say they're not to blame for the supply chain mess. Yahoo Finance's Danny Romero joining us now with a special guest. Danny?
Thanks, Alexis. Yeah, we're joined by Tony Karg, Executive Director at Accountable.us, and he's going to talk to us about a new report that shows how the trucking industry is profiteering off the supply chain mess while playing the blame game on the driver shortage. Thank you so much, Tony, for joining us.
Thank you so much for having me.
So let's talk about this report. What led to the findings, and what are the biggest takeaways from this report?
Sure. So here at Accountable, we've been looking at several industries involving how they're reacting to the pandemic. And what we're finding is that prices are increasing a lot, but what we're finding is that corporate greed it can explain a lot of the reason why prices are going up. For example, we did some work in the meatpacking industry and the oil and gas industry showing how prices are going up for consumers. Meanwhile, they're raking in record profits. But we decided to take a look at the trucking industry as well, because that's obviously a major contributor to the supply chain. And what we found is similar to what we found for those other industries, is that the big trucking companies are boasting record profits. They're saying that they're in the most profitable position that they have been in history in some cases. Meanwhile, what we're seeing is that the prices are going up for average consumers, and we're not seeing any improvement for the working conditions for truckers themselves.
So, and to that point, there seems to be a lot of finger pointing when it comes to the supply chain mess. And the most common one is the shortage of truck drivers, right? Is it that we still need more drivers? Because I've spoken to some truck drivers out at the port of LA as well as Long Beach, and they say that they're willing to work. And also another thing is that most of them are contract drivers. So what's the holdup? What needs to change in the trucking industry?
Right. Well, I think that you raise several key points. That truckers themselves are willing to work, but but we're not addressing sort of the problems that have been in the trucking industry that even predated the pandemic. I mean, if you look at the wages for the median salary for truck drivers in the last 40 years, they've been cut in half. So we have the pay is not keeping pace. There's a lot of companies that are misclassifying their workers as independent contractors versus employees, which is something that you just addressed. But also just the working conditions. I think that to make it more attractive for people to come into trucking, I think, yes, we do need to have more truckers, because 72% of domestic goods are brought by truck. So it is a huge, vital part of the economy. It's a huge, vital part of keeping the supply chains working. And we need to address these persistent problems that have been occurring long before the pandemic, but obviously the pandemic exacerbated it.
I wanted to shift gears just a little bit and talk about the fallout with the hundreds of truck drivers protesting in Canada over the vaccine mandates. Do you think it's done? Do you think the tactics are working?
I don't know all the particulars of what's going on with the Canadian trucker protesting. I do know that there are some similarities, but I think there are a lot of key differences between what is going on here in the United States versus in Canada. I do know that some of the big trucking associations or the people that are representing the truckers have come out against what's been going on in Canada. But again, I don't know if I can say enough that I know enough about the Canadian experience. I would say that they said that it started over vaccine mandates, but which is something that is not part of what's going on in the United States.
Got it. And, I wanted, again, to shift gears back to, some of these policies, specifically in California. I've spoken with some truck drivers out here, like I said, at the Port of Long Beach and Los Angeles. And California has a truck and bus regulation, which they attempt to reduce emissions of greenhouse gases as well as diesel exhaust. And, this policy has been in the books since 2008. But like I said, I spoke with a truck driver, and they said one of these truck drivers told me that there's a pressure for them to buy a newer big rig, and that they would have to split the bill on it. Would we see more impacts on that? I think that brings, because that's something that hasn't really been shown, right? That these big rigs in certain states, right, their policies that they might have to, buy a new big rig in that regards. Would you see drivers, if that's the case, leave the industry because of that, because they have to flip the bill on a big new rig?
Again, I'm not sure. I think there are a lot of factors that are contributing to what's going on in the trucking industry. But what we've outlined in the report is basically what's been happening with trucker pay over the last 4 decades. I know that there are other conditions that truckers are looking to have make improvements, like where they can park. And obviously, it's just a really, it's a vital job, but you're going to be spending long hours away from your family and on the road. So there's obviously some things that people need to address with that. I would say, though, just to go back to what the report said, is that the big trunking companies here are charging higher prices, which then get passed on to consumers, but they're using the higher prices that they're getting not to improve conditions here, but to also do more corporate buybacks and to increase profits. So we think that everyone should sort of work together to solve these problems, that it's not just going to be one thing or another.
Thanks so much, Tony Kark. That was Executive Director at Accountable.us. Thank you again for joining us, and I'm going to toss it back to Alexis.
All right, thanks a lot, Danny Romero. Appreciate it. Karina, I'm going to toss it over to you.
Okay, and coming up, Alexis, we talk about the fight against COVID. Booster uptake is at an all-time low, while frustration over masking continues to grow. That story ahead. According to new CNN analysis of CDC data, only 28% of the U.S. population has been boosted, while 64% has received at least the 2-dose series. Here to help discuss that is Dr. Ellen Eden, Associate Professor, University of Alabama at Birmingham Division of Infectious Diseases. Doctor, thanks so much for being here. In your opinion, do you think at this point whoever wants to get vaccinated or boosted has done so?
I do. What we're seeing with boosters is very reminiscent with what happened early on with the initial vaccine dose, which was that many who were eager and enthusiastic got vaccinated very early, and we quickly reached saturation with that group, just like the boosted group. Those who were willing and enthusiastic about a booster quickly got boosted, and now we're seeing availability of boosters, but very little interest in the general population. And as you know, those boosters are essential to keeping individuals healthy and out of hospitals, specifically with Omicron and potentially with newer, as yet to be identified variants.
Doctor, there is a lot of pushback over mask mandates at the moment, and frustration is turning to anger. We are seeing school board members getting death threats over COVID mandates and mask mandates. We're seeing border disputes between Canada and the U.S. amongst truckers continue. It used to be a political divide. That was the reason some people gave, but now blue states are pushing for easing or lifting mask mandates. In your opinion, is it productive to continue with enforced mask mandates, especially the piecemeal way that they're being administered?
It is a very challenging question. I think masking mandates in some areas have been counterproductive, as you mentioned, due to really the disregard and vitriol towards our public health officers. I think that the best way to address masking now is at the local level. We know that what's going on in Alabama is very different from the Northeast and California. And so what I've encouraged is really businesses, agencies, schools, talk locally. What is your micro epidemic looking like? What is going on in your hospitals? How many doctors do you have available to staff your ICU? How are schools looking? And I've really encouraged collaboration between business owners, agencies, organizations with their local health experts to understand if and when it's safe to relax these measures. And just like we're discussing off-ramps, I have really stressed that we start talking about on-ramps for risk mitigation. Although we're all focused on this reprieve with Omicron, what we've learned with Alpha and Delta and prior surges is that we have had subsequent surges. So I really think it's inappropriate now to talk about these off-ramps and relaxed measures without planning for a future surge, hoping that it won't happen. And certainly this could be our last major surge, but to be caught unprepared now, almost 3 years into this pandemic in March, I think is really unacceptable.
And Dr. Eden, Sweden is the latest country to propose a fourth vaccine. I'd like to know where you stand on that. And people are being reinfected, right? So Prince Charles is the latest high-profile case. Are the reinfections as severe?
Currently, no. I'll tell you, for the vast majority of individuals, reinfections, and certainly reinfections in those who are fully vaccinated, for the vast majority of individuals, we are not seeing those as severe. It is still recommended that people who were previously infected with Alpha or Delta do get vaccinated if they're not vaccinated already. I've seen examples of that in my clinic. People who thought they were in the clear, they thought they were immune because they'd already been infected, now got infected again in December, January, missed more work, kids got sick, household contacts, certainly exposing more in their community. So I still recommend vaccination if you are not fully vaccinated, even if you have some natural immunity. And I think with regards to that fourth dose, we're learning more. I think the evidence overwhelmingly shows that those of us with a normal immune system who've been fully vaccinated and boosted have a great amount of protection against severe disease that's going to lead us to the ER, the hospital for breathing treatment, or even worse, life support like we've seen previously. So have confidence in those 3 doses. If you are immune suppressed, you do need to talk to your doctor because there are populations who are going to need a fourth dose sooner than later. But I think the jury's still out on if and when the general population needs a fourth dose. And it's certainly something to talk to your provider about if you have questions.
Doctor, really quickly, only about 30 seconds left. I want to turn your attention to what's going on in Hong Kong. COVID cases are surging there. The system is overwhelmed. The vaccination rate is so low there. Should we be concerned that that is a breeding ground for a new variant?
Absolutely. This is what keeps us up at night. Healthcare providers like myself, frontline workers, March, even winter is not that far in our rearview mirror. We have a workforce who is weary. We in Alabama also have the lowest vaccination rates in the US. I think this keeps us up at night. With each wave, we're more weary. We're less well staffed and prepared and resilient to respond to the next surge. So of course, any community where there is transmission, there is opportunity for mutation and new variants. I can't say that'll happen. None of us have a crystal ball, but I do think it's important for us to be mindful, be prepared, whether it's COVID or a flu or whatever the next infectious disease threat. We need to really ramp up our public health infrastructure and be prepared.
Okay, great advice there. Thank you so much, Dr. Ellen Eaton, Associate Professor, University of Alabama at Birmingham Division of Infectious Diseases. Thank you for your time. Alexis, I'll send it over to you.
All right, thanks a lot. There are some fast-moving developments on the Senate Banking Committee's scheduled votes over President Biden's Federal Reserve nominees. Yahoo Finance's Brian Chung here now with the very latest. And Brian, it seems like they just don't have a quorum to hold these votes yet.
Yeah, Alexis, a very dramatic scene playing out in the Senate Banking Committee right now. Actually, it's still happening where supposedly they were going to vote on the 5 nominees from the Biden administration for vacant seats at the Federal Reserve, including a second term for Fed Chairman Jay Powell. Now, the problem seems to be the nominee for the Fed Vice Chair for Supervision role, Sarah Bloom Raskin, who's a former Fed governor, by the way, confirmed by the Senate in 2010. Apparently, Republicans have some concerns about her previous writings about climate change, as well as her dealings with Reserve Trust, a fintech company that got a master account with the Fed. It's kind of an inside baseball way to get access to the Fed's payment rails. Some GOP members have some questions about whether or not she leveraged her connections at the Fed to get that master account. Either way, the Republicans said they simply weren't ready to make the vote, which was supposed to happen in committee at 2:15 today. So the Republicans decided not to show up for the meeting. That means that they don't have a quorum and cannot advance any of these 5 candidates out of the committee. The Republicans had said, we were willing to compromise to allow the 4 other nominees, including Fed Chair Jay Powell, to go through a vote and they could hold Raskin. But Democrats said they didn't want the GOP to be able to pick and choose who they could delay and who they couldn't, which means that all 5 nominees will now be delayed. We don't know when another vote will happen. We don't know when a full Senate floor vote will happen. But there are a few wrinkles here, one of which I want to point out is that even if the Republicans were in committee today to make an advance on these 5 nominees, it likely wouldn't be able to go to a full floor Senate vote because of the fact that the Democratic senator from New Mexico, who suffered a stroke a number of weeks ago, still hasn't returned to the Senate. And in a 50-50 Senate, they would have had to wait for him to return, which is supposed to happen in a few weeks, to get that vote in anyway. So it's possible, even if the GOP was present today, they still would not have been able to advance the Senate vote. A lot of inside baseball, inside the DC Beltway issues here. But either way, the expectation for these 5 Fed nominees to get out of committee today, simply not going to happen. Guys?
All right, never a dull moment. Brian Chung, thanks for the update. I know you'll continue to follow it for us. On the other side of the break, the oil markets respond to mixed messages coming out of Russia. We're back right after this. Welcome back to Yahoo Finance, everybody. Jared Blickery joining us now with not only a look at the energy markets and how oil is reacting to these tensions between Russia and Ukraine as they drag on, but also I understand Activision Blizzard back in the news. Warren Buffett having a little something to do with that company right now. Fill us in.
That's right. We know that Berkshire Hathaway just reported on Monday after the close that they had bought a significant stake in Activision Blizzard, which we know is being acquired. So Activision trading at 81.54 right now, not really moving too much today, but we did get some color on this. And it turns out the transactions occurred in October of last year. So this is a 3-year chart. Let me dial this down to a 6-month chart and we can see where that would have been made. So I calculated the VWAP. That's a volume-weighted average price for all of October, comes out to about $77. So you can see the current price, really not that far above it. Wasn't able to get in, it looks like, at these lows, but they made that transaction before this latest purchase was announced. So just want to point out that Activision Blizzard had been under some pressure, but now it is a Berkshire holding, and it's being attributed to some of his money managers, one of whom is Todd Combs. So interesting development there, but we want to get to the crude oil market, and that's where WTI for March settlement just closed at $92.07 per barrel, down 3.6%. Worst day for oil in about, I believe it's 8 weeks. So here's a 3-month chart, but you can see here, really, does an upward trend look any tighter than this? I don't think so. So really at the bottom end of this range, and we can see it was bought just a little bit there. And of course, this is on the heels of those sanctions that on the incursion that we're seeing potentially in the Ukraine with those Russian troops standing at the border. So we'll have to see how that develops. But also seeing some weakness in palladium. This is another metal that's mined by the Russians, and we can see that is down about 4% today. So just kind of confirming the news that, at least for the time being, some tensions have eased a little bit. Let's go to our energy heat map here, and I want to check out some of the moves in energy for the day, and there we go. You can see a lot of red on the screen. This is, I think at one point this was the only sector in the red today, but now we're seeing ExxonMobil down 1%, Chevron down about 0.75%. Some of the shale oil players, Occidental Petroleum down 3.5%, and Continental Resources down 6% after reporting earnings earlier this morning. Guys?
All right, thanks a lot, Jared Blickery. Time now for our ETF report brought to you by Invesco QQQ. Let's bring in Dave Naudig, CIO and Director of Research for ETF Trends. Dave, good to see you again. We see how headline sensitive this market is right now to the situation between Russia and Ukraine. What kinds of recent trends have you been seeing in the ETF space?
Well, I mean, I think it's reasonable that people have been wanting to play Russia, given that's been the news headline. There is one big and good ETF covering the space. It's the VanEck Russia ETF RSX. Interestingly, it's had pretty much steady inflows all year long. About 120 billion has flowed into that really just in the last few weeks. And if you think about playing Russia with a fund like this, it's important to understand what you're getting. Gazprom and Lukoil represent about 18% of the fund by itself. It's 40% energy, 26% materials, and 16% financials. So it's a remarkably undiversified index for a country index like this. That being said, I'm always a little reluctant that folks reach for an ETF to play a geopolitical headline like this. However, the fund does do what it says on the tin, and it's up about 5% today on the obvious news that things seem to be calming down a little bit in Russia.
Yeah, I mean, in terms of playing sort of the Russia story, as you were saying, we know that energy is playing a big part in that. Jared was just talking about the activity in crude today falling by the most in about 2 months. Where are you seeing money flowing into or out of energy-related ETFs?
Well, interestingly, as we've had this sort of rally in oil on the backs of these geopolitical concerns, it's been interesting to see green energy plays actually get a lot of traction. One that we've been following a lot is the Crane Shares Carbon Credit ETF, KRBN. It's up to about $1.7 billion, has had really consistent inflows. This is investing in the futures contracts for cap and trade carbon credits around the world, both in the US and in Europe in particular. It's up about 89% 8% so far this year. It's done, over the last 12 months, it's done extraordinarily well. And it's an interesting way to invest in the transition, in that low carbon transition that we see. So instead of maybe chasing the high oil price, chase the thing that's going to come after it, which is that transition away from the need for fossil fuels.
Now, also, of course, we continue to be on the hunt for yield in this environment where we're expecting interest rates to move higher. Again, today we saw with the producer price index that inflation remains high and isn't going away anytime soon. So how are people using some of these ETFs as hedges against inflation and higher rates?
Well, there's been a bull market in new products trying to chase both of these key needs, right? This need for income, particularly financial advisors are always looking for income. And obviously, we're now facing an inflation regime that most of us have never seen in our lifetime. Two products I'd highlight there that are both pretty new. Today, we got a launch from Simplify Asset Management. The ticker is CDX. This is a high yield bond fund. It invests in sort of traditional high yield using USHY from iShares and Fallen Angels using ANGL from Van Eck, but then it adds a hedging layer on top of that to try to profit if you get some sort of spikes in that credit spread that would make you concerned about it. So it's an interesting way of hedging high yield exposure. On the flip side, if you're worried a little bit more about playing defense with inflation, AXS Astoria launched a really interesting product a few weeks ago. PPI is the ticker. It's the inflation sensitive ETF. This is an actively managed fund run by John Davey. He's one of the best sort of macro allocators I know in the space, and it moves between tips, sensitive commodities, and sensitive equities, and it'll do that on an active and reactive basis. I think it's a really interesting way to take a run at that space without just buying tips, which is probably a little bit late.
Yeah, nice to diversify there for sure. Real quick, Dave, what are investors' appetite for tech, especially those mega cap tech ETFs right now?
Well, what we've seen is an interesting diversion between sort of non-profitable innovation tech and sort of more traditional technology, Apple, Microsoft, big software companies, Cisco, things like that. It really has flipped on almost a day-to-day basis, whether or not one version of technology is in favor or not. At the moment, we're definitely back on an everybody buying everything mode. That may just be the relief rally coming off some of these tensions we've had in the Ukraine. But I do think we've had a bit of a reset on that non-profitable tech sector, and investors are starting to reallocate into it.
All right, Dave Naudig of ETF Trends. Always a pleasure. Thanks for stopping by. Up next, the boating business boom. Who is buying these luxury yachts and what are they looking for? The answer may surprise you. Welcome back to Yahoo Finance Live. The boating business is booming, but just who is fueling the industry right now? Joining me is Rafael Solo, CEO of the yacht company Fraser. So good to have you here, Rafael. Thanks so much for joining us. What does the demographic look like right now? Who is fueling this boom in yacht buying at the moment?
Well, Alexis, thank you so much for having me this afternoon. The yachting industry is going through some tremendous changes over the last few years. You know, I mean, the average of our customers is spanning between 25 years old up to 80 years old. We've been having sales with very young individuals of 25 years old, and obviously we're still selling yachts to a more mature, I would say, customers. I mean, but one thing is for sure, the average age of our customers over the last 2 years went from 55 to 65 down to 45 to 55. So clearly you see a strong shift here in who is buying yachts and also the number of people who are buying yachts.
So when you say as young as 25, what are these 25-year-olds doing that they can afford a yacht? So I have two questions for you. What is the average sale price of a yacht right now? And what industries are these young people coming to you from?
Well, I mean, today, average sales price of a yacht would be $7 million, and that would be a 30-meter, 100-footer, basically because this is where you have the most numbers of boats in the inventory, but it can start at 2-3 million all the way up to over 100 million. So going back to your questions, the younger customers, if I may say, who are joining our industry, they may come from Bitcoin investments or hedge funds for some, and some others are just selling their IT companies. So we've had some example whereby a gentleman sold a couple of softwares he developed himself, and then went on into yachting, where he's having rather a good time today, and he's actually looking into buying a second yacht now. So you see the background of these younger buyers is pretty diverse, but mainly internet companies and obviously finance.
Now, you've done a booming business during the pandemic. You saw a 175% increase in sales from 2021 to 2020. I'm wondering what matters most to the buyers of these yachts right now. What are they looking for when they purchase one of these boats?
Well, I think there's many things you're looking at when you buy a yacht. As we all know, yacht is not an investment. It's a pleasure purchase. And what the people are looking for when they buy a yacht is, one, to be together with their family in an environment which is obviously lately seen as safer, because you can control the recruitment of your personnel, where you decide to go with your boat, where you decide to stay, how long you want to stay. So that's one major factor here. And of course, also the boom of the so-called remote work the last couple of years, where people now realize they actually can do business away from the office. So some of our customers, they've been taking that opportunity to spend time on their yacht, sometimes 4, 5, 6 months in a row, together with their family, their kids, sometimes tutors, to take care of the children. So all of this together has really been shedding a new light on yachting. So freedom, which for me, freedom is luxury. And of course, the fact of being able to explore new destinations, whereby within the last 2 years, a lot of places were closed for tourists, hotels were closed, or they're offering limited services. So if you go on a yacht, basically you have a full crew only for you to serve you. So that pleasure of having this great service and that pleasure of being able to go almost anywhere has been a big trigger for many.
And just talk quickly about inventory right now, and what does the resale market for these, or the used yacht market, look like right now?
Well, I mean, if I look at the market last year, we have had over 7.12 billion in sales inventory. So I can tell you already a lot of second-hand boats went sold. So what we are looking at coming into 2022 is potentially a lack of inventory, even though we see still a strong appetite for yachting, but we can see that boats are getting more difficult to find. The boat which we think will fit the best our clientele are maybe not easier to find. And of course, the shipyard, as I said, they also are going through the same challenges, whereby, the waiting list for some of the shipyard is almost 4 to 5 years. So if you wanted today to buy, to build a new yacht, you will most likely have to wait between 4 to 5 years before taking delivery of the yacht. So we still have a huge demand in second-hand boats, but we are not necessarily able to find the right product immediately. You actually see today some off-market boats being sold, meaning we are calling some of our customers to see whether or not they would be interested in selling their yacht. So this is the market we're in today.
That is really wild, and they're certainly not cheap, but demand is strong. Rafael Solo, CEO of Fraser, thanks so much for being with us. Karina?
Okay, and coming up, a big blow for former Alaska Governor Sarah Palin in her defamation case against the New York Times. That story ahead. Welcome back. Well, a jury has found the New York Times not liable in the defamation case brought by former Alaska Governor Sarah Palin. Here with more, let's bring in Yahoo Finance's Alexis Keenan. And Alexis, that after the judge delivered a not guilty directed verdict in the middle of deliberations.
Okay, this is getting really confusing and I still have so many questions, but let's break this down. So what just happened is a federal jury in New York has concluded, they came back after deliberations that they started on Friday, saying that the New York Times did not defame Sarah Palin in that 2017 editorial that's in dispute. So this comes, though, after an extraordinarily unusual move by the district court judge to take back the case that he had handed to the jury on Friday. This is the defamation case that was brought in 2017. Sarah Palin had said that the New York Times and then its editorial director, James Bennett, Palin said that the New York Times had damaged her reputation by incorrectly linking her to a 2011 shooting in Arizona that injured Democratic Congresswoman Gabby Giffords along with 18 others. Now, what's really unusual about this case is that in mid-deliberations yesterday, the judge said that he planned to dismiss the case, though still let the jury finish its deliberations for the benefit of the appellate court, he said. The judge said that Palin had failed to show that the New York Times acted with actual malice. And that is the very challenging legal standard that public figures like Sarah Palin and others must show in order to win a defamation case. So that standard, it was made law back in 1964 in a landmark case, Supreme Court case, that is New York Times v. Sullivan. And so there's been a lot of questions about whether this case that Sarah Palin has brought could change that long-standing precedent, and also then involving the New York Times at that time back in 1964. Now, it's still too early to know. That's a long road to the Supreme Court. There's the appellate court in between, and it's anyone's guess whether the Supreme Court would take this up. But there's so many questions around what really this jury would-be verdict is. Yes, they returned what they thought was a verdict. They didn't know that the judge had said he was planning to rule for the New York Times in this case. And so really procedurally challenging here. And there are going to be a lot of questions, maybe even challenges following what this judge has decided to do. We don't know at this point whether this verdict will stand as a jury verdict or whether this will be the judge's decision. Usually these types of things come, if the judge is going to make a decision, it comes before the jury gets the case or after the jury gets the case. Certainly the judge can say, notwithstanding the verdict, I'm going to rule this particular way. This is just highly unusual though, guys.
All right. Well, you know, you're right. It is pretty confusing. So what does this all mean for the media and for journalists, Alexis?
Yeah, so at this stage, this is the trial court stage, and so trial courts do not set precedent, so there's no change to the law here. However, if there is an appeal to the circuit court and then there's a decision at that level, this could potentially become a Supreme Court case. And certainly the legal experts that I've talked to today, they've said that this judge's intervention in this case certainly ups the ante and makes it possibly a more interesting case for the Supreme Court to consider. Also, you have to take into account that this jury was not sequestered. So if perhaps they saw any headlines or they saw any news that this judge had already decided what to do, even though they were still deliberating, that's really questionable because these people are giving their time, they're public servants doing their duty, and they certainly don't want to be, no one would want to be deliberating knowing that their deliberations and their time is time that is spent in vain. So what exactly is going to happen and how this ruling will really be made, we still don't know. But as for journalists, that 1964 precedent in New York Times v. Sullivan, it still stands. We can operate under those rules, but just so many questions here. Added to that are a couple of justices who are on the current court, Justices Gorsuch and Thomas. They have both expressed concerns and interest in looking again and revisiting New York Times v. Sullivan. So at least that's 2 of the 9. There's some interest there, but gosh, you guys, a lot of questions remaining here. So we'll keep following up on this story.
All right, we had trouble hearing Karina there. All right, everybody, we want to thank you for being with us. Stay tuned because Emily McCormick, Brad Smith, going to take you to the closing bell coming up next.
Stocks are rebounding after 3 straight days of losses as Russia signals a partial pullback of thousands of troops near the Ukrainian border. And the jump in risk assets comes even after another red-hot print on inflation came out this morning, with producer prices posting a near-record leap. We'll break down what all of this means going forward and whether this relief rally can continue with our markets guests these next 2 hours. Plus, at least one lawmaker has issued some sharp criticism for energy companies, unleashing major price hikes this winter. Congressman Jamal Bowman of New York has called out Con Edison for a steep price hike, costing New Yorkers as temperatures plunge and commodity prices surge. We'll have a discussion in a bit. And Hollywood loves a comeback, this time the reboot of MoviePass. We'll speak with the CEO and co-founder of the entertainment subscription service as MoviePass aims for a relaunch this summer. We have an hour to go until the closing bell. I'm Emily McCormick here with Brad Smith and Rochelle Akufo. And Rochelle, I'll turn it over to you.
All right, thanks, Emily. We're going to do a quick check of the markets here. After seeing red across the board for Valentine's Day, the 3 major indices perking up today on news of that de-escalation between Russia and the Ukraine that you mentioned. Now we're seeing that the Dow is up over 400 points for the day, the Nasdaq up 315 points, and the S&P up 64 points. For more on this, to break down what's been moving markets today, here's Yahoo Finance's own Jared Blickery.
Thank you for that. And check out the Dow, up 400 points. I think investors will take that. Are we out of the clear? I don't think we're ready to say that just yet. But here's the Dow. You can see maintaining most of its gains from the open here. Similar story with the Nasdaq, except we just broke 2 new nominal session highs here in the S&P 500. Up 1.5%, up by its highs as well. Just want to check out a longer-term chart of the S&P 500. We are entering this zone here where we broke down the other day, and so could see sellers emerge here. We are not out of the clear yet, but it is a risk-on flavor to the markets today. Here we have tech, consumer discretionary, materials, and industrials all outperforming. Financials not far behind. So we have an interesting mix of both value and cyclical stocks and the growth stocks doing very well today. To the downside, only energy and utilities are in the red. Energy down more than 1%, seeing the steepest decline in crude oil prices in about 8 weeks. Now, looking at some of our leader and sentiment markets here, we can see a lot of green on the screen. I'm not going to go through all of these, but when we see this, it means that there's a risk on flavor and money is flowing into some of those fringe groups that typically attracts money when things are good or when we're having a short covering bounce. So take it with a grain of salt. Here are our meme stock. And we see GameStop up 6%, Discovery reporting earnings after the bell, which we're going to bring you live. That's up 3%. Avis Budget Group, well, they had some disappointing earnings in terms of the pricing power. That stock is down 12.5%. But you get the idea here. Most of these stocks in the green. Now, taking a look also at the ARK Invest components, seeing a very similar theme here. We got Tesla up almost 5%, Coinbase up over 5%, Shopify up 3.5%, and the list goes on. And if you're looking for some relief rallies because of the geopolitical tensions easing a little bit, can see it in nothing but the travel, well, a lot of other places, including the travel sector. Airbnb, by the way, we're also bringing those earnings to you after the bell. That is up 5%. Booking.com, that's up 3%. And here's that Avis Budget Group, kind of messing up my dark green theme here. But as I said, that stock down 12%. Guys?
All right, Yahoo Finance's Jared Blickery. Risk on amid some Russia-related relief, Jared, for sure. We'll continue to discuss this. And for more on the market reaction to Russia retracting some troops from Ukraine's border, Ken Van Leeuwen, who is the Van Leeuwen & Company founder and CEO, joins us now. Ken, we got to know, from your perspective, what makeup of the volatility even that we've seen in the past few sessions would you say is attributed to international conflict as compared to Fed signaling?
Well, it's interesting because I think it's a combination of both, Brad. I think what we're seeing is the overpinning, of course, is what's going on in our own country with inflation and how it's basically been to a plus a 40-year high. And then, of course, what we're seeing is, of course, the tensions with Russia and the Ukraine on the overlay. And what we're seeing today with the news that Russia is moving troops away from the border is definitely giving a market a bounce. But I think the overriding concern is still, what is the Fed going to do with regards to inflation, especially after the PPI numbers today, which just, another record leap. So very much of a concern.
Right. And so should tensions continue to subside, where would you position your portfolio?
Well, basically, if I would not be in energy stocks, I would be in financials. I would be in consumer stocks. I would be in the travel related stocks, because one of the things that we're going to see, even with this inflation numbers, I think we're going to see a boom in the economy. I think we're already beginning to see that. I think we're beginning to see that people want to get out and go. The coronavirus, and frankly, the Omicron that we've lived with the last couple months is starting to fade behind us. And we're going to want to get out there and go travel.
Ken, you mentioned the producer price index, and this morning that came in at 9.7% on a year-on-year basis for January in a near record jump. What do you think this, in tandem with the hot CPI print that we just got out recently as well, suggest about what the Fed should be doing next?
Well, it's going to be interesting, Emily. It's going to be to say, what's the action they're going to take, right? A lot of people were feeling that we were going to take quarter-point jumps as possibly as much as 7 this year. What we're seeing right now is the Fed going to be more dramatic in March and actually raise rates by 0.5 point to signal to the markets that they're going to be vigilant and very on top of this topic. And I think that's what we're seeing is that the impetus that the Fed will act. Not just gradually, but really go after it, because I think maybe that's what the markets want to see as well.
And when we think about the path forward for the Fed, is there further room on a stock basis for outperformance among the beneficiaries of higher rates like the financials, or have higher interest rates already been priced in here?
Well, I think what we're going to see is that for financials to benefit, right, we've got to see again that the yield curve begin to steepen, not flatten as it was doing for the last couple of days. So right now, we're not seeing that much today, but we really need to see that yield curve or short-term rates decline so that the financials can borrow short, and lend long. I mean, I think that's what we got to see for the impetus to beat the financials. I still think the trouble spot areas will be that technology with interest rates, because the 10-year is clearly over 2% today. So I think that will clearly put a lid on the technology stocks, or the risk-on stocks, like they like to call themselves.
And Ken, what are some of the biggest investment stakes that you tend to see investors make when markets are this volatile? And where do you see the biggest opportunities in this climate?
Well, Rochelle, that's always a great comment. I mean, the individual investor tends to do things at the wrong time, when they frankly should have been selling into the excesses of at the end of 2021. They should have been doing that. Right now, we're advocating that, yes, lighten up potentially, or we should have lightened up in January in some of those technology or higher flying issues. But otherwise, it's always, Rochelle, is to stand pat, let the action go around you, because you can see, right? Yesterday was a terrible day. Today's a great day. You never get the timing right. And it just shows you got to make 2 right decisions. Making 1 right decision in investing is hard enough, let alone 2.
And as you mentioned, a day is a long time in the markets. I want to look at this article that you wrote entitled, "It's Going to Be Harder to Make Money in 2022. Now, you tap on a number of concerns, including Fed rate hikes, persistent inflation, Washington politics, and stagflation. Now, when you add Russia-Ukraine uncertainty into the mix, how hard is it going to be to make money in the short to midterm?
Well, I mean, clearly, because the markets are focused on that tension, and as well as our European counterparts, and investing in European markets, and companies that do benefit multinationally are going to struggle. Again, because energy prices, if we were to get into a conflict, could technically hurt us if that action was to take place. And we saw that right today, because the tensions are lessening. We're seeing energy prices decline, because Europe, frankly, is such a big user of Russian natural gas that does pose quite a concern to us. without a doubt. So again, we don't want to see them tipping necessarily into recession.
Well, lots of great insights there. We do appreciate it. Ken Van Leeuwen there from Van Leeuwen and Company, founder and CEO. Thank you for your time. All right, coming up, you saw their ads all over the Super Bowl, but are regulators hot on their heels? And is Canada perhaps helping the case for cryptocurrencies by trying to block accounts? We're talking cryptocurrencies after the break here on Yahoo Finance. Welcome back. You're watching Yahoo Finance Live, and we're going to take a quick check on what's going on with cryptos today. They seem to be faring a lot well as some of that risk easing from Ukraine-Russia tension seems to have helped, as well as some news out of Europe. We're seeing Bitcoin up. We're seeing Bitcoin up significantly, last price at 44,000. For more on what's happening with crypto, let's turn it to Brad.
All right, thanks so much. Well, crypto regulation is what we've been tracking here, and Dan Roberts, Decrypt editor-in-chief, joins us now to discuss this even further. Dan, as crypto acceptance ramps and the ad campaigns ensue, the regulation which the space has been looking for largely hasn't kept pace. But recently, we saw BlockFi reach a $100 million settlement with the SEC, and it raises this question of whether legal precedent will be set on a case-by-case basis instead of sweeping regulation outright.
Well, Brad, I mean, BlockFi chose to ask for forgiveness rather than permission. BlockFi is one of a few companies, along with Celsius and Nexo, that is offering these high-yield crypto savings accounts. So customers deposit a little bit of crypto, or you can deposit a stable coin. They are, in turn, lending that crypto out to other crypto companies and protocols at higher rates, and they give you back high yield. Now, the SEC had basically made it clear that they view those as unregistered securities. So now you have the $100 million settlement for BlockFi. What's funny is you see the BlockFi executives out there in the last couple of days trying to frame this as a win and a positive. This is great for the space. And maybe that's true, but it is also the case that they got in trouble and they got fined. It's $50 million to the SEC and $50 million to a number of states that had taken issue with this product. For now, they're not going to be able to onboard new accounts in the US, but those who are grandfathered in and already have a BlockFi account can continue to earn yield. Now you're onto something. What's interesting here is they might be lighting the way for other companies to get away with these products if they work hand in hand with the SEC. But of course, that's something that crypto companies do not love the idea of and don't want to do. I mean, in Coinbase's case, when Coinbase had announced a new product that looked a lot like these BlockFi accounts, it was called Lend. The SEC threatened to sue, and Coinbase said, never mind, and shut it down. So some companies are going to say basically, thank you, BlockFi. Maybe we can do the same product if the SEC approves us. Others are going to say, well, this isn't much of a win because the SEC is going to totally clamp down and require KYC, know your customer, and AML, anti-money laundering. And it's also unlikely that DAOs, decentralized autonomous organizations, are going to do well if they have to work hand in hand with the SEC. But it certainly is a pivotal moment that we'll have to keep watching, see how long it takes now for SEC to approve BlockFi to bring on new customers.
And so I think you raise a great point as well. Do you believe that the misrepresentations about over-collateralization, which is what the SEC had pointed out, do you believe it's specific to BlockFi, or does this render concerns that other Bitcoin lending practices are operating similarly?
Yeah, I think BlockFi was just kind of the sacrificial lamb, the first out the gate. A number of these other companies are certainly watching closely. Their products are basically the same. They vary in the details. Some of them allow you to deposit one of 8 different cryptocurrencies. Some of them, it's only Bitcoin and Ethereum. They vary in the details, but I think the SEC probably, it's safe to bet, has the same view on all these products. They see them as securities, and that doesn't mean that they're saying that they're illegal, but they need to be registered. So if you've been offering unregistered securities, you better register them with the SEC and pay a fine. They're basically saying you've broken the law. Of course, when you come to one of these settlements like BlockFi did, you admit no wrongdoing. So again, the executives get to trot out and say, this is great. Look at us. We've come to terms with the SEC. That and paying $100 million. But it's going to be really interesting. And, you know, the lawmakers, especially Democrats like maybe not Biden himself, although we can surmise what his view is, but Elizabeth Warren, Gary Gensler, they all seem to think that the crypto space is rife with these tokens that are unregistered securities offerings and with products that might lead regular uninformed investors to lose their shirts.
And so let's go overseas. In Europe, Fidelity's first exchange-traded product pegged to the price of Bitcoin, that's set to be listed. What type of volume should we expect for the ETP overseas in comparison to some of the spot ETFs that we've seen from ProShares? We've seen this from Valkyrie as well, listed during 2021.
Well, and the distinction that we should draw, Brad, is in the US, we still haven't had a spot ETF. An ETF that is tied to the current price of Bitcoin. That is what people have wanted for a long time. The SEC won't do it, or hasn't yet. What the SEC approved in the US was the ProShares ETF and others that are tied to futures contracts. So you're betting on the future price of Bitcoin, which is kind of a workaround. It's a little bit of a mature investing product that regular folks, most retail investors, probably don't understand and probably shouldn't mess with. This Fidelity ETP in Europe, so not in the US, is essentially a Bitcoin spot ETF. You are betting on physical Bitcoin. That is the current price of Bitcoin. And I think people are excited about it. You know, look, even Bitto, the ProShares one, which again was kind of a workaround, did very, very big volume on its first day of trading. So because you've got Fidelity, a known household name, I expect it to do pretty big volume. But again, it's not in the US. And in the US, we still don't really have the spot Bitcoin ETF that people have clamored for years.
Right, right. And so then additionally here, one other major crypto story that we've been tracking, and I believe you guys have written about this as well, the Canadian government's invocation of the Emergencies Act cutting off crypto-linked accounts. It seems the weeks-old trucker protest and the economic impudence from it is now turning into a flashpoint for DeFi regulation with appropriate oversight without overreach here. And so now it's, you know, for this flashpoint, how do other nations also, how are they also watching this very closely to figure out how they can have appropriate oversight without overreach?
Well, just so people understand here, Brad, I mean, this was a group of anti-vax protesters, truck drivers in Canada who were protesting the vax mandate. And what happened first is that they raised money on GoFundMe, and then the government stepped in and shut down their GoFundMe accounts. That's when they turned to Bitcoin. They raised a lot of money for their efforts in Bitcoin, and Elon Musk was one of many people who tweeted supporting their efforts. And so that's just interesting, even regardless of your politics. Now the Canadian government steps in and is going to freeze the bank accounts of some of these people. Now, this isn't just a crypto story. I mean, they're freezing their bank accounts. So this is all funding, but they're trying to stop them from being able to access their funds. So, if you use an exchange and you are connected to the exchange through your bank account and you hold certain Bitcoin that you've raised as part of your protest, now you can't access it because you can't access your account. So a lot of people do see this as overreach, but the interesting thing is that Bitcoin advocates love this story because they think it's a great advertisement for Bitcoin. It's an advertisement for decentralization. This is why people who were early to crypto, who are libertarians, like it, because the government can't step in and freeze your accounts or mess with your Bitcoin. Of course, if you store your crypto on a centralized exchange, well, maybe they can. So it is a flashpoint. You're right. Politics are involved. COVID's involved. It's going to continue to be a big story.
Dan Roberts, Decrypt editor-in-chief, joining us here today to break down these big headlines we've been tracking. Dan, appreciate the time, as always. With that, let me toss things on over to Emily.
Well, according to a new study from CNN, the rate that Americans have been receiving COVID booster shots has fallen to a record low. We'll discuss what this means for the public health outlook on the other side of this break.
Welcome back to Yahoo Finance Live, everyone. We are awaiting a press conference from President Biden. He's going to be giving an update on the international conflict in Ukraine and Russia. We are going to continue to monitor that shot when it comes up. But first, let's take a look at some of the COVID vaccine stocks you just saw there on your screen as you're taking a live shot in Washington, D.C. Turning back to some of the vaccine stocks that we're keeping a close eye on here on the day. You're seeing gains pretty much across the board. Pfizer, the lone laggard right now, flat just barely to the downside. Pfizer reported earnings this time last week. They revealed $42.6 billion in revenue for its vaccine business in totality during the full year of 2021. But as of recent, has pulled its 5 and under vaccine submission. An update expected in April there. J&J, you're seeing them on your screen, higher by about 0.9%. They reported their earnings in the latter half of January, saw $2.4 billion in revenue specifically for its COVID vaccine during 2021. And Moderna, take a look at shares there. They are up by about 7%. Novavax also up 10%. AstraZeneca up 4.3%. Moderna reports their earnings next Thursday, highly anticipated from the biopharma company. Emily, I'll toss things on over to you.
Thanks, Brad. Americans are getting booster shots of COVID-19 vaccines at their lowest rates on record, based on a new report from CNN. As of the start of the week, about 64% of Americans were fully vaccinated against COVID, while only 28% had received a booster dose. For more, we're welcoming in Dr. Anthony Harris, founder and CEO of HFit Health. Dr. Harris, thank you so much for joining us. Does this slowdown in booster shots track with what you've been seeing as well? And what does this mean potentially about our ability to address the pandemic and potential future variants here in the U.S.?
Absolutely. Well, thanks first and foremost for having me on here. And yes, what we're seeing in terms of the slowdown of the booster is what we actually anticipated in the clinical community in regards to Omicron, right? When Omicron hit, everyone started hearing news that this was the end of the pandemic because Omicron would be so widespread, we'd have herd immunity. And so why go get boosted? And we saw that started to play out really early in the inception of Omicron, beginning of this year. And we're still seeing ripple effects from that at the anecdotal level as well as nationwide. So unfortunately, what we feared would play out in terms of messaging has eventually played out and will lead to, our performance being drastically lower than what we see across the pond, where we're talking 75+% of the population fully boosted.
And Dr. Harris, your company, HFit Health, also offers low-cost access to COVID testing, including for employees who have to test regularly for their jobs. How many people have you been seeing use this service lately versus those using your vaccination verification service? And how have these trends changed recently?
Sure. So we're seeing still a significant number of individuals using our service for low-cost testing. It's no different than what you're seeing, at your local pharmacy or what you're seeing available down the street at different institutions that are doing these drive-thrus, right? The unique value of what we're talking about and what we provide is we're doing this at the workplace. So the convenience of being at work or the likelihood of going to work with COVID now is decreased because we're allowing people to test before they show up to work. And we're seeing that also we're seeing more and more companies turning to screening, right? At this point in time of the pandemic, so many people, we're looking at Dr. Gottlieb estimating half of the US population will get Omicron just in and of itself. And so screening for symptoms is going to be key for keeping ill people from showing up or asymptomatic people who have COVID that can transmit it from showing up to work. And so we are seeing an increase in leaning on the screening services. We've done over 15 million screens throughout the pandemic, and we know how to do it well in terms of keeping people at home that should be home because of COVID infection.
And when we think about the RTO, return to office for companies, just yesterday, Microsoft announced that it was reopening its Washington State and California Bay Area offices at the end of this month. Do you think we're at the point where new cases have fallen sufficiently across the U.S. to warrant wide-scale reopenings for some of these major companies?
If the trend continues, the answer to that is yes, right? But as of last week, we were still at a level of infection on a daily 7-day average that we were at the peak of Delta, right? And so we know because of widespread Omicron that we still want to see a trending down nationally. But unfortunately, if we see a turnaround that was seen in Denmark, that was seen in Sweden, where they encountered BA2, the second iteration of Omicron, the sublineage, then we may see that trend slow down in terms of downward and hopefully not reverse. But if it does, I do anticipate these companies might be reversing their policy in terms of return to work.
And on the other front, internationally, one other headline that we're tracking is in China. The country unexpectedly decided to approve Pfizer's Paxlovid coronavirus pill for use in the country. This is being seen as the sign that China may be moving away from the COVID zero policy, since it's now bringing in a COVID treatment from the U.S., no less. Now, do you think this shift to COVID management rather than eradication is the right one for China and the world?
Sure. I think it, no matter what, is the right move for keeping the health and wellness of their population, right? To have more in your armamentarium in terms of treatment for COVID is going to be beneficial for population health. And we know that the data on this medication is phenomenal. We're talking an 86, I believe it's 86% reduction in risk for severe illness and hospitalization. And so we know in terms of intervention as a pill, this medication is going to be key.
Just to jump in real quick here. Everyone, just to jump in, President Biden is speaking, giving brief remarks, and an update on Russia and Ukraine. Let's listen in.
In this crisis, I have been absolutely clear and consistent. The United States is prepared no matter what happens. We are ready with diplomacy, to be engaged in diplomacy with Russia, and our allies and partners to improve stability and security in Europe as a whole, and we are ready to respond decisively to Russian attack on Ukraine, which is still very much a possibility. For all the events of the last few weeks and months, this has been our approach, and it remains our approach now. So today I want to speak to the American people about the situation on the ground, the steps we've taken, the actions we're prepared to take, and what's at stake for us and the world, and how this may impact on us here at home. For weeks now, together with our allies and partners, my administration has engaged in non-stop diplomacy. This weekend, I spoke again with President Putin to make clear that we are ready to keep pursuing high-level diplomacy, to reach written understandings among Russia, the United States, and the nations of Europe to address legitimate security concerns, if that's his wish. Their security concerns and ours. President Putin and I agreed that our team should continue to engage toward this end, along with our European allies and partners. Yesterday, the Russian government publicly proposed to continue the diplomacy. I agree. We should give the diplomacy every chance to succeed. And I believe there are real ways to address our respective security concerns. The United States has put on the table concrete ideas to establish a security environment in Europe. We're proposing new arms control measures, new transparency measures, new strategic stability measures. These measures would apply to all parties, NATO and Russia alike. We're willing to make practical, result-oriented steps that can advance our common security. We will not sacrifice basic principles, though. Nations have a right to sovereignty and territorial integrity. They have the freedom to set their own course and choose with whom they will associate. But that still leaves plenty of room for diplomacy and for de-escalation. That's the best way forward for all parties, in our view. We'll continue our diplomatic efforts in close consultation with our allies and our partners. As long as there is hope of diplomatic resolution that prevents the use of force and avoids incredible human suffering that would follow, we will pursue it. The Russian defense minister reported today that some military units are leaving their positions near Ukraine. That would be good, but we have not yet verified that. We have not yet verified the Russian military units are returning to their home bases. Indeed, our analysts indicate that they remain very much in a threatening position. And the fact remains, right now, Russia has more than 150,000 troops encircling Ukraine and Belarus and along Ukraine's border. An invasion remains distinctly possible. That's why I've asked several times that all Americans in Ukraine leave now before it's too late to leave safely. It is why we have temporarily relocated our embassy from Kyiv to Lviv in western Ukraine, approaching the Polish border. And we've been transparent with the American people and with the world about Russia's plans and the seriousness of the situation so that everyone can see for themselves what is happening. We've shared what we know and what we're doing about it. Let me be equally clear about what we are not doing. The United States and NATO are not a threat to Russia. Ukraine is not threatening Russia. Neither the U.S. nor NATO have missiles in Ukraine. We do not have plans to put them there as well. We're not targeting the people of Russia. We do not seek to destabilize Russia. To the citizens of Russia, you are not our enemy. And I do not believe you want a bloody, destructive war against Ukraine, a country and a people with whom you share such deep ties of family, history, and culture. 77 years ago, our people fought and sacrificed side by side to end the worst war in history. World War II was a war of necessity. But if Russia attacks Ukraine, it would be a war of choice, or a war without cause or reason. I say these things not to provoke, but to speak the truth, because the truth matters. Accountability matters. If Russia does invade in the days and weeks ahead, The human cost for Ukraine will be immense. And the strategic cost for Russia will also be immense. If Russia attacks Ukraine, it'll be met with overwhelming international condemnation. The world will not forget that Russia chose needless death and destruction. Invading Ukraine will prove to be a self-inflicted wound. The United States and our allies and partners will respond decisively. The West is united and galvanized. Today, our NATO allies and the alliance is as unified and determined as it has ever been. And the source of our unbreakable strength continues to be the power, resilience, and universal appeal of our shared democratic values. Because this is about more than just Russia and Ukraine. It's about standing for what we believe in, for the future we want for our world, for liberty, the right of countless countries to choose their own destiny, and the right of people to determine their own futures, for the principle that a country can't change its neighbors' borders by force. That's our vision. And toward that end, I'm confident that vision, that freedom will prevail. If Russia proceeds, we will rally the world to oppose its aggression. The United States and our allies and partners around the world are ready to impose powerful sanctions on export controls, including actions that we did not pursue when Russia invaded Crimea in eastern Ukraine in 2014. We will put intense pressure on their largest and most significant financial institutions and key industries. These measures are ready to go as soon and if Russia moves. We'll impose long-term consequences that will undermine Russia's ability to compete economically and strategically. And when it comes to Nord Stream 2, the pipeline that would bring natural gas from Russia to Germany, if Russia further invades Ukraine, it will not happen. While I will not send American servicemen to fight in Ukraine, we have supplied the Ukrainian military with equipment to help them defend themselves. We provided training and advice and intelligence for the same purpose. And make no mistake, the United States will defend every inch of NATO territory with the full force of American power. An attack against one NATO country is an attack against all of us. And the United States' commitment to Article 5 is sacrosanct. Already, in response to Russia's buildup of troops, I've sent additional U.S. forces to bolster NATO's eastern flank. Several of our allies have also announced they'll add forces and capabilities to ensure deterrence and defense along NATO's eastern flank. We will also continue to conduct military exercises with our allies and partners to enhance defensive readiness. And if Russia invades, we'll take further steps to reinforce our presence in NATO, reassure us for our allies, and deter further aggression. To be clear, if Russia decides to invade, that would also have consequences here at home. But the American people understand that defending democracy and liberty is never without cost. This is a cause that unites Republicans and Democrats. And I want to thank the leaders and members of Congress of both parties who've forcefully spoken out in defense of our most basic, most bipartisan, most American principles. I will not pretend this will be painless. There could be impact on our energy prices. So we are taking active steps to alleviate the pressure on our own energy markets and offset raising prices. We're coordinating with major energy consumers and producers. We're prepared to deploy all the tools and authority at our disposal to provide relief at the gas pump. And I'll work with Congress on additional measures to help protect consumers and address the impact of prices at the pump. We are not seeking direct confrontation with Russia, though I've been clear that if Russia targets Americans in Ukraine, we will respond forcefully. And if Russia attacks the United States or our allies through asymmetric means, like disruptive cyber attacks against our companies or critical infrastructure, we are prepared to respond. But we're moving in lockstep with our NATO allies and partners to deepen our collective defense against threats in cyberspace. Two paths are still open. For the sake of historic responsibility, Russia and the United States share for global stability, for the sake of our common future, to choose diplomacy. But let there be no doubt, if Russia commits this breach by invading Ukraine, responsible nations around the world will not hesitate to respond. We do not stand for freedom where it is at risk today. We'll surely pay a steeper price tomorrow. Thank you. I'll keep you informed.
Mr. President, whether or not they are de-escalating. That was President Biden there speaking live on the Ukraine-Russia tensions. He called this a war of choice if Russia invades, touched on a number of things, including diplomacy, but also sanctions, as well as global implications if perhaps U.S. consumers and citizens are affected by the fallout. I want to bring in Yahoo Finance's own Jennifer Schonberger to break down what Biden said in that speech. Jennifer?
Good afternoon. It looks like tensions may be cooling for now. President Biden saying he spoke with Russian President Vladimir Putin, and both have agreed to continue moving forward with diplomatic efforts. This after Putin yesterday said to his foreign minister Lavrov that diplomacy does seem to be the path forward. That said, there are reports that Russia's ministry is pulling back on some of those troops at the border, but President Biden says the U.S. is not been able to verify that yet, and that over 150,000 troops likely still remain at that border. Now, Biden did warn that invasion still remains a, quote, distinct possibility, and he reiterated that the U.S. and its allies are ready to impose strict sanctions and take other measures if Russia does decide to invade Ukraine. He says that they will work to undermine Russia's ability to compete globally, and when it comes to that critical Nord 2 gas pipeline between Germany and Russia, that will be put to rest, cutting off a major cash flow to Russia as far as energy is concerned. The president did warn, though, that if tensions escalate, that it could affect energy prices here in the U.S., and that the president is talking with energy producers and consumers about ways to ease those pressures so that there is no further upward pressure at the gas pump for Americans. He's also said that he's working with members of Congress. Last we heard from the president, it seemed like Russia was ready to invade as soon as Wednesday. But again, it looks like tensions cooling for now as both look towards the path of diplomacy. Back to you.
A fast-moving story indeed. Thank you so much to Yahoo Finance's Jennifer Schonberger. All right, for the latest on the Russia-Ukraine standoff and what's at stake, I want to welcome John Herbst, former U.S. ambassador to Ukraine and now director of the Atlantic Council's Eurasia Center. Ambassador, thank you for taking the time to join us today. I want to first start by getting your reaction to President Biden's speech. He was updating the American people on the tensions, on the measures as well. What stood out for you from this speech, and what were you hoping to hear more about?
Look, this was a continuation of essentially a solid Biden administration-led response to Putin's threat to invade Ukraine with conventional forces on a large scale. The administration has been consistent going back to at least November, laying out there'd be a strong U.S.-led response in terms of punishing sanctions, increasing NATO forces along Russia's border, and sending additional arms to Ukraine. He was clear-eyed. He was strong in laying that out once more in his press conference just now, his press statement just now.
Now, it's difficult because on the one hand, we're seeing this partial drawdown of some troops at the Russia-Ukraine border, but we're not sure where they're going to be permanently. And you're also seeing this more diplomatic tone, but Russia still says it's going to continue military drills. And Ukrainian officials, look, they want more concrete action from Russia. Talk about this strategy of mixed signals and what we should read from that.
Look, we still don't know what Moscow is up to. They've announced today they're pulling some troops back from the border, but according to Secretary General Stoltenberg of NATO, we have not had confirmation of that. So we have to wait and see. At the same time, the Duma, the parliament in Russia, has said that Russia should annex the territories they occupy in Ukraine's east, the Luhansk and Donetsk People's Republic. So that's obviously an unfriendly signal. My sense is that Putin is a risk taker, but a cautious one. He is deeply concerned about the tough measures Russia will face if, in fact, he does invade Ukraine. So he's going to stand down. But he will keep pressure on Ukraine because he's still trying to disrupt Ukraine's westward-oriented foreign policy.
Ambassador, when we think about the strategy that's at play from both sides, but also the diplomacy that's attempting to be shown here and hopefully wins out, with the number of troops that are being told, from Russia at least, that are being withdrawn and pulled back, as you mentioned there, yet, as President Biden had said, Russian defense reported these military units returning. However, that's unverified at this point. What measures would the administration be able to take to verify that information? And would they still be, what is the strategy around releasing that information to the public once verified?
We have excellent intelligence. And if the Russians, in fact, are removing those troops, we will see it. And of course, if Moscow wants to make clear the way we see it, they will do it in a way so it's easily visible to us. So as far as I'm concerned, until we hear from someone authoritative, whether it's in Washington or in Brussels at NATO or in London, we should keep that as something which may be happening, but which we're not certain is happening. But in any case, even the statement is a sign that Moscow wants to de-escalate tensions a little bit. Again, I think it's because Putin is afraid of the consequences of actually launching a major invasion of Ukraine.
The president also gave a clear nod to how this may impact energy prices, and that they're going to have to do more from the White House's side to also curb the impacts to Americans. What measures do you expect them to take at this point, especially as Americans are largely looking at energy prices that have been soaring for themselves too?
Well, the administration has been doing a very energetic work around the globe trying to find possible substitutes for Russian natural gas to Europe. I think it would also be, and they've also been asking OPEC to increase oil production. The administration so far is not willing to talk about a great increase in American hydrocarbon production because they have decided to pursue this very strict, regimented green energy policy. This is something else, though, they could do if they truly want to ease gas and oil prices in the U.S.
Ambassador, broadening this out a bit for a moment here, what do we know now about what Russia and Russian President Vladimir Putin wants with Ukraine, and how might these motives play into the diplomatic discussions going forward?
Unfortunately, Mr. Putin has very aggressive designs, not just on Ukraine, but on all of the countries that used to be part of the Soviet Empire. You know, they sent us these draft treaties in late December, one for us and one for NATO. And in those treaties, they said that all the countries that joined NATO after the Cold War ended, after the Soviet Union collapsed, would have to remove troops and weapons because Moscow wants to be able to have major influence over those countries. That is in effect an attack, at least an implicit attack on our NATO allies, and we cannot allow that. In Ukraine, Putin's objective is to push Ukraine from a westward-oriented foreign policy to a Moscow-oriented foreign policy. We have a vital stake in making sure Putin fails in Ukraine, because if he succeeds in Ukraine, his next target will be our NATO allies, whom we must defend with arms, with our own troops. And we don't want to have to do that. So let's beat Putin in Ukraine using sanctions and NATO deployments and not U.S. soldiers.
And at this juncture, are there specific moves from Russia or from the U.S. and its allies that you think we should be keeping an eye on as a signal of whether this is continuing to move in a diplomatic direction or switching back to a more militant direction?
All right. Moscow, again, has been threatening a major invasion for over a month now, a couple of months. Again, I've been a little bit skeptical that Putin will actually pull the trigger because, again, he's afraid of what we'll do. But here's something. If, in fact, the Russians announce that, quote unquote, Ukrainians have attacked either ethnic Russians in Ukraine or they have launched an attack on Russian forces, that will be the pretext for Moscow to actually launch an invasion of Ukraine. So that's something to watch for. Now, indicators that the Russians are going to de-escalate the current crisis, well, I think we may have seen two today. First, again, was the announcement they're pulling forces back from the border. But again, that has not been confirmed. The second is a statement by the Russian Foreign Ministry's spokeswoman, Zakharova, that Russia, by pulling back its forces from Ukraine, has won a great victory over the West, which said that Moscow was going to invade. So I take that as an indicator that Putin may well be interested in, at least for a little bit of time, de-escalating tensions.
And Ambassador, as we know, Ukraine is not a NATO member, but what happens between Russia and Ukraine, as the president mentioned, affects the global economy. Now, piped gas from Russia accounts for a third of the gas burned in Europe. Other than being the top producer of one of the top producers of natural gas, also oil, nickel, palladium, copper, coal, potash, wheat, and others. How do some of these allies then strike that balance between Russia and sanctions while also trying to protect their own economic interests at home?
Look, that's a very important question. In part, this problem exists because of very short-sighted policies in Germany to make the agreement to create this Nord Stream 2 pipeline, which is a disaster for the United States, for Eastern Europe, and for that matter, for Germany as a NATO ally. But this is the situation we're in right now. What we can do is, I mean, again, if Moscow goes into Ukraine with those forces, we will impose punishing sanctions. Then Putin has a dilemma. He can either punch back by reducing gas supplies to Europe, or he can just maintain gas supplies. If he does reduce gas supplies to Europe, he can probably afford that for 4, 6, 8 months, in which time, though, he would deplete his war chest of surplus. He has a fund of about $600 billion. That will be depleted within a year if they're not getting oil revenues from the EU. So he could do that, but I'm not certain that he will. And again, the United States has taken some steps. It needs to do more to help ensure security of gas supplies to Europe if Moscow decides to play that card.
A delicate balancing act indeed. We do thank you for helping us with our team coverage there. John Herbst there, former US ambassador to Ukraine and director of the Atlantic Council's Eurasia Center. Ambassador, thank you so much. All right, do stay with us on Yahoo Finance. We're going to be just checking in on what's happening with markets minutes away from the closing countdown. Do stay with us.
Welcome back to Yahoo Finance Live, everyone. Just about 5 minutes left until the end of today's trading session. Major averages still in the green. Let's bring in Yahoo Finance's Jared Blickery as we're getting closer to the closing bell. Giving up a little bit of steam here, Jared, as the president was speaking.
That's right. And at first, the reaction was negative. And if you take a look at the S&P 500, doesn't look like a whole lot of movement, but we did get a little bit of a downdraft right there. But guess what? That minor dip was bought, and we are back up to session highs right now. Very similar story with the market-leading NASDAQ. That's up 2.5%, set for its best day in, I believe, 8 weeks. And let's take a look at the sector action as well, where we see tech adding to gains. That is XLK in the upper left, followed by XLY, that's consumer discretionary, housing, Amazon.com, and then materials. All of three of those are outperforming, but we got industrials close behind. Let's take a look at the NASDAQ 100, where we can see some of the mega caps getting some love today, namely Apple. That's up 2%, Microsoft almost there with it, but Tesla up 5% and NVIDIA up 9%. So impressive to see what the semiconductors have been doing here. You can see a sea of dark green here. We're going to get some earnings after the bell. And also, if you look at the software space, seeing some nice gains here too. Salesforce up over 3.5%, Shopify up over 5%. And I'd like to look at the meme stocks as well, just kind of as a sentiment indicator. We can see GameStop up 7%, American Airlines up 8%, Discovery, which we're going to be bringing their earnings after the bell, that's up 3.5%, AMC nearly 10%. So interesting to see the sector action play out today. We looked at Tesla before, but a lot of these smaller names showing some momentum to the upside. FuelCell up 19%, guys.
Jared Blickery, thank you so much for that breakdown. Coming up, we'll take you to the closing bell and beyond as we await earnings results from Airbnb and Roblox. Stick with us.
Welcome back to Yahoo Finance Live, everyone. Just seconds remaining in today's trading session. Brad Smith here with Emily McCormick and Rochelle Akufo. And also joining us for the market close, we've got Hal Reynolds, Los Angeles Capital Chief Investment Officer, and James Bruderman, who is the 1879 Advisors Vice Chairman. Hal and James, we're going to kick off our discussion in a moment. But first, we've got to check in on the major averages to see where we are trending, now moving closer to the closing bell. Just seconds out, the Dow holding on to gains of about 1.2%, 400 points higher on the day. S&P 500, you're seeing that hold on to gains of about 1.5% right now, 68 points higher. And the NASDAQ Composite tech-heavy average there, that's up by about 344 points. On the sector front, we're being led, it seems right now, by consumer discretionary going into the close. You've got about 9 out of 11 sectors in positive territory right now. We'll continue to watch that, plus some earnings on the other side of the closing bell. Let's watch as the bell rings.
And that is a closing bell this Tuesday, February 15th. A lot of green across the screen as we take a look at the three major stock indexes. The Dow Jones Industrial Average up more than 420 points, or about 1.2%. The S&P 500 up about 1.6%, led by the information technology, consumer discretionary, and material sectors, all outperforming in that index. And the Nasdaq Composite, the outperformer on the day, up about 2.5%. Now, turning back here to our panel, Hal, I'll turn this first question over to you. Is this increase that we're seeing across stocks something that can be sustained, or is this just a momentary relief rally on the more positive news that we've been getting today out on the Russia-Ukraine front?
Well, we'll certainly take the good news that we received today. Hopefully it'll last. None of us know. But I would say no. I would say, the underlying fundamentals that we're facing here in terms of rising rates and decelerating earnings, it's going to present a challenge for stocks in the coming year.
And James, if we take a look under the hood here at the sector performance, energy was one of the biggest laggard in the S&P 500 today. We saw oil prices moving lower. Do you think this is a sign that this outperformance that we've seen in the commodity space and in the energy sector specifically was perhaps a little bit overdone? Or do you think this is potentially something that we could see rebound?
Well, I think that the threats we've seen on the geopolitical front and the thought of higher energy prices, especially given the constraints of supply, I think across the universe, bode well for energy companies in a rising energy rate environment. But whether or not these rising prices are sustainable depends as much on the geopolitical environment as it does on the economy.
And Hal, I want to bring you in here. As a more hawkish Fed prepares us to raise interest rates multiple times, most likely aggressively, we're seeing investors obviously pouring now more into treasuries, some of these safe havens. How else should investors be preparing as the credit market tightens and the Fed pulls back its policy stimulus?
Well, it's an interesting question because there are really two questions. What is the impact of rising rates on valuations? We know quite clearly that's been a real problem, even for the highest quality growth stocks, as their valuations have come down because of rising rates. But I think you really maybe need to look past the next 6 months and ask yourself, where can you find protection should inflation persist longer than many believe? Many of us think that the unwinding of the supply constraints will happen in the second half of the year, and that the central banks, maybe in another year or so, will be back to fighting the old war of disinflation and possibly even deflation. And so anyway, I think you can't ignore the fact that inflation can be sticky, wage inflation particularly. And so one needs to look at companies that have pricing power and have better profit margins and can withstand, have the ability to pass those higher input costs through to their customers. And so while technology has certainly been beaten up here in the last couple months, I think some of those firms may be the ones that are best able to withstand rising input costs and be able to pass those costs on to their customers.
And speaking of passing on costs to customers, James, I want to bring you in here. How concerned should investors be about U.S. wholesale prices jumping 1% in January, blowing past those 0.5% expectations, as these costs do get passed on to consumers, which just adds to some of this inflationary pressure?
Yeah, they certainly have jumped, but in terms of their overall growth, and they haven't softened either, but they haven't jumped as much as they could have. And I do think that we're seeing something of a topping out on the year-over-year comparisons. In fact, we think that as we go forward, we'll see some of that supply chain easement and some of that base level effect as a positive as a positive backdrop to the otherwise seemingly hot inflation environment. We're simply put, we're not as concerned about rampant inflation as a lot of the pundits on the street currently are.
And James, sticking with you believe that GDP could revert to a more sustainable trend of around 3% by Q4 of 2022. What would that be on the back of, or what would be the catalyst for that target?
We think there's a lot of natural demand. We think the economy certainly has the wind at its back. We had a very strong Q4, maybe a little bit over strong, as companies were replenishing inventories. We're off to a weak start in Q1. I based a lot of that on maybe some of the hiccups we saw with Omicron coming in late in the quarter, and certainly, having a significant portion of the workforce home in January. So we think that we're going to see a continued pop. We think on the one hand, on the good side, things from a supply chain standpoint ease themselves, maybe not so quickly with automobiles, but for goods in general, we see inflation becoming less of a big thing. We do think that hospitality and entertainment and a lot of the service economy is certainly going to have their day, and that could lead to things heating up later this quarter and certainly into the summer. And then, as we progress further into the year, we do think that there's enough economic strength and there's enough buying power in the economy. Certainly, there's strong wages, productivity is on an upswing. So we think inherently underpinning the market is a sense of growth that we think stabilizes somewhere in the 3% range as we get closer to Q4.
All right, Hal and James, we got to leave things there on the day. We've got some earnings coming out. Hal Reynolds, Los Angeles Capital Chief Investment Officer, joining us, as well as James Bruderman, 1879 Advisors Vice Chairman. We appreciate the time here today. We've got some movement in after hours on the tape. Roblox shares moving as of right now, and Yahoo Finance's Inez Ferre is standing by for those numbers. What is the reading, Inez?
Well, Brad, taking a look at fourth quarter revenue, that came in at $568 million, and that was a miss. Also, looking at loss per share, that came in at 25 cents, a big miss there as well. Bookings coming in at 770.1 million. The estimate was for 786 million. Hours engaged coming in at 10.8 and a billion. The estimate was for 11.19 billion. So across the board with these metrics, at least, you are seeing a miss. And right now, shares are down in after hours. Year to date, shares are down 26%. This company, this is a play on the emerging metaverse. And analysts would be paying attention to user numbers, the international growth, how each of these monetizes, and also brand offerings. But according these metrics that we're looking at right now seem to be a miss, and shares are reacting.
All right, Yahoo Finance's Inez Ferre, thank you so much for that breakdown. And the earnings continue to roll in this afternoon. Yahoo Finance's own Jared Blickery is standing by with the numbers from Viacom CBS. Jared?
That's right. A little disappointment on the bottom line number. Adjusted EPS from continuing operations, that came in at 26 cents, 19 cents short of the Wall Street estimate of 45 cents. You can see shares down about 1% in after-hour trading. EPS from continuing operations, $3.05. Don't have a comp right there for that number. Revenue coming in at $8 billion, topping the Street's estimate of $7.5 billion. And then finally, I got a statement from the earnings on their subscriber growth, and that would be Paramount and Peacock. So they're saying, fueled by a diverse global content offering, subscriber acquisition and consumption on Paramount Plus accelerated. And that was driven by original scripted dramas, 1883 and Mayor of Kingston, family-friendly films such as Clifford the Big Red Dog, and live sports with the NFL on CBS. Now, Viacom's fourth quarter streaming revenue, that came in at $1.32 billion, topping estimates of $1.26 billion. And that breaks down into two categories. Advertising revenue, $684 million versus estimates of $657 million, and then also streaming subscription revenue, $631 million. All in all, so they added 9.4 million subscribers during the quarter, and I do have a statement from the company CEO saying, fueled by a diverse global content offering, subscriber acquisition and consumption on Paramount Plus accelerated, driven by original scripted dramas. I think I just read that. Not sure why that's on there twice, but I'm going to go back and just say that Viacom CBS added 10 million Pluto TV global monthly active users. Let's take a quick look at the stock right now. And we can see over the last 2 months up about 21%, but largely choppy sideways trading. Let's not forget, a year ago, this was a meme stock. And I think Archegos had a little problem with that short squeeze right there. So nevertheless, looking at a little bit of a disappointment off of that bottom line miss, guys.
All right, thank you to Yahoo Finance's Jared Blickery there with the after-hours earnings reaction. All right, up next on Yahoo Finance, a record-breaking year for commercial gaming. We'll check in what made 2021 a bumpy year and how the industry is expanding.
Welcome back, everyone. Today, the American Gaming Association releases the full year 2021 commercial gaming revenue just days after the Super Bowl, which was anticipated to have seen $7.61 billion worth of wagers. Joining us to help break down the 2021 results and the forecast for the year ahead, we've got Bill Miller, who is the American Gaming Association CEO, and Yahoo Finance's Alexis Keenan joining us here for the conversation as well. Bill, let's just dive right into it. The headline figure for 2021 commercial gaming revenue, what was it, and how did we see this year-over-year growth achieved?
Well, first, thanks for having me on. And absolutely, we crossed $50 billion in commercial gaming revenue for the first time in the history of the industry. $53 billion, up 77% year over year, and 21% over the best year in the gaming industry's history, which was 2019.
Bill, it's Alexis here. Now, I want to ask you about the fact that some form of betting is legal in most U.S. states, but for Utah, Georgia, and South Carolina. Yet sports betting still lags behind that brick and mortar style of wagering. So in 2021, we had those 7 new U.S. sporting betting markets join in, but I'm curious about the $57.2 billion that your organization reports in sports betting handle. Now, that's the total amount wagered by sports bettors versus $4.29 billion in revenue. So that's just about a little less than 8% of handle. So I want to learn what's driving that seemingly small fraction there.
First of all, it is exciting to think about. It's hard to really believe that 4 years ago, when the Supreme Court ruled that it was inappropriate that Nevada had the only place in America where you could legally bet on sports, that we now have 33 states in the District of Columbia where you can actually legally place a bet on a sporting event. And so we've seen massive growth across the country, and still, 10 states just from the Super Bowl last year to the Super Bowl this year. Still a number of states, some big states, some states that will probably never legalize some form of gaming, but that's okay. And that's really the prerogative of the states. But to your question with regard to the difference between, from handle to revenue, it's really a function that, unlike other pieces in the gaming industry, slots, table games, et cetera, it's a low margin business for sportsbook operators.
And so with regard to that, Bill, do you ever think that that revenue number, the amount that actually gets taxed here, is ever going to be a larger percentage of the overall handle?
I don't. I think because, number one, unlike in sports betting, you're in essence playing a hedge, and you take 10% of the hold, but you also lose bets. And so there are sometimes when sports books make money, and there are sometimes when sports books lose money. And so the reality is, unlike with a slot hold or a table hold, the percentage of revenue vis-a-vis the overall handle is always going to be a small number.
Bill, you've talked about the fact that travel is still a headwind, as is fewer events for the gaming industry. Despite a record-breaking year, though, do you think that the stay-at-home factor could instead have maybe driven wagering and been a boon for the business because people are looking for something to do when they're not at those events?
Well, I think one major change that's happened in this industry has been the adaptability and really the adoption of traditional brick and mortar brands to the online experience. In essence, what we call is an omni-channel experience, where you know that someone's only going to be able to visit your property X number of times a year, but you want to continue to have a relationship with them, whether it be the offerings that you have in terms of sporting events, et cetera, or the ability to place mobile wagering. CDC and COVID really did accelerate that, as well as modernizing payments and digitizing the industry. But really what we're seeing is an evolution in the industry to really allow for in-person experiences that, there's nothing like Las Vegas. There's nothing like the entertainment that comes from that place and of our resorts. But there's also the ability for you to, as you are in so many other areas of your life, be able to do it when you want to and where you want to.
So, Bill, we're going to ask you last year to do a little handicapping of your own. There are some big states, namely California and Florida, that still do not allow sports betting. Florida with some legal complications holding up the show there. So if you were to make a wager on which state would be the next to legalize, which one would you pick?
That's a great question. And they're really two different, it's two different fields if you want to take the metaphor a little bit further. In Florida, it's about the courts. And in California, it's about the voters. And what we've seen in the last few years is the voters have resoundingly supported the expansion of sports betting. And the courts, recently, it's been a mixed bag. But I'm hopeful and believe very soon that we will have California, Florida, and we're probably a year or so away from Texas. But that'll be the trifecta that I'd look for.
Yeah, going to be watching closely in the Lone Star State to see when that comes online. Bill Miller, American Gaming Association CEO, joining us here today, as well as Yahoo Finance's Alexis Keenan for the conversation. Appreciate the time. And we've got even more earnings that have come out this afternoon. For that, let me toss things on over to Emily.
All right, Brad, as you mentioned, we are seeing the earnings continuing to roll in this afternoon. Airbnb, the latest to cross the tape. And we have Yahoo Finance's Jared Blickery standing by with the numbers. Jared. That's
right. We have Airbnb up about 3.5% in after-hours trading. Revenue, pretty nice beat here, $1.53 billion, beating the street estimate of $1.46 billion. That number is up 78% year over year. Now, EPS was a little bit of a disappointment. It came in at it came in as a beat of 8 cents. The estimate was for 3 cents. And here's a key statistic. Gross booking value, $11.3 billion, up 92% year over year, pretty close to the estimate of $11.09 billion. And adjusted EBITDA, $334 million versus a loss of $20.5 million a year ago, and much higher than the estimate of $286 million. That's accounting for that beat on the bottom line EPS number. Nights and experience booked, 73.4 million, a little bit shy of the Wall Street estimate of 75.3 million. Finally, free cash flow, 376 million versus an estimate of negative 142.6 million. So the cash position looking pretty good there. Total stock-based compensation expense, that was 225 million, a little bit larger than the estimate of 199 million. And here's this first quarter forecast for Airbnb. They are seeing revenue of 1.41 billion to 1.48 billion, and that is trouncing the estimates of 1.22 billion. Now, some commentary from the earnings report. We expect to achieve our first positive Q1 adjusted EBITDA, and we expect Q1 2022 nights and experiences booked to significantly exceed Q1 2019 levels. We currently anticipate the Q1 2022 ADR, and that's average daily rate, to be up approximately 4% from Q1 2021. And starting in Q1, we will begin using corporate cash to make all tax payments associated with employee equity grants, reducing the rate of shareholder dilution. That has to do with their good cash position, which did surprise the street, so not going to be diluting their shareholders as much anymore. Now, Airbnb has been a stock that has been under a little bit of pressure at various times in the year. You can see it's up 8% year to date, up 6% today before we got this earnings report. You take a look at a max chart, and this is very much sideways action here. So kind of in the middle of its range. Have to see if this can catalyze a move to the upper end around 210, 215 per share, guys. I can go on. Well,
all right, I think Rochelle may be muted, but thank you so much, Jared Blickery, for that breakdown. And again, Airbnb shares up about 5.6% in after-hours trading. But coming up, we'll tell you the winners and losers of today's session. Stick with us. Welcome back. Let's get a check of where Roblox is trading after reporting earnings results after market close this afternoon. As we can see, those shares moving sharply lower after that disappointing number on fourth quarter bookings. Now, that is a closely watched metric here for the gaming company. Those coming in at $770 million, up 20% year on year, but below expectations for $786.2 million. So that is the number that Wall Street is looking at here that came in a little bit short of expectations and driving this more than 11% drop that we are now seeing in shares of Roblox. But speaking of losses, it's time now to chat some winners and losers of today's session. And today's winner, Good Morning America. ABC's morning show has won more viewers overall during the first week of the Olympics than NBC's Today Show has, and that's even given NBC is broadcasting the Winter Games. But Rochelle, what do you think about what this signals about audiences and even the Olympics this year?
So I do feel a bit bad for NBC because of the pandemic. Obviously, we had the Summer Olympics and then right after it, the Winter Olympics. I think maybe people were a little bit fed up. And I think also, I mean, we're used to seeing the NBC team really on the ground, trying out some of these sports and really making it more interactive. I think when you don't have that and it sort of like levels the playing field among broadcasters, I see why perhaps GMA was a fresh voice that people might have been interested in looking at. Brad, what do you think?
Yeah, I think for today, what they're going to look at is the demographic that they're going after, the most highly coveted, of course, between 25 and 54. And honestly, for today, they continue to hold on to that demographic and maintain a margin of victory, if you will. But again, when it comes broadly to how people are looking to access different norms for morning news. And I think for these two titles, they've gone neck and neck for years, and they're going to continue to try and vie for those advertising dollars, which is what it comes down to at the end of the day. Emily, I'm not sure if you have a preference between either two in the morning. We get up early and we immediately hit the wires, I would say.
Absolutely. I feel like growing up, Good Morning America tended to be that was on my parents' news channel, so something perhaps a little bit of a bias there on that front. But just taking a look at some of this historical data, GMA has not won the ratings gold medal. This according to Variety during the Olympics since the week of February 7th, 1992. So some interesting stats here to see GMA coming out ahead again during the Olympics. But speaking of the Winter Games, also want to turn over to our loser of today's session, or the losing story rather is how we should perhaps be framing it. But one story that we're watching closely is the Russian figure skater, Kamila Valieva. Now, she, of course, being one of the favorites to win some of the singles figure skating competitions here, of course, testing positive for a banned heart medication. That revelation coming out late last week. And based on this, she is going to be allowed to continue in the competition. But if she does place, we may not actually see a medal ceremony for her or for any of the other three who would otherwise be standing on the podium. And guys, I do think this is an interesting story that we continue to watch developing. But Brad, what are your thoughts on this?
Yeah, I think the IOC is on thin ice, quite frankly, when it comes down to their decision-making around this and even letting her continue to compete. Let's remember, Sha'Carri Richardson was told not to compete and was banned from competing, and she is looking for answers on this front as well. And that was for a substance that was legal in the state that she was in. However, for the IOC pushing back and still having their own regulations, they did not allow her to compete, yet there was this allowance for the Russian figure skater. And so I think there is this double standard, and the IOC, quite frankly, does need to answer for that. Rochelle, I'd love your thoughts on this.
And so it's interesting because you have a lot of governing bodies. You have the skating bodies, the IOC, sort of really at loggerheads on how to handle this. And honestly, I think the biggest sort of losers in this are some of the other competitors. Because as you mentioned, Sha'Carri not able to participate during track and field events. But then you also have a lot of people wondering, do I get an asterisk now? Did I actually win gold if the other people didn't really place? And I think it sort of, I don't know, it really sort of goes to the heart of the Olympics. If you walk away and you don't really get a medal, I don't know, it leaves a bad taste in the mouth, I think.
I fully agree. And I think at the end of the day, we're going to see where some of the continued voice from the IOC is heard on this matter going forward for sure. And the decision making that goes on that is above our heads and pay grades, many of us. But as we continue to track these winners and losers, we've got one big conversation that's about to take place on the other side of this short break. Congressman Jamal Bowman is calling out energy companies for dropping price increases on customers during the winter. The representative is the chair of the 117th Congress's Subcommittee on Energy and joins us next to discuss legislation he's looking to prioritize on Capitol Hill.
Welcome back. Let's get a check of shares of ViacomCBS. The company was one of several to report its latest quarterly results after market close today. And as you can see, that stock is trading in negative territory in the after hours session. Now, taking a look here at a couple of the highlights, adjusted earnings per share from continuing operations came in light compared to consensus expectations, those coming in at 26 cents versus the 45-cent expectation. And on the top line, revenue of $8 billion was a beat compared to the expectation for about $7.5 billion. Now, one other corporate announcement here coming out from ViacomCBS, or I should say the company about to be formally known as ViacomCBS, because the company is going to be now known as Paramount, perhaps with a renewed emphasis being placed on the streaming side of the business with this rebrand. But again, ViacomCBS changing its name now to Paramount. Rochelle?
Quite the change indeed. Thank you so much, Emily. Now, as part of our ongoing coverage for Black History Month, we explore some of the policies that have been shaping economic and the educational future of the Black community. In fact, just recently, Treasury Secretary Janet Yellen highlighted the systemic inequities in the U.S. economy and what her department needs to do to narrow the wealth divide. Well, I'd like to now bring in Congressman Jamal Bowman, who represents New York's 16th Congressional District. Thank you so much for joining me today. Now, obviously, we're in the middle of winter and in the middle of a pandemic, and we're seeing natural gas prices in some cases doubling or even tripling. Talk about your actions on so-called energy poverty, who it affects, and the sort of action being taken on it.
Well, energy poverty impacts everyone, particularly those who do not earn the prevailing wage in the workplace and those who struggle with overall poverty. And unfortunately, that always disproportionately impacts people of color, Black people, and particularly women who unfortunately are often single moms. So it's important for us, not just the US government, to ensure that we are providing resources for people who struggle with poverty to cover their energy costs. It's also very important for us to hold energy companies accountable for price gouging that continues to be pervasive and prevalent in the energy and utility sector. I mean, just recently we saw Con Ed prices double and even triple in parts of my district here in New York 16, and their sort of explanation for that is the market. Well, we're responding to the market. These are aspects of our economy that continue to contribute to inequality overall and continue to hurt working families and families that struggle with poverty.
And obviously, this isn't something that happens overnight. There are systemic inequities, as the Treasury was saying. Now, you introduced the African American History Act bill that invests $10 million over 5 years in the National Museum of African American History and Culture. Now, that goes to support African American history education programs. As an educator yourself, how important is this bill and the initiatives it funds, not just to the Black community, but also students, parents, and educators?
Well, it helps all students to understand the impact of racism and systemic racism on all aspects of American institutions. Oftentimes we think about and talk about racism as it's one individual racist to another, and that is obviously part of it, but it's also systemic. It's in how we think, it's in how we behave, and it's in how we legislate. And the African American History Act helps to curate and consolidate resources from across the country and around the world that schools can use to teach African American history accurately. And as a nation, if we don't be honest and look back at our history and look at how we got to a place where we have mass incarceration that disproportionately impacts Blacks, wealth inequality, health inequality, housing inequality, education inequality. The only way we get to a place where all these things are happening is because of systemic problems. And the African American History Act will help us to analyze and understand those systemic problems so we don't repeat them going forward.
And shifting gears to a related policy here, the Green New Deal for public schools, your ambitious proposal to invest $1.4 trillion over the next 10 years in Americans' public K through 12 schools. So how much of that climate agenda, though, since it was trimmed from Biden's bipartisan infrastructure deal to get it passed, where does that leave then some of these schools and these students who do tend to get overlooked?
It's a shame because our schools, particularly our schools in communities that have been historically redlined, have also been historically underfunded. So if you live in a wealthy community, your students, the students in that community receive twice as many funds per student than are received in Title I communities. So that is inequitable and that is completely unacceptable. In addition, we have to end our dependency on fossil fuels by the year 2030. Some are pushing even to 2035, because as we have seen, the frequency of severe storms and drought and hunger and everything related to the climate catastrophe we are currently living in will become more consistent. So the Green New Deal is about ensuring our schools end their dependency on fossil fuels. Our schools will finally fully invest and equitably invest in our children. And we will create pipelines, work pipelines for workforce development in the areas of clean energy, but also in the areas of teaching and learning and teacher assistance. And finally, we want to put students in the driver's seat of their own learning. No more sitting in rows and teaching to a standardized test. We need our students to be creative, innovative problem solvers so that they can be prepared and conquer the challenges of the 21st century.
And you really are taking a holistic approach to this. I mean, you wear a number of hats, including being the commissioner of the Commission on the Social Status of Black Men and Boys. And you're really investigating the potential civil rights violations and how they affect them, and some of these disparities, whether it's in education, employment, fatherhood, etc. What does this holistic approach mean, not just for how Black men and boys progress economically, but also access to some of these opportunities to build generational wealth?
So when I worked in education as a middle school principal, we saw all of the inequities and inequality land at our doorstep each and every day. So a child cannot learn and cannot thrive in school if they are hungry, if they're housing insecure, if they have trauma from a family member being caught up in the criminal justice system, or if their schools are underfunded. And if we haven't dealt with the historical trauma, the intergenerational trauma, and the epigenetic trauma that many in the African-American community struggle with, we have to deal with it all. We have to deal with the present and the past in order to get to the future we want, but we also have to deal with all of the things that impact a child's learning in our schools. Because once that is internalized, once the inferiority because you are Black, or inferiority because you're a woman, or inferiority because you are different sinks in, that becomes your lived reality. We have to look at our history, right? After slavery, we did not get our 40 acres and a mule. As a matter of fact, the Homestead Act gave millions of acres of land to everyone except Black people. There haven't been any investments in Black banks in a way that allowed us to build wealth in our communities. And the list goes on and on and on. So it's about a holistic, both present and past look, but it's also about, as we deal with the present, let's deal with, for example, violence. Let's not just deal with the crime after the fact. Let's stop people from committing crime in the first place by dealing with the issue of poverty.
Indeed, a tough subject to tackle, but we're glad to see you doing the work. Thank you so much. Congressman Jamal Bowman there, who represents New York's 16th Congressional District. Thank you for your time. All right, coming up, MoviePass, the app strikes back. Find out why after a 2-year break, you might not be able to take your eyes off what the company has to offer movie lovers with its relaunch. Stay with us.
Welcome back. MoviePass is making a reboot. The movie subscription service is returning this summer after filing for bankruptcy about 2 years ago. And for more, we have MoviePass CEO Stacy Spikes joining us now. Stacy, thanks so much for your time this afternoon. What should consumers be expecting from the new MoviePass this summer?
Thanks, Emily, for having me. We are looking forward to a new and exciting version of MoviePass that's completely different than what we had before. And it's going to give everybody a really good way to get back into the movies and start going to see cinema again.
And in terms of monetizing this reimagined MoviePass, you've talked about the relaunched MoviePass using a credit system rather than the fixed cost unlimited viewing plan used previously. Where would pricing start for these credits, and how would this plan work?
Yeah, so we're still in the research phase on what our pricing plans are going to be specifically. But what I can tell you is that there's going to be a credit system with the marketplace that people will be able to use different credits at different times. So if you are going on a weekend and you are a peak viewer, you may use a different number of credits than if you like going in the middle of the week and it may cost you less. And we heard feedback from the theaters that have said they wanted to be the ability to market to customers and set themselves apart. So that's part of the reason why we decided to go with this credit system.
And when we think about the pricing strategy that MoviePass had previously 2 years ago, one of the challenges had been because so many people were going to the movies and going more than that fixed fee was actually covering. Was that pricing strategy really the main pitfall that you saw for the previous iteration of MoviePass, or were there other challenges that over the past couple of years you've seen that needed to be reworked?
Yeah, the owners who had taken over MoviePass, so I was the original co-founder of the company, and we had left at the sale. They set it at a price point that just wasn't realistic to be able to maintain. It was cheaper than the average ticket is in the United States. So that has to be corrected, but there's ways to do it that people can come in at levels that are right for them, but also have the ability to go to more if you want to, but you're still not paying prices you would at full price.
And when you think about what the new MoviePass is going to look like more broadly and even years into the future, you've talked about potentially leveraging crypto, Web3, and the metaverse here with MoviePass. Can you talk a little bit more about your plans for this and actually incorporating some of these ideas into the business?
Yeah, so one of the things that we've noticed with NFTs and some of the things that are emerging there, they're really tied to collectibles and memorable events that you're experiencing, like whether you go to a concert or you go to a special movie. We think that there's a marketplace for that. We do think that there's, a tie-in to the live event, which movie-going is still the #1 out-of-home entertainment in the world. And so there are ties that we think that we can be able to make a robust end-to-end cinematic marketplace using a lot of the Web3 technologies that are coming online. Crypto specifically, I don't think we have things that are that tight and that specific in relation to that, but we do think using credits, make them transferable, make them shareable among people are things that you can use blockchain and be very effective with that.
And to that point, just today, Disney's CEO Bob Chapek had appointed an executive to lead Disney's own metaverse strategy. I'm wondering, what have you been talking about, if you have been talking about, talking with some of these studio executives about what the metaverse strategy is going to look like for some of these studios and how MoviePass could potentially be a part of this?
Yeah, I mean, they've been keeping their cards pretty close to the vest on metaverse specifically, but in relationship to MoviePass, hands down, all the exhibitors and studios have said, we'd love to see you back in the marketplace and helping drive traffic as we all emerge from the pandemic. So we want to get back in the game. And we saw prior to that really seismic numbers, sometimes even as high as 20% of traffic being driven by MoviePass on Oscar titles and some of the art house and independents. So we're thrilled to be able to get back in the ring and fight for this industry that we love so well.
And again, going back to this idea of expanding with crypto and into Web3, do you think legacy movie theaters are prepared for and ready to embrace these changes that MoviePass may be implementing?
Yeah, I mean, largely it's we think that the consumer is the one that needs to be ready to make that leap, but the way that we're building it is we're making it seamless that the exhibitors don't need to do anything. There's no hardware or things that need to happen on their end. We can build a lot of that all on our side that doesn't affect them or make any changes into their POS systems or the payment systems that they need to do today. It wouldn't affect them at all.
All right, we'll leave it there for now, and we will continue to track developments as MoviePass relaunches this summer. Stacey Spikes, MoviePass CEO, thank you so much.
Thanks
and
so
Brad,
much,
I'll turn it over to you.
Awesome. Well, we're going to get to the most read story of the day on Yahoo Finance. Sandy Hook school shooting victims' families that reached a $73 million settlement with gun manufacturer Remington. We're going to have the details for you coming up next.
Welcome back to Yahoo Finance. Now we're going to take a look at the top story of the day on Yahoo Finance. It's a tough one. It's the families of 9 victims of the Sandy Hook Elementary School shooting have agreed to a $73 million settlement with gun maker Remington. Now, obviously, a very tough story. This happened in 2012. 21st graders, 6 educators killed by shooter Adam Lanza, who got a Remington Bushmaster rifle from his mother, who did purchase it legally. I mean, this is an incredibly tough story. So, I mean, I understand the interest in it. It was a tough story to cover back then in 2012 for a lot of journalists, not to mention parents who had to watch this as well. So I'd love to bring you guys in. Emily, your thoughts on this top story of the day.
Certainly, Rochelle, as you mentioned, definitely a difficult topic for many here. But in terms of the impact of the settlement, in addition to the $73 million that we're seeing here as part of this, this also does include an agreement. We should note that Remington released a number of internal documents, which may include the company's thinking about how it marketed the weapon that was used during the massacre. And this is a step that could open the door to more scrutiny, not only for Remington, but for the broader gun industry. So that also is really the center of how the settlement even was able to happen. There are significant federal protections that typically shield gun makers from legal action when their weapons are involved in a crime. But in this case, the parents of the victims suggested the way that Remington was promoting its products encouraged illegal behavior and so violated state and federal laws around sales and marketing practices. So certainly something to continue to watch going forward here on the gun industry, on the regulatory front. And Brad, I'd love to bring you in on this topic as well.
Yeah, we all remember, of course, hearing the outcries from the families who were impacted, the victims' families who have been calling for gun reform, who have been calling for stricter gun laws, and particularly more safety in schools as well. And with regard to even how this settlement, how long it took, just the proceedings, nearly 10 years after the events, the deadly events of Sandy Hook, and particularly for the gun manufacturers, they look at this and they say, okay, we've got insurance that covers us, because at the end of the day, I think the gun manufacturers, they got off easy here. It's still the insurance that they're going to be leaning on. That's what's going to be paying out the settlement. And so at the end of the day, now it's up to insurers to be even more strict on these gun manufacturers as well, and look into, as you mentioned, Emily, how the gun manufacturers themselves are marketing so many of the products that they produce as well. Rochelle?
And some of these gun manufacturers, they really are in a tough spot. We saw that the plaintiff for the victims' families said, this was really a wake-up call for the gun industry to really think about how it markets its products in a way that lowers risks rather than courting it. Now, that's a tough sell if you, as a company, it's your goal to try and sell more guns. So I'm not sure how some of these gun companies are going to balance that. Obviously, we've seen a number of them go into bankruptcy as a result of this, some of these marketing companies, and also with Remington itself having to sell off some parts of its company as well. Emily?
Absolutely. And just to read a quote here from Josh Koskoff, who is the attorney for the victim's family, he's saying, and this being quoted by NPR, quote, for the gun industry, it's time to stop recklessly marketing all guns to all people for all uses, and instead ask how marketing can lower risk rather than court it. For the insurance and banking industries, it's time to recognize the financial cost of underwriting companies that elevate profit by escalating risk. Our hope is that this victory will be the first boulder in the avalanche that forces that change. So again, certainly something to continue watching here for the broader regulatory front in the gun industry more broadly. Rochelle?
And so obviously a lot of things to watch today other than that top story of the day. We were taking a look at markets. We're seeing that they closed green today, a real turnaround from what we saw yesterday with Valentine's Day, all red across the board. We certainly see what a difference a day makes for markets as they saw some of those tensions in Ukraine and Russia easing back. We also had President Biden coming in saying, look, we're pursuing this path of diplomacy, not taking sanctions off the table until they get more concrete evidence about Russia's moves, but at least some sort of dialing down. And the markets certainly seem to welcome it. Brad?
Yeah, and just to jump in here with some of the earnings that have come out after the market closed as well and see how those companies are doing. We were seeing Roblox move lower sharply, and we're going to see what these companies, who are many of them kicking off or already started their earnings calls, what the executives say, and that's going to be in focus for sure. Roblox shares moving lower by about 13% now. Viacom, or should we say Paramount, they're going to have a lot of explaining to do, but they've got some of the growth that they may tout on the Paramount Plus side as well. Those shares, though, moving lower in after hours trading by about 4.4% here right now. Well, everyone, that's going to do it for us here today on Yahoo Finance Live for the closing bell hours, at least. But you can catch us once again, 9 a.m. tomorrow live with much more business coverage, and Rochelle and Emily and myself at 3 p.m. tomorrow. We'll see you then.